Get yours today.
Welcome back to Squawk Box. Investors gearing up for the first trading day of the second half. Will AI stocks continue to power the markets higher? That is the question of the morning. Joining us right now, perhaps with the answer, Stephanie Lee, Chief Investment Strategist at Hightower and a CNBC contributor. Why don't we go there first?
Good morning.
Good morning, good morning. So AI, all these AI stocks, are they really going to power us higher? Are they going to turn on us? What's going to happen?
I don't know if they're going to turn on us, Andrew. Maybe they pause for a bit. I mean, they've had a heck of a run, but I don't think it's over by any means. I think you're in the second or third inning in terms of AI. I mean, look what we learned over the weekend, that Amazon is going to spend $100 billion over the next 10 years on data centers. And so when you have all these hyperscalers spending all this kind of money, it's just so positive for the overall space in general. That being said, these stocks have had a nice move, and I do think we are going to see good earnings across the spectrum in the market. Other sectors, I think financials can play catch up. I think energy definitely can play catch up. Pockets of industrials that have pulled back most recently, especially those tied to kind of grid and power and that sort of thing, they have pulled back. I think you're getting a good look. And overall, why do I think earnings are going to be good? It's because the economy is running at about 2.5%. Inflation's coming down, and perhaps we get a friendly Fed at some point later this year. So all that kind of bodes well for not only AI, but also other parts of the market.
Okay, what's your NVIDIA call at this point in the ball game?
Oh, well, I don't own NVIDIA, so I missed it, but I do think there are other ways to play it. I own Broadcom. They're the number 2 player. They're going to have about $10 billion worth of AI stuff over the next year and a half. That was actually less than $2 billion just 2 years ago. So they're going to benefit. I think the memory guys are going to do well. Applied Materials and Lam Research, KLA. Because you need 6 times the memory for AI, and so they will benefit too. So I think there's other ways to play it.
What do you think of the stragglers? I mean, when I say the stragglers, the Intels, the AMDs, the Qualcomms, that all of which would make an argument to you if they were sitting here that they are major players in this, as a lot of this stuff's going to need to go to the edge, as a lot of these models are going to get smaller. Do you buy that?
Yeah, I mean, I think that this entire trend will help a lot of companies. But the problem is you have to execute, Andrew, and I'm not sure that Intel over the last several years, well, I'm pretty sure that they have not actually executed. So you actually need to have not only the trends in your favor, tailwinds from AI and the spend and that sort of thing, but you also need to have companies that are going to do well and also have a strong strategy. I think that Intel has they're involved in kind of like this investment cycle at this point in time, and so it's always hard to own companies when they are in an investment cycle mode. Qualcomm, I think, is a little bit ahead of Intel at this point, but I don't know. I mean, like I say, I prefer Broadcom on any pullback. I prefer Lam Research.
Steph, can you explain, to the extent you have a view, what you think the impact of the uncertainty around the Democratic nominee will be on the markets? Which is to say, you know, I think we all sort of saw where things were going even 2 or 3 weeks ago, and now maybe we don't. And I don't know if you think that changes the dynamics at play around regulation, around taxes, around anything else, and whether you think that CEOs who might have been looking at certain types of CapEx spending in the next couple of months might say to themselves, you know what, I'm going to hold off because now I really don't know what's going to happen.
Yeah, no, and there's definitely a little bit more uncertainty at this point in time, Andrew, but what I have found in my career is that it doesn't necessarily matter so much about the presidency. It really matters about Congress. It really, the makeup of Congress, right? If it's a split Congress, that's actually what the market likes, because nothing gets done, unfortunately. I don't like to say that, but that's what the market wants. They don't want any surprises. So it's more important there than it is.
What's your S&P earnings for next year? Because we're going to have Tom Lee on, and I think he thinks he was at 270. I think he's higher now, and even if multiples could contract, and it still puts you much higher on the averages, the S&P. What do you think for next year?
Joe, it's either earnings or multiples, right? That's how you get higher or lower stock
what's your
prices.
earnings number?
And so I do think, I think you're going to see 8 to 10% this year, and I think you're going to see about the same for next year.
Would
And a
that
lot
be
of that is
280?
because the economy.
Would that be about
Could be.
280,
Could be.
285? Yeah, okay. Just
Could
wanted
be,
to.
sure,
We're gonna have
of
them on in a
course. I mean-
second. And,
Yeah,
That's a lot.
No, I mean, look, I think that's why it is a lot, but the economy is running. The Atlanta Fed tracker just came out last Friday at 2.2% for GDP. When you have GDP growing at about 2.5%, you can get mid-single digit revenue numbers, and you can get with margin, a little bit of margin, either it stays strong or expanding, and that gets you double digits in terms of earnings. There's a lot of operating leverage as margins come in better than expected, and I think a lot of people are not expecting margins to be better than expected. You have pricing power, and now you have lower inflation. That's good for margins. So overall, I feel pretty good about the overall earnings picture. Again, because the economy is doing pretty good.
Okay. Stephanie, thank you. Nice to see you.
Thank you.
All right, still to come this morning, big tech going nuclear. The AI boom means big energy demand. We've got that story right after this. As we head to a break right now, though, check out the price of crude oil. It is up slightly this morning and is gaining about 15% year to date. Squawk Box will be right back.
NBC.
Welcome back, everybody. Tech companies are making moves to go nuclear. The Wall Street Journal reports that owners of roughly a third of U.S. nuclear power plants are in talks with tech firms to provide electricity to data centers to meet AI demands. Amazon Web Services is nearing a deal for electricity supplied directly from a nuclear plant with Constellation Energy, which is the nation's largest owner of nuclear power plants. AWS also recently purchased a nuclear-powered data center in Pennsylvania for $650 million.
Coming up, Boeing finally happening, striking a deal to buy back parts maker Spirit Aerosystems. We'll have the details next. And later, Fundstrat's Tom Lee with his latest call on the markets. It's it July 1st?
It is.
First day of the second half. Good time to check in with him. Squawk Box coming right back.
What are you waiting for?
Boeing striking a deal to buy back Spirit Aerosystems. Phil LeBeau joins us right now. He's got more on that front. Hey, Phil, we knew this was coming, but I guess this is the deal.
Yep. Well, it took a while to put together because there is a third party involved here, Airbus, which is taking a chunk of Spirit Aerosystems as well. So here's the deal altogether. It's $8.3 billion. That's the total value of the deal when you include debt, which Boeing will be assuming. Boeing gets 80% of Spirit. Airbus gets 20%. For Boeing, the importance here, and we've talked about this for months, they have to have some way to better integrate the fuselage manufacturing facilities from Spirit, most notably in Wichita, Kansas, but also in Tulsa. They have to incorporate those so that there is better quality control, the manufacturing process. So many of the problems that we have detailed over the last year and a half have been surrounding the facilities from Spirit in Wichita. So they now get that fuselage plant. 14,000 workers who were at Spirit will now be part of the Boeing team. As you take a look at shares of Boeing, remember this is an all-stock deal structured that way so that it would help Boeing withstand a credit downgrade. If it were to pay cash, there likely would have been a credit downgrade. $3.5 billion of Spirit Aero's debt will also be assumed by Boeing. In a message to employees, Boeing CEO Dave Calhoun said, "We believe this deal is in the best interest of the flying public, our airline customers, the employees of Spirit and Boeing, and the country more broadly. This deal is not going to close right away. They expect it to take until at least the middle of next year. As you take a look at shares of Boeing, that's when they expect this deal finally to close." And I mentioned the Airbus component of this. Take a look at shares of Airbus. Spirit is actually paying Airbus $559 million to take a couple of its facilities, the most notable one being in Belfast, Ireland, where parts for the Airbus A220 are made. The reason they're paying Airbus, these are all loss-making positions so far in terms of their facilities and what they're manufacturing for Airbus. So that's the deal, guys. The one that everybody was expecting to come together has finally come together. And as I've mentioned many times, there are 4 things that need to happen before you start to see shares of Boeing potentially move. This was one of the 4. Obviously, the big one is naming a new CEO. And when that happens, that might be the start of a catalyst towards seeing where Boeing shares go, let's say 6 months, 12 months down the road.
Hey, Phil, there were so many questions around Boeing's safety credentials that have been raised.
Yep.
And I know people look at Spirit Aerosystems and say, okay, that was a big part of the problem. Does it fix
Sure.
it to simply bring that back in-house? Or, you know, just the idea
We'll find
that
out, Becky.
a company
I mean,
that's
Boeing
already
already
being
has-
questioned. Yeah.
Sure. You're hitting right at the main question that many investors have, which is how quickly can they correct the problems at Spirit? And oh, by the way, they've got their own problems. So the company with problems is trying to fix another company with its own set of problems, related but separate to a certain extent. That's the big question. How quickly can Boeing do this? I have seen some reports where the airlines, and most notably Ryanair, has said some of the planes that are being delivered, albeit at a much lower production rate, there seems to be an improvement in terms of when they're delivered, perhaps fewer issues that the airlines have to shake out when they take delivery of a new aircraft. But it's going to take time. It will take time before Boeing can say, look, we think that we are in a place where production can move substantially higher because the quality controls are in place.
Phil, thank you.
You bet.
Okay, coming up after this, we're going to talk about it because a weekend of damage control and fundraising for the Biden campaign out in the Hamptons over the weekend. We're going to have the latest on both of that story next. And a reminder, you can get the best, of course, of Squawk Box in our daily podcast. Follow Squawk Pod on your favorite podcast app and listen anytime. We'll come right back.
and Peacock.
Welcome back to Squawk Box. We're going to talk some politics right now in the post-debate fundraising blitz that took place over the weekend. Megan Casella joins us now with the latest. Good morning.
Hey, good morning, Andrew. So the Biden campaign spent the weekend looking to shore up confidence among its supporters after that debate. They've been alarmed by Thursday night's debate, and the Biden campaign is really pointing to its fundraising. It says the campaign raised $33 million from Thursday through Saturday, with most of that, about $26 million, coming from small dollar donors. They say Thursday and Friday were their best ever days for grassroots fundraising, which the campaign says shows the voters are still with them. Biden also needs the wealthy donors. He had 3 big fundraisers this weekend. And I spoke with attendees who told me they were reassured by how the president seemed at those events. One described the mood in the Hamptons as one of, quote, concerned enthusiasm, while another said people in New York were resolved to do even more to help Biden win after Thursday. A third source told me the debate was a, quote, cold shower shock for Democrats about the state of the race, making them more engaged, in part because they're now more frightened about the potential outcome than they were on Thursday. So the emerging consensus really seems to be that while, yes, there's a lot of frustration that the party is in this position, they're standing by their candidate. And the upshot really is that if you were supporting Biden because you were anti-Trump, after that debate, you're still anti-Trump. Andrew?
Real quick, Megan, there's also been reports, though, that a number of big donors have talked about putting together a separate fund, in fact, that would be dedicated only if another nominee were to emerge, and that money would not be made available to the president. What do you think of that?
I think there's a little bit of bulletproofing going on, right? That, some candidates are trying to raise more just in case they need it. But the upshot from the folks that I talked to was that the calls were really dying down for President Biden to resign. When I spoke with people on Thursday, the mood was one of major alarm, calling the debate a disaster, saying there had to be something done to force him out. By Sunday, that had really calmed down among the same people. So I think, yes, that sentiment is out there. One thing that we did see over the weekend, or it was on Friday, was LinkedIn co-founder Reid Hoffman came out with a long email laying out 5 points as to why he thought that shouldn't happen. It was a bad idea. And people are really sort of coalescing behind that from the people I talked to of just, it's up to President Biden and his family, and if they don't make that decision, we're still going to support him no matter what, because at the end of the day, this is Trump versus Biden.
We got to thank you. I got to tell you, a number of the people that I spoke to, they may be in the position you're describing, but it's not because they want to be. It's because they think he's going to refuse to actually step down, and therefore that they think this is sort of a reality they have to accept.
It's easier if he doesn't for everything, but it may not be. Let's talk about this with someone who's been all over the story over the weekend. Axios National. Alex Thompson is going to join us right now. Oh my God. Alex, thank you for joining us this morning. Every time I think we should talk about it, I'm ready to look down at my screen and see something citing 6 unnamed individuals who requested anonymity, and they're going to come out and say something, and I'm ready for anything at any given time. It's such a fluid situation right now. We heard, the move is afoot to find somebody else. We've heard that, and then we've also heard that the wagons are circling, and it'd be so difficult, and there's no heir apparent that's totally obvious either. Alex, what do you expect to happen? What's as of what time is it? As of 6:40, what do you know? A.M. East Coast time.
Well, both things can be true, that some people are already scouring to see if there can be a replacement, and also the wagons are circling around Joe Biden. You basically saw Joe Biden's family really take the wheel over the weekend. He went to Camp David for a pre-scheduled shoot with Annie Leibovitz, which I can tell you did not go over great with a lot of very concerned Democrats who felt that the Bidens were not reading the room. That also included the First Lady on the cover of Vogue this month, which just dropped this morning. That being said, the only one that can get out of this race is Joe Biden. The party cannot force him off the ballot. He won the primary. This is a one-person decision. And the fact is that a lot of donors, a lot of Democrats, a lot of White House staff are both simultaneously sad because of how this could affect the election, but also feel really angry right now because they feel like they've been gaslit. They could see Joe Biden was struggling in public forums the last 6 months especially, but also over the last year, and basically were confronted by eye rolls and people in the White House being like, he's as sharp as ever. Yeah, maybe he has some physical frailties, but he's fine. The fact of the matter is the debate undermined that, and now has even people in the White House questioning not just about whether or not he can win this election, but whether or not he should actually be president in 2029, which is what he's running to do.
It's an unholy alliance between those people who I don't, that's what they have to do, I think. They didn't really have much choice than to try to protect him and to keep him out of, as much as possible, to present him in the best light they could. Now, the mainstream media, I don't know, they're just in the tank, and I don't understand how they defend themselves after this.
Well, I think you've seen a huge shift in the mainstream media since Thursday's debate.
It's kind of sad, though. They pull the rug out from under him. Just pull the rug out from under him when they no longer need him and don't think he's useful to their cause anymore. It's all just, I guess it's politics and human nature.
Well, actually, to your human nature point, I actually think part of this is that reporters feel lied to, too. I mean, that's like what the main reaction, and I've had this experience, too, as I've reported on Biden's age several times over the last year, and the White House has issued denials, has gaslit, has deflected, has not told the truth. Not only just to reporters, but sometimes actually to themselves. I think there's a little bit of denialism happening within the White House among some of his top aides, in addition to this.
They're now blaming the media. I mean, I saw that they're saying if there's any drop in the polls, it's because the media is exaggerating this. I mean,
That's what they said all along, though.
I mean, it is extraordinary because just 2 weeks ago, you'll remember the Wall Street Journal had that big story that had behind the scenes Biden is slipping, and they basically, in all but essence, called it fake news. Right. And now they're saying it again. So
right, they had 30 sources, and people to me, Brian Stelter, people like that, calling it poorly sourced, just whatever it takes from the White House, just almost repeating verbatim what the White House told them to say, right?
Yeah, I mean, the Journal could have avoided some of that pushback if they had not just had Republicans on the record. That sort of gave the White House an easy out. But the truth is that the Journal's reporting has basically been borne out by what everyone saw on stage, that Biden has been slipping. Now, he can still win this race because the fact of the matter is that there are tens of millions of people in this country that would still vote for Joe Biden at 110 over Donald Trump. Right. And you actually saw that in some of the flash polls afterward. 33% of people still thought Joe Biden won the debate. Now, that is higher than what Barack Obama had after his disastrous debate against Mitt Romney in 2012. So it sort of shows that political polarization still gives him a
CBS poll
chance.
yesterday showed that nearly 75% of Americans thought he was too old to hold office.
I mean, it is very difficult to win a presidential race if that is the stat you're working against. And that might be the mechanism. It's going to be really tricky because it's July 4th weekend. It's unclear when we are going to get the next series of really high quality polling. And that could really shift the narrative here. If you see a complete collapse of 5 to 10 points, which I think is within the realm of possibility, you could start seeing donors flee en masse. And then what does the rest of the party do?
Alex, I got two questions for you. One is, you wrote a piece over the weekend that got a lot of attention, just about what was known inside the White House, what wasn't known inside the White House, how many people were in this sort of inner circle that might have known the true state and condition of the president relative to maybe the way this was described to the public. Can you just talk about not just the piece itself, but also I'm very curious what the reaction was to that?
Yeah, so basically, the piece was that the core inner circle of this White House, which is about a dozen to 20 people, have really cordoned off the president since day one. And that is what has led to this shock factor within the White House. The fact is that a lot of White House aides watching the debate on Thursday night had no idea that this sort of side of Joe Biden existed. And part of that is because they really had intermittent access, and occasionally they would see a bit of a senior moment. He would forget that he had called the mom of a certain lawmaker a few weeks ago, and then he'd be like, oh yeah, and people just sort of brushed it off as like, oh, it's a brain fart, anyone could do it. Now what it appears to be is that was a more consistent behavior.
How do we know if they didn't know? How did everybody in the world know if they didn't know? It's like, don't believe your eyes. What, you got one more? Because I want to ask him something about
Well, no, and the second related question to this, though, is clearly it appears that Jill Biden, Jill, not Joe, but Jill Biden is the prime mover. I don't know if you believe that she is the prime mover, but there seems to be a view inside the party and among some very senior people I know that she's going to be the prime mover on terms of any decision that gets made. So the question is, where are the pressure points around her and her perspective, and also to the extent that they would pick a replacement if they did, how they would have to pre-wire that or want to pre-wire it.
Let me just add to that, throw in Joe Biden's sister, because I've seen reports that she's been not on board for a year, and she supposedly has a lot of influence. That puts her in direct opposition with the First Lady. Does it?
Okay, so a few parts to that. So Jill Biden is the most important person in this coming month about what decisions he's doing. And you saw her take the wheel. I mean, you saw her do that rally right after the debate, praising Joe Biden for answering every question. And then you also saw her really introduce him in a pretty fiery rally. I can also tell you in those fundraisers over the weekend, people there were struck not just by the fact that Joe Biden was still talking on a teleprompter, but by how much Jill Biden spoke at those fundraisers. In some cases, it seemed to be about half the time. And in terms of the pressure points around her, I'd say the most important person, and perhaps one of the most powerful people really in the country, someone who's not very well known, is Anthony Bernal, who's been with her since 2008, is incredibly influential, not just in the First Lady's office, but throughout the White House and the administration, and is sort of the, in some ways, the loyalty czar of the family. And so I think that's going to be, those are the main people that are really influential.
Right. Alex, what kind of, just to the last piece of the last thing I asked you, what kind of phone calls have you gotten from the White House or others around him since you put out that report?
It's interesting. In terms of the official White House comms, nothing really. But in terms of other White House people, I think there's been, honestly, it ranges from anger to being sad. And there's deep anger among many people in the White House of now being put in this position where they might not only lose the election, but this could also affect their own careers, their own legacy. And there's also fear that Joe Biden, who's lived really an extraordinary life in public service, that his own legacy could be permanently scarred by this. It could be the first line in his obituary if Trump were to win.
Right. And Hunter, we didn't mention Hunter. Hunter said that his father's the smartest guy he knows, and his father said he's the smartest guy that he knows. It's nice back and forth thing. Thanks, Alex. Talkbox will be right back.
No problem.
What are you waiting for?
Still to come this morning, the Supreme Court overturning a 40-year-old decision that allowed federal agencies to more easily regulate the environment, public health, workplace safety, and other consumer protections. To push back against big government, Dr. Scott Gottlieb will tell us how this ruling could impact his former agency, the FDA, and future drug approvals. Squawk Box will be right back.
NBC.
Welcome back, everybody. The Supreme Court has overturned a 1980s precedent known as the Chevron Doctrine. That decision could actually undercut federal agencies, including the FDA. Joining us right now for more on this is former FDA Commissioner and CNBC contributor, Dr. Scott Gottlieb. And Dr. Gottlieb, thank you for being here. I wanted to talk to you about this, not just in your role as the former FDA Commissioner, but also as someone who used to work at the American Enterprise Institute, which takes the view that big government's not always a great thing. And I just wonder how you are looking at this decision that was originally brought by fishermen in the Atlantic who were unhappy with having to pay for monitors who were watching over what they were hauling in. Why don't you talk through how you see all of this and what it means?
Right, and I'm still at the American Enterprise Institute. Look, I think a lot of conservatives viewed this as a way to constrain the administrative state, that regulatory agencies had expanded the scope of their authority into new areas that Congress hadn't clearly delineated. And now agencies aren't going to be able to do that. When you were a regulator, so when I was at FDA, if we issued rulemaking and we were interpreting the statute in areas of ambiguity to try to apply our regulatory oversight to new areas of supervision, new product areas, we generally, as long as we went through rulemaking, we generally felt that the courts would defer to us under Chevron doctrine. And that was a reason to go through the rulemaking process, so that deference would attach. Now that presumption no longer exists, and so you're going to have to go back to Congress in many cases, get explicit authority if you want to extend the agency's jurisdiction into a new product area. Now, with respect to FDA specifically, I would expect that the courts will still defer to FDA on fact-based decision-making with respect to the drug approval process or medical product review. Courts and Congress has given the agency broad grants of authority in those areas to make fact-based, science-based decisions. But when the agency is trying to delineate its regulatory supervision over new product areas, for example, laboratory-developed tests or certain food safety rules, I think those are the areas where the agency's authority now is going to be more ambiguous. They're going to be challenged. And Congress ultimately is going to have to come in and probably re-legislate some of these areas to make sure that the agency's jurisdiction, its authority in places where you want the agency to be regulating, where it's very clear.
Could you have gone after Juul the way you did in their marketing towards kids under this new ruling? Or this
It's
ruling
quite
being
possible. Right, so one of the rules that could very likely be challenged is the agency's efforts to try to regulate flavored vapes, for example. A lot of what we did when we went after Juul was taking enforcement actions under the existing statute and regulations, which I think was pretty ironclad. I think we were on firm ground, and we were challenged in courts, and we prevailed not under Chevron deference. But I think that have been some rules that have been promulgated in the intervening years, particularly around flavored tobacco products, where the agency could face a challenge. That would be one of the more immediate places I think you'll see some litigation now as a result of this decision. You know, you led at the top with the politics of this. It's interesting to just go back to 1984 when this doctrine was first established. It was actually conservatives that were fighting for it because they felt that the courts were second-guessing regulatory agencies. Remember, those regulatory agencies were under the control of a Republican president at the time, and they felt that the regulatory agencies should have more jurisdiction and not the courts. And so now you see the politics of this reversed, to your point.
Yeah. I was just reading, I didn't even realize Supreme Court Justice Neil Gorsuch was in the majority deciding this. It was his mother, who was the former EP administrator, Ann Gorsuch, who actually made the decision that the Supreme Court upheld back in 1984, which is describing your point exactly, how it has changed flavors with them. I guess my question is, I've had other people who are former FDA officials saying, look, this could be very bad because it could mean that Congress basically has to sign off on every decision that they're making. Could really slow things down, especially when you consider that Congress can't even do its own job on time, which is coming up with the budget. Are you concerned on that level? And you mentioned yourself that Congress may have to rewrite some of these rules. Do you see that happening? How long would that take, and how difficult of a job would that be to get through Congress?
Yeah, with respect to FDA, I think that there is a general view in Washington that they go through very careful rulemaking. It's the agency issues a lot of regulations, and if you look at a lot of FDA statute, Congress gives the agency broad grants of discretion by directing it to develop guidance in specific areas. So in areas where the Congress has explicitly said, we want you to develop a guidance to delineate what your regulatory oversight is going to be in this general area, I think if you read the recent Supreme Court decision, those would be perceived as general grants of authority back to the agency. And so I think you're going to see more of that in statute. I wouldn't be worried about the agency's decision-making around scientific matters, product review decisions. I think it's going to be in areas where the agency has stepped in to regulate new areas of technology where Congress didn't explicitly direct the agency to do that. And so those aren't very common. They do exist. Laboratory-developed tests, as I mentioned, is one of the things that I would expect to be challenged quite immediately under this Supreme Court decision. But as far as the day in, day out of the agency's scientific decision-making, I wouldn't expect those to be subject to challenges. Another broad area where I think you're going to see more challenges is around the grants of exclusivity. The FDA makes a lot of determinations about what exclusivity periods different products are entitled to. Those are already the subject of a lot of litigation. I think under this new recent Supreme Court ruling, you're going to see more challenges there.
All right, Dr. Gottlieb, thank you.
Thanks a lot.
Okay, it is now 7 a.m. on the East Coast. You're watching Squawk Box right here on CNBC. I'm Andrew Ross, working along with Joe Kernan and Becky Quick. We got a lot going on this Monday morning. The top story, Boeing agreeing to acquire Spirit AeroSystems for $37.25 a share in an all-stock deal that values the company at $4.7 billion. Boeing saying the move is to buy back its troubled former subsidiary will help improve safety and quality control. Meantime, BlackRock buying UK data provider Preqin for more than $3 billion. It's going to use Preqin to create data tools for the private market, which BlackRock says is the fastest growing segment of the asset management business. And Apple's AI plans go beyond integrating its new Apple Intelligence technology in the iPhone, iPad, and Mac. Bloomberg now reporting tech giant is also working to bring these features to the Vision Pro headset. Apple's biggest challenge is redesigning how the features will look in mixed reality. Apple also changing how it demos the Vision Pro in stores, allowing potential buyers to view their personal media, which may make it more attractive because once you're in there and you can see pictures of yourself and your family, you sort of do an ooh-ah that's at a different level than sometimes some of the other stuff.
One of these days, maybe.
One of these days.
One of those.
You know what I just bought?
You're waiting for version 3.
No, you know what I just bought?
What'd you buy?
The Ray-Ban Meta glasses.
They're great.
I tried them on from somebody else, and I was so impressed. It's the
I've got
first
a
time
pair.
I've ever wanted one of these things. They talk right into your head. It's really cool.
That's all I need. I hear voices now. That's the problem. Checking the futures. Quick look. Close to highs in a couple of the averages, adding about 27 points on the Dow 14. On the NASDAQ, let's get to Contessa Brewer. Let's look at this morning's pre-market movers. And not like Caesars and
We're gonna move past because I was just thinking, if you're hearing voices in your head, isn't it just the producers talking to you in your ear?
Yeah, maybe that's it.
I mean, but like we all hear voices.
You can ask it questions and they answer. Well, I guess the producers.
I ignore the voices in my head. So yes, I think it is. I think it is the producers.
They're talking in my ear right now, like saying, "Move it along." Okay, Nvidia is getting a price target increase from Morgan Stanley this morning from $116 to $144. You're seeing shares though down in the pre-market by 1%. The analyst indicates there's strong demand from China, robust builds in Taiwan. Estimates stay the same short term, but Morgan Stanley's raising earnings estimates through 2025 to $334 per share from $294. Look, they acknowledge the sharp acceleration in valuation since the last earnings report, but say this is the most compelling narrative in the AI semi space. Wells Fargo is adding Tesla to its tactical underweight list and says it sees declining delivery growth driven by lower demand and diminished return on price cuts. It estimates deliveries will decline 14% year on year. Now look at this, sort of a rough report, and you've got shares higher by more than 1% in the pre-market. Wells also is raising questions about whether Tesla belongs in the Mag 7 at all because it's trading at 82 times PE versus its peers at 35 times on a lower outlook for earnings. But the robo-taxi event in August, of course, is taking up a lot of spotlight, which may be why we see shares on the rise. Birkenstock getting a raise on a price target from $52 to $85 from UBS. The analyst says its direct-to-consumer expansion is successfully executing. It is rapidly ramping up in Asia. Factory expansions are going well. Plus, he says the market's not giving credit for its ability to transition to closed-toed shoes. UBS's EPS estimate is now 10% above consensus, and Birkenstock shares on the rise by 4 1/3%, Joe.
All right, Contessa. Never owned a pair. I sold them. I think.
Oh, is it shoe sales?
Yes.
Really?
Yeah. I think someone on the
Al
set
Bundy.
has owned it. Yeah. Al Bundy. Shoe betcha. Shoe
You're
betcha.
sitting the same way. Go ahead.
Yeah, exactly. Oh, like this.
Yeah, there you go.
My hand down like this. Andrew, you own some Birkenstocks, didn't you?
I do.
You do now.
I do.
own a
I
pair
used
right
to. Part of my sales pitch was that the foam, like your toes, went into.
Yeah, they
the,
do.
now. Fishy.
I wasn't just exaggerating to sell the to get a sale.
No, it actually forms to your foot. That's the great part about this.
When do you wear them? And what
With
color?
socks.
And what color socks
that?
do you
What are you waiting for?
The last, the most recent time Tom nailed it was when he said the S&P would reach 5,500 by the end of June. It did. It hasn't closed above there, I don't think yet, Tom. But joining us now is Tom Lee, Fundstrat Global Advisors, managing partner and a CNBC contributor. But close enough for government work. You're right again. And once again, your rationale was borne out. It was that inflation would continue to cool. It's July 1st. You have a new target for the end of the year, or I've already sort of foreshadowed some of the things we were talking about. The S&P earnings might even be above what you thought.
Yes, I think that now that we're at the mid-year, 2025 earnings look a lot stronger than we thought at the start of the year. We thought maybe 260. It's probably closer to 275, maybe 280, even 285. And I think the multiple we thought originally could be 20 times that number for next year, but given the Fed has more reasons to be dovish, and I think maybe the employment picture is softening, PE multiples actually could be higher next year. So I'd say between now and year end, stocks should be higher. I mean, we've had a strong first half already, and second half won't be as strong as the first half, but we should build upon those gains. So yeah, it looks pretty good.
You have numbers. I mean, so if the S&P is 285, you possibly, that's earnings,
Correct.
285, up from 270. Because the economy doesn't cool, multiples don't expand. In fact, they might contract from 21 to 20. So if you multiply 20 times 285, you get to 5,800.
Yeah, so that sounds like it would be within reasonable, as a reasonable base case, that stocks don't have to have a prodigious second half. They just have to follow what typically happens in the second half, especially in an election year.
So 5,800 for the year, what would that be the total return? If it's 15 now, so
yeah, so it's, you know, it's a little bit more than 20%.
Which would be after last year's
24.
24. That's a couple of years no one really expected, I don't think.
That's right. I mean, that's painful for people who've been sitting in cash for 2 years, earning 5% because they missed out on a 50% gain, and that's 10 years worth of sitting on cash. So I think the end of this year is a little bit of a day of reckoning for those who've said, oh, I'm happy with my $6 trillion in cash earning 5%, when in reality, unless the economy is rolling into recession, you know, the expansion will continue for some time.
Is the $6 trillion, and that's what's fueling this, the additional liquidity, people aren't fully invested, was that gotten through organic positive means, or was it gotten through stimulus that shouldn't have been probably legislated and shouldn't have been printed? Is it good money, or is it money that comes home to roost because it's too much?
I haven't deconstructed that, but it's a valid point because, you know, we are running a pretty big fiscal deficit at a time when it's not necessary. There is a lot of earned income on people's assets. I think that accounted for a lot of this increase in cash. And historically, that would have been reinvested in the economy or into equities, but it's been instead earning cash.
You know that my insecurity about crypto manifested itself again in my feet of clay, because I said, Tom Lee's going to be absolutely right about the 5,500. Why is he still saying 150 for Bitcoin? Why do that? Why not just focus on stock? Don't stick your neck out, because it was falling below 60,000. Now it's back to almost 63,000. So that $6 trillion we just talked about, that sort of plays into your Bitcoin thesis.
That's right. Bitcoin's probably suffering from the Mt. Gox, you know, starting distributions in July. That was a huge overhang for many years. But if I was invested in crypto knowing that one of the biggest overhangs is going to disappear in July, I think it's a reason to actually expect a pretty sharp rebound in the second half. So I think, you know, 150 is still within.
It's already July 1st, so that's so you're not taking that off the table. That's still a possibility.
That's right. And, you know, one thing to keep in mind, Bitcoin makes most of its gains with 10 days every year. If you take out the 10 best days in a single year, Bitcoin actually has negative returns.
Hey, Tom, when you say there's a reckoning for people who have been hanging around in cash, that means that they're going to have to say, oh my gosh, what am I doing, and get into the market? Or that they've missed it all and they've missed, potentially years of advances?
Well, it's probably a little bit of both. I think that there is been valid reasons for people to be concerned because inflation isn't fully defeated yet, and there's people who think we could roll into a recession. So I think those are valid, but if we don't have those, then the stock market shouldn't peak next year. We're mid-cycle. We have a $100 trillion generational asset transfer going from boomers to Gen Z and millennials. They're going to have a higher risk tolerance. So I think stocks have a pretty long runway ahead. That's why I think 2 years is a day reckoning.
Related back to Bitcoin, I don't know if you saw the interview that I did with Peter Thiel and some of his comments last week in Aspen, which was, he of course was a massive bull.
Yes.
Famously called Warren Buffett a sociopathic grandpa because he was upset that he was against Bitcoin. But he seemed to take his foot off the gas at a minimum, suggesting maybe this price is where things are, and even made the comment, which I was very surprised by, about the way he looks at, the FBI and how the FBI says, criminals are using Bitcoin, and it was such a fascinating shift. I have to say, I was, like, when I asked the question, I thought I was, ready for him to say, it's going to, a Tom Lee style or Kathy Wood style, 500,000, and it was very much the opposite. I was totally caught off guard. Were you?
Yes and no. I mean, he has been very early in Bitcoin, so for him,
Right.
as he thinks about total return and he being, a venture capitalist, I think he's looking around today and seeing that there's all these other new opportunities. So Bitcoin isn't as shiny as it used to be, but that kind of makes sense because, the next generation of holders of Bitcoin are more institutional, not necessarily venture early stage capitalists like Peter Thiel.
I was surprised at with a gun to my head, I might vote for Trump. He raised money for Trump last time. He got so butthurt. He got so butthurt from that he barely can. I felt kind of bad. He looks like he's still dealing with the fallout from being doxxed and everything else. It's tough to live in Silicon Valley after you did that.
He doesn't live in Silicon Valley.
Well, I'm sure he doesn't at this point.
No, he moved to LA a long time ago.
Oh, well, that helps. I mean, he's still incognito there. He's got his N95 on all the time.
He does not, trust me. Tom, great to see you.
It's great to see you.
When we come back, the far-right National Rally Party won the first round of parliamentary elections in France, raising the expectations of a hung parliament. We will discuss the French elections and what it could mean for investors. And later, reaction to last week's debate and what it means for both candidates. Former Senators Judd Gregg and Heidi Heitkamp will join us. We'll be right back.
NBC.
Welcome back, everybody. Marine Le Pen's far-right party winning the first round of France's parliamentary election, and later this week, the UK voters head to the polls as well. Joining us right now is Max Bergman, Europe, Russia, and Eurasia Director for the Center for Strategic and International Studies. And Max, what did the snap election show, and what do you expect to have happen this weekend, both with the second round and with what happens in the UK?
Well, the vote was a real rejection of Emmanuel Macron. He's now, I think, effectively a lame duck president with 3 years left in his mandate. And he called elections, perhaps unnecessarily, but in part because the far right had done so well in Europe, in European parliamentary elections that were held earlier this month, where the far right did quite well. And I think he was sort of trying to call the far right's bluff and say, okay, French voters, do you really want the far right to be in government? And the end result is not a huge surprise. It basically reflects the vote that we saw 2 years ago in French presidential elections, where the far right got around 33 to 40% of the vote. So what we're looking at right now is a period of immense turmoil in French politics, where it'll probably resemble a little bit like the US, where we have divided government and nothing can really get done. It's a little bit more complicated in the French system because they are effectively electing a prime minister, and that prime minister also has a role in the executive and running government as well. So something called cohabitation, and it's unclear exactly how this will play out. This is the first round. There'll be a second round in another week. So then we'll know the final seats, but it's going to be pretty messy, I think, going forward.
Max, how would you just gauge the sentiment, the political sentiment, if you look at all of the G7 countries? You can look at Europe, you can look at what's happening in Canada, the United States. Where are the political winds blowing?
Well, I think there's anti-incumbent winds that are blowing. And I think in part in Europe, we have to remember that Russia's invasion of Ukraine sparked a real continental-wide energy crisis that caused huge increase in cost of living. And I think to the surprise of many analysts, that didn't lead to an anti-Ukraine vote emerging. It led to sort of an anti-incumbent vote emerging, and I think we're seeing that in Emmanuel Macron. In the UK, which is about to have elections on our Independence Day on July 4th, there I think we have 14 years of conservative rule. We have Brexit sort of really going awry, causing all sorts of economic complications. And we have effectively a loss of faith in the Tory party, the Conservative Party's economic management, and in part fueled by the cost of living crisis. And it's going to lead to a real rejection of conservatives. So we're not really seeing a uniform trend in the far right emerging or the center left emerging. It's sort of, if you were holding the keys to the car of government during a huge spike in cost of living, it probably impacted your popularity.
So inflation is the big boogeyman. We've had people say that we're getting inflation under control. How confident are you in that, and where would you look to see a resurgence in inflation?
Well, I think in Europe in particular, the energy crisis has abated, that the Europeans have actually taken enormous steps. We actually have a report at CSIS coming out this very week about how Europe responded to the energy crisis. And it's rather remarkable. Europe is far more energy secure, in part because of U.S. LNG, but also because of massive investment in renewables and other steps taken by the Europeans to get off Russian gas. And so that has led to prices coming down. And I think what we've seen with the European Central Bank is beginning to cut rates. So I think the ECB feels that inflation has been somewhat tamed. And I think there's a real hope that growth begins to really return to Europe. And I think that may cool some of the anti-incumbent sentiment that we're seeing across the continent. But it may be a little too late for Emmanuel Macron, at least in this election.
Max Bergman, thanks for joining us, Max.
Thanks so much.
Coming up, still to come, former Senators Heidi Heitkamp and Judd Gregg are going to join us, talk about last week's presidential debate and where things go from here. You don't want to go anywhere. We're coming right back.
50% off.
Americans feel that they're going to have to earn $186,000 a year, same as the speed of light, right? To feel financially comfortable and secure. A new Bankrate survey finds that that's more than twice what the average full-time worker made in 2022. Now, to feel financially free and rich, the numbers rises to $520,000, up 8% from last year. Roughly 75% of the people say they're not completely secure based on their current financial situation.
Some positive news from the box office, which is pretty rare these days. Disney's Inside Out 2 has crossed the $1 billion mark at the worldwide box office in less than 3 weeks of its release, reaching that level in the fastest time of any animated film in history. The film is the highest grossing movie of the year and the only one to cross $1 billion so far in 2024. You saw that.
Mm-hmm. Loved it.
Andrew's a buyer.
I'm a buyer. I think actually better than the first one, by the way.
Oh, wait, gotta talk about this next one.
Sing
Paramount's
Sing.
A Quiet Place.
Sing Sing.
Day
Coleman
one,
Domingo.
took
Sing
in
Sing.
$53 million at the box office. That's the prequel to the Quiet Place franchise. It was only expected to bring in $40 million over the weekend, and I have to say, I can't wait to see that one too.
It's not wide release yet, but
Sing Sing.
Sing Sing. Big, not 10 out of 10 on, it's unbelievable. It's half real, half not. It's about Sing Sing, but it's about it's about humanity, Andrew, something I think you'd like.
I love it.
And the human condition. And I don't ever cry.
You cried?
Yes.
I cry all the time,
Several
as you know.
times. Yeah.
Usually during the show.
You do. Coming up, if I'm doing my job. Coming up, what investors should take away from last week's debate performances. Judd Gregg and Heidi Heitkamp join us to discuss that and more. And then later, former White House Council of Economic Advisors Chair Kevin Hassett is going to join us to talk inflation, the economy, rates, and much more. We'll be right back.
Welcome back to Squawk Box. I want to talk about the fallout from last week's debate. President Biden's campaign spending the weekend in damage control mode. NBC News reporting that the Biden campaign holding tense negotiations and conversations with Democratic officials and donors yesterday, pushing back against suggestions that the president might step down from the race, stressing the president has no plans to do so. Joining us now with more reaction to last week's presidential debate, former Democratic U.S. Senator Heidi Heitkamp. She's now director of University of Chicago's Institute of Politics and a CNBC contributor, and former Republican senator and former New Hampshire governor, Judd Gregg. Good morning to both of you. Heidi Heitkamp, it was nice to see you in Aspen last week, but I want to ask you what you thought of the debate and, more importantly, what you think happens next.
Well, by any objective measure, this was a bad debate on both sides, but I think Biden basically had one job, and that was to come out and answer the concerns that people had about age, about his ability to serve 4 more years. I don't think he met that mark, and I think there isn't anyone who should suggest that he did. However, the decision on what happens going forward belongs to one person, and that's Joe Biden. And so we'll see what happens. And what's sad about all this debate is it has eclipsed the debate performance of Donald Trump. Donald Trump was calm, which I didn't expect, but he also was not very clear in terms of what he believed and where he was headed. Right. And I think what the American public saw, Andrew, was 2 candidates that they had an opinion about beforehand, saying, I don't like either one of them. Right. None of this
that might be
like
true, but
better.
Before I get to Judd, clearly I think anybody who was watching that performance, it was almost sad to see somebody at that age not be able to perform the way you would imagine. And then some of the reporting over the weekend, we just talked to the author of one of the stories, suggesting that lots of people inside the White House have known, in fact, how bad it has been, and that perhaps we've all been gaslit over the past several years as people have asked questions about age. Do you sense a shift in terms of how donors are going to behave and what kind of pressure points there will or won't be on the president to potentially step away and find a new nominee?
Well, I think Biden has one thing going for him, and his name's Donald Trump. And so as people will look at him and objectively judge him, I think that the bigger concern from donors and from a lot of Democrats is we don't want Donald Trump back in the White House. And so if Biden decides to stay in this, there will be a huge rallying around Biden, and we'll go forward. But I think it's really up to Joe Biden to take a look at that debate performance and say, can I make it 4 more years, and can I win this election objectively?
Hey, Judd, 2 questions for you. One is you've known Joe Biden for a very long time. What did you think? And 2, you were never, I don't think, somebody who was particularly in love with former President Trump. If, in fact, a new nominee were to emerge on the Democratic Party side, could you imagine yourself voting for them?
Well, on your first question, I did serve with him for 18 years. I liked him. He's a decent individual, but he's not the Joe Biden I served with. He projects himself down. He is, unfortunately, feeble, both physically and mentally, it appears. And he's going to get feebler. I mean, he's going to be 83, 84, 85, and 86 in his next, if he were reelected. And you can't have a president like that. I think the Democrats have 3 choices. One, Biden, because of his hubris, stays in. Then they lose the White House, they lose the House, they lose the Senate. And Donald Trump wins, and that must really scare them. Their second choice is he steps aside and he picks somebody substantive, and they maybe keep the presidency and win the House and maybe even keep the Senate. Or a third path, which I don't think many people have talked about, is he replaces his vice president. And Franklin Roosevelt did this a lot. And we got Harry Truman as a result of it, one of the best presidents of the 20th century. And he brings in somebody who's substantive as vice president, so people are a little more comfortable with voting for him because they presume he's not going to serve out his term. But none of those choices are really very good for the Democratic Party. They've got serious problems. And the fact that this more senior members of that party haven't stepped up and said, hey, maybe they're doing it in private, but they need to do it. They have to go to him and say, listen, Mr. President, you're going to elect Donald Trump, and that's not good for us. You're going to lose this stuff.
What do you think, both of you, what do you think the risk is to the Democratic Party if, in fact, they were to try to nominate somebody else, and whether that would, quote unquote, divide the party, right? That, to the extent that there's an anxiety inside the White House, or at least the one that they project about why they believe that President Biden is the right person, the view, I think, is that once you start to open up the possibility that there could be others, that it divides everything. And given that President Biden was the one who beat former President Trump last time, that they think that is the somehow safer choice.
I don't
Either you
think
speak
that's
to
true at all. I don't think that's true at all. I think if they chose somebody substantive like Gretchen Whitmer or somebody like that, the party would immediately unite around the person, and the person would be very viable. I mean, a younger, vibrant candidate on the Democratic side, Donald Trump's in trouble. But with Joe Biden, Donald Trump is not in trouble. He's going to win. He's going to win big.
Heidi?
I couldn't agree more. I think that this idea that somehow this would be totally disruptive and would throw the party into turmoil, I think it would bring a level of excitement and enthusiasm, not just from Democrats, but from independents. I think it would suck the oxygen out of the room, and Donald Trump couldn't help being even more outrageous than what he is, because he's an attention hound, and all the attention's going to go to the Democratic side. I'm not worried about a brokered convention at all. I think that when you look going forward, we've got great talent, and that talent will step up and run for presidency if Joe Biden decides that his time to be president of the United States has ended. But remember this, only one person will decide this, and that's Joe Biden.
Heidi, have you not gotten a phone call yet from the White House saying you got to circle the wagons here?
No one's called me, Andrew. I mean, I think this is really a personal decision, and that's why he's with his family right now. He's reading the tea leaves, and you look at the polling. A lot of people that I've talked to in North Dakota, and I've talked to independent, mainly what you would consider suburban women, and said, "Did you watch it?" And they said, "I tried. I couldn't watch any of it. I don't like either one of them." And I think that's the demographic they both need, and they both fail to address the concerns and the enthusiasm of that demographic.
Well, I think Heidi's right that it obviously is only one person's decision, but what we're seeing here is an unbelievable level of personal hubris. I mean, he must know he's not capable of being president. It's very obvious. But he wants to be president, and therefore he's demanding that people toe the line and support him. You can attack Donald Trump for being one of the most narcissistic people in America, but unfortunately, Joe Biden's proving to be one with super hubris, and it's damaging to our country. It's damaging to the world. We really can't afford to have this type of leadership, and we're in dangerous times. We're in dangerous times internationally. We're in dangerous times in the United States. There are massive deficits in debt.
Hey, Judd, would you answer leadership? We got to run, but answer the question, if I could, that I threw out at the beginning, which is, given your feelings about the former president, if in fact there was a Whitmer in place, would that change your vote?
Probably not, because I think the Democratic Party has become so encaptured by its socialist base that I wouldn't trust them to have the control of government. I think the only hope for America over the next 4 years is probably to have a divided government, so not much happens.
We gotta leave it there, but it's a longer one. Heidi and Judd, thank you.
Thank you.
Take care, Andrew.
Check out the shares of Chewy. The stock's jumping after Keith Gill, Roaring Kitty. That's funny. Chewy, the pet food thing. Disclosed a 6.6% stake in the pet products retailer. Finally, now this I understand. This I can, I finally understand it. It might have something to do with actual positive fundamentals, since I cannot believe what I spend on this stuff.
Pet food or pet toys?
We get this kibble is, I think, $60 for a big bag, and then we supercharge it with this weird freeze-dried chicken. A bag of that costs $80. It's just, and it seems like I'm there every 2 weeks, and I'm, it's like expensive. It's like expensive.
It is.
And you know how heavy those bags are.
No.
What goes in comes out.
Oh.
So I have to, that's another thing. I got to do that today, as a matter of fact.
Pooper scooper for you.
Duty calls.
So to speak. All right, when we come back, Semaphore co-founder Ben Smith will join us, and then Congressman Byron Donalds will join us as well. Squawk Box will be right back.
lady. Welcome back to Squawk Box. The first 2024 presidential debate had extensive media coverage, but drew only 51.3 million viewers. That's the smallest since the 2004, I should say, Kerry Bush debate, according to Nielsen. Joining us right now is Ben Smith, Semaphore co-founder and editor-in-chief. Good morning to you. Seems to be a collective freak out in the media about everything that's happened since Thursday. I'm curious what your reaction was to the New York Times coming out with an editorial within 24 hours. Tom Friedman and Nick Kristof and others coming out with their own views within hours, frankly. And then David Remnick over the weekend, too, from the New Yorker. I mean, these are sort of the establishment taking a quick position at the same time that the donor class, and it's unclear really where the donor class sits, but have seemingly circled the wagons, at least over the past couple of days.
Yeah, I mean, I think, the media at some point is reckoning with this kind of unbelievable failure to do our own jobs. The President of the United States, probably the most important subject for media coverage in America, and so the fact that everyone was surprised, that we were all surprised by what he was like, really represents this huge reporting failure. And I think, outlets, the Times and others, did stories about his age in the context of other stories saying his age was fine. But just to have the President of the United States walk out on stage and seem totally unlike the guy he was reading about.
Reporting failure is the mask is off. The mainstream media is in the tank for the Democrats. Ben,
I think it's a reporting failure, but I understand that point.
And they're forced to admit it. Finally forced to admit it. They're a Praetorian guard for Joe Biden.
I think they were. I mean, I do think the White House genuinely kept him sheltered.
How did I know? I'm a mean person that I've been saying that don't believe your eyes for 6 months. Didn't you know?
I mean, I
honestly watching him.
I would know. I mean, I think I was surprised. I didn't think it was that bad.
Ben, let me ask you this though, and this goes, I think, to a little bit of information, misinformation, truth, and everything else that who people believe. So I very distinctly remember talking to Kevin McCarthy back actually in November at the DealBook conference, where he explicitly came out publicly and said, I was in a meeting with Biden. He gave the whole thing and said he is not with the program. He's lost it. He said it.
Yep.
It was just said. And then I interviewed the vice president 2 hours later, and I played that effectively back to her, and she said, that's not the Joe Biden that I know, da-da-da-da-da-da-da. My question to you is, how much of this, not as a reporting failure, I'm sort of a little bit with Joe, in that I think people wanted to see what they wanted to see, and they weren't willing to push when they were, and for some reason, age is a very complicated topic for a lot of people, and so when you push on something and they push back and say, oh, come on, you're being an ageist, or you're not really, that people didn't want to fully go there.
Yeah, I think that's right, and I think probably Joe, maybe a softer version of what Joe was saying, was that there's a freak out in the media about Donald Trump that made people scared to write what they weren't absolutely sure of, but what they suspected about Biden. But I think there were gasps in the press room when he walked on stage, which I think means people were actually surprised.
He hasn't done a press conference in so long. I mean, he hasn't done one at all this year. He didn't do one at the end of last year. He won't come out without a teleprompter, and when he does, this is the performance that you get. I mean, I think there are going to be questions about whether he can finish this term, let alone run for a new one.
I think that's right. And I mean, the narrative over the last month has been, you see these clips of him on social media looking old, but they're out of context, they're edited, Trump is old too, and the debate really
So to the extent that there's
a
journalist, that the journalistic community feels gaslit, and the question is, do you think that results in much harsher and much more critical coverage? I remember, by the way, this is a completely different kind of thing, but in the business context, when Enron went bankrupt 25 years ago, every business journalist in America felt gaslit by that company and felt like, oh my goodness, we can't write nice stories about anybody anymore because maybe we're going to be wrong. And the question is whether you think that kind of sentiment now comes to Biden or not. And by the way, I'm not sure it is, because I'm reading some of the coverage this morning, even just of what took place over the weekend, and there's a kumbaya kind of thing happening.
Yeah, I guess I do think the kind of herd mentality in the media goes both ways, and they'll be in that this is the only story right now, that they'll be all over him, that that the White House, though is used to ignoring the New York Times, happy to shut them out, happy to ignore their endorsements. But no, I think that this is going to be a huge subject of coverage. I mean, honestly, I think any politician over 70 right now is suddenly going to be on the receiving end of a wave of scrutiny.
Yeah, Andrew, you knew, and to your credit, you never tried to say otherwise to me. You'd always followed up with, "Yeah, I know, but Trump."
Right. Yeah, no, that.
For like,
I mean, that's basically the
6
campaign
months,
slogan.
Yeah, yeah, I
Put that
know.
on a-
You're
put
right.
that on a t-shirt.
But Trump, right?
That's where we are.
So then you know a lot of people knew and just were.
I think
denial.
there was a denial and a sense that maybe they were. I mean, I think people question themselves, say, well, you know, you don't get to see him a lot, so maybe behind closed doors he really is with it. I don't, you don't know. And is this just a bad day or something else?
But there's no way to unprove that now without having him out all the time,
Exactly.
speaking and taking tough questions, and
No.
I don't see them doing that.
Now.
In the days following the debate, several House members have called for President Biden to be replaced as the nominee. Some House Republicans have even brought up the 25th Amendment. Joining us now with where he stands, Congressman Byron Donalds. His name has been floated as a potential VP pick for Donald Trump. And Congressman, good to see you again. I think we saw a couple of weeks ago. Thanks for joining us.
Of course, good to be with you.
We just had former Senator Governor Judd Gregg on, and this is what he said, and I'll let you respond to it, and you tell me whether you agree. He said if Biden stays in, the Democrats lose the White House and most likely the House and the Senate. He said if he does agree to exit and a younger candidate is put in, he mentioned Governor Gretchen Whitmer, that at that point the Democrats could keep the White House and probably have the Senate and the House. So do you agree with that, and why would any Republican be supporting the Democrats removing Joe Biden?
Well, first of all, I'll tell you, as far as I'm concerned, it doesn't matter whether it's Joe Biden, Gretchen Whitmer, Gavin Newsom, Kamala Harris, or anybody else, because at the end of the day, their agenda remains the same. Gretchen and Gavin might be able to explain it better, but the agenda is still terrible for the American people. You'll still have massive open borders. You'll still have massive overspending at the federal level. There'll be no serious decisions to try to curb inflation or to make America energy dominant across the globe. In a lot of respects, you'll still have the same feckless foreign policy that got us into the position we're in right now, whether it's Ukraine or whether it's our ally Israel. So they might have somebody who looks better on camera, but the agenda doesn't change. And that's the fundamental problem. I think that no matter who they put up, it won't matter because Donald Trump has been president. He did a job where the country was secured, where the economy was doing very, very well, and where there was no new wars across the globe. And so they could pick who they want to. At the end of the day, this is going to be a Joe Biden decision. But I think what the biggest thing overall is that the Democrat Party as a whole and the media covered this up. The stories are rampant through Washington, D.C. that Joe Biden's not with us. How come it never got out? That's because they were covering for him, because they are covering for the agenda that they all want to happen throughout America, which has failed the American people.
Congressman, do you think, if you don't think anyone else could win, do you think that there'd be a difference between if it was Gretchen Whitmer or, and I don't know, the whole Vice President Harris situation, I'm not sure how they deal with that. I don't really have much pity for the position they're in, obviously, but because they're painting themselves into a corner. But do you think it would be closer? I know you have to say you think Donald Trump's going to win, but there's a lot of people that aren't necessarily voting for Joe Biden or Gretchen Whitmer. They're just voting against Donald Trump. You think it'd be, some people think a younger Democrat could win because it's anybody but Trump. You don't see anything to that notion.
Well, I think that if you look at recent polling that came out around that question, it doesn't really matter who the Democrats pick, they all lose. When you go down that ladder, Gretchen Whitmer, et cetera, the margin is even wider. And so that's what I'm saying. At the end of the day, I don't really think it's going to matter one way or the other. The biggest concern is that Joe Biden is president now. It is crystal clear. Everybody is concerned, can he do that job for 4 more years? That answer is no. People are concerned, can he do that job for 4 more months? That's the bigger question right now, and this is because the Democrats have decided that they chose party power over doing what is right for the country. It is clear that is the case. So, I mean, look, like I said, they might be able to explain it better, but it doesn't matter. The agenda items will remain the same.
You think the ticket will be Joe Biden and Kamala Harris when it's all said and done, Congressman, or you don't think that's a possibility?
I'm not going to predict that. I'm not going to predict it. That's in the hands of Joe Biden and Kamala Harris. They got to make that decision. I will say that if Joe Biden decides to step away and the Democrats try to step over Kamala Harris, they're going to have a bigger problem on their hands. But I'll let them deal with that. I'm just going to watch it, and we're going to go campaign and make sure that Donald Trump's the 47th president of the United States.
I think it does highlight that sometimes you think of the vice president as sort of not necessarily that important, but it highlights how important it is. And Donald Trump, I don't know when you expect that decision, and you never really have any comments on who you think it should be, but it should be someone that can step into that role immediately. And I'm not sure they were really thinking of that, the Democrats.
Well, look, I think that when you're talking about the vice presidency, or any other position, it's really about judgment. Can you look at information and make quality decisions? Are you going to make political decisions? Or are you going to make ideological decisions? Or are you going to make the right decisions? And I think that everybody on President Trump's list, we all have one thing in common. We look at the information and we make an appropriate decision for the American people. So I think whoever he picks is going to work as a partner with him to put the country back on track. That's what really needs to be decided. President Trump's going to make that decision. He's going to make a great one.
Okay, Congressman Donalds, thank you. Appreciate it.
Thank you.
Okay.
It is just after 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Let's take a look at today's top stories. First up, Boeing is buying back former subsidiary Spirit AeroSystems for $4.7 billion in stock. Airbus will take on Spirit's European-focused activities. Analysts say Spirit has struggled as an independent company since Boeing spun it off back in 2005. Speaking of Boeing, reports say that the Department of Justice will criminally charge the company with fraud over 2 fatal 737 MAX crashes in 2018 and 2019. Those reports say that Boeing will have to choose between either pleading guilty or facing a trial. And the Financial Times says that the European Union will charge Facebook parent Meta with violating a new set of digital rules. This is similar to regulators' case against Apple from about a week ago, with Europeans continuing to come after American tech companies. Sources tell the FT that the European Commission will flag Meta's practice of allowing people to use Facebook and Instagram for free while having their data collected, or alternatively, allowing them to pay to remain private.
Meantime, let's check the futures right now ahead of the opening bell of the third quarter. Looking at the Dow up about 68 points, the NASDAQ up about 38 points, the S&P 500 up a little over 11 points. We're going to get straight over to Contessa Brewer with a look at this morning's pre-market movers. Contessa, good morning.
Andrew, good morning to you. Let's kick things off with a check on shares of Chewy, which right now are up more than 15% in the pre-market, with an SEC filing revealing that Keith Gill, a.k.a. Roaring Kitty, bought 9 million shares in the company. That amounts to about a 6.6% stake, and it makes Gill the third biggest holder of the pet food e-commerce retailer. Shares are up about 40% this year due to better than expected earnings and automatic delivery sales. Meanwhile, Keith Gill's darling, GameStop, the shares are off by almost 6.5% in the pre-market. Perhaps those GameStop investors don't really like the fact that he's picked a new darling. Nike shares this morning, after Friday was its worst stock performance on record. Look at them this morning. They're up about 0.5% in the pre-market. Remember, they had dismal guidance for 2025, half a dozen bank downgrades, several analysts raising questions about management's ability to execute. It was bad news for CEO John Donahoe. Let's see if the shares turn around starting up this Monday morning. Becky.
Contessa, thank you. Let's turn our focus back to what we've been talking about this morning. President Biden's campaign highlighting an influx of small donor donations late last week, including after the president's widely criticized debate performance. But that performance is still worrying many in the party establishment. Joining us right now to talk about what may be happening is Roger Altman. He is Evercore Senior Chairman and Founder. He's also a former Deputy Treasury Secretary under President Bill Clinton. And Roger, thank you for being here this morning.
Good morning, Becky.
There's a lot of stories that are out there kind of swirling about what happens. But as somebody who has been through campaigns time and time again and who sees what's happening here with the donor class as well, how would you suggest the party move forward from this point?
Well, this is a tough situation. And in many respects, I think it's historically unprecedented. At the moment, I don't see any indication, and I'm not, Becky, in the councils of war, but I don't see any indication that President Biden is prepared to step aside. And I think there's an argument for his taking this a bit slow. By that I mean taking his time, and trying, perhaps through a news conference, to restore confidence and demonstrate, if he can, that the Biden we saw on Thursday night is not the day in, day out Joe Biden. I don't have any idea if he will do that or not, but I think that's something that would be logical to try to do, and do so this week.
Yeah, I'm with you in that we have not seen this in the past. People can say that there have been bad debates before, that Ronald Reagan faltered in his first debate with Mondale. I went back and watched that over the weekend. That was October 7th of 1984. It was nothing like what we saw here. These are questions raised, not even about age, but about mental competence. And the idea that we have not seen a press conference from Biden this entire year, and even well into last year, we hadn't seen one. Just the idea of, even if he were to come out with a news conference, as you suggest, I don't know that that would assuage the concerns that there are about whether he can do this job on a daily basis.
Hard to tell, but if he did hold a press conference, and if he did conduct himself well, and I've seen him conduct himself well in recent weeks in private, I think that would allay a lot of concerns. Whether it would allay them all, I don't know. But it would be a wise thing to try, if in my view.
Roger, we've even seen it in print that it says the Biden oligarchy is meeting to decide what to do. Is there an oligarchy? Are there 5 or 6 people that are running things? Has it been that way all along? And is he basically just a figurehead? And is that okay to run the country like that? I mean, it's brutally frank, but is that possible?
Well, I find that term, Joe, oligarchy, amusing. Anyone who has spent time with Joe Biden knows that he's not a figurehead. He's actually quite a decisive guy, in my experience. I think what you're referring to is the close-knit team of advisors, and we all know who they are: Ron Klain, Steve Ricchetti, Anita Dunn, and so forth, who have been around President Biden for a very long time and on whom he relies. But as to whether they're running the government and he isn't, the answer is no. All this legislation that passed, the Inflation Reduction Act, the infrastructure bill, and so forth, his hand in all of that was the decisive one, not theirs. So, no. He's president, they're not.
Right. Roger, you said that you've been with him and seen him in a different light, and we've heard people say that over time, especially when others, and I'm talking about Kevin McCarthy and others, who came out and said that he isn't with the program. The question, I guess, is what do you see that others don't? But also, is it acceptable if there are bad days? Is that something that you think the American public should accept, recognizing that there are going to be super crises on super important days, and if you have a bad day on a super crisis where you actually have to be able to perform and you can't, that's a problem?
Well, Andrew, let me be clear on one thing. All I meant to say was the most recent time I saw President Biden, which was in a meeting with business leaders about 5 or 6 weeks ago, he was on his game. That's all I'm trying to say, that one 90-minute discussion. As to your second question, look, there's a difference between having a bad day and cognitive decline. And President Biden, as I suggested at the beginning here, needs to go out and demonstrate that it was the former and it is not the latter. And I think that's the acid test.
Roger, very quickly, you think that the only resolution, if the president were to decide not to run again, would be taken care of at the convention?
Well, I think people are underestimating, Becky, and I just listened to the conversation with former Senators Gregg and Heitkamp, and also what Congressman Donalds had to say. I think people are underestimating the difficulty of the post-withdrawal process if President Biden were to withdraw. What would happen, I think, would be a free-for-all with a number of contenders, for perfectly good reasons, jumping in. All the primaries are over. Therefore, that could only be resolved at the convention, which is about 2 months, a little more than that, before the general election. So someone would prevail at the convention, and I think it would be hotly contested. And that person would have, give or take, 2 months to mount an effective national campaign. That person would never have run a national race before, unless it were Kamala Harris in terms of her serving as Biden's running mate in 2020. And that's a tall order. I think you have to be a real optimist to think that would really work out well. It could, of course it could, but it's hard because there'd be so little time for that individual who prevailed at the convention to then turn around, become a well-regarded household name, mount the huge organizational effort necessary to effectively run a national campaign, and of course to have the financing. That's tough.
Mm-hmm. Roger Altman. Thank you, Roger. We appreciate your candid assessment. Good to see you.
Pleasure, Becky. Same here.
Coming up, former SEC Chair Jay Clayton is going to help us make some sense of the critical end-of-term Supreme Court decisions. That could be kind of the elephant in the room at 10 a.m. Who knows? I mean, we had this news cycle. We could get off this news cycle very quickly, depending on what happens, including a big one impacting his foreign agency, among others. Stay tuned. You're watching Squawk Box on CNBC.
Welcome back to Squawk Box. Joining us right now on the set, former chairman of the SEC, Jay Clayton, is also a CNBC contributor. Good morning to you. Want to talk about some of the Supreme Court rulings we heard about last week and some we may hear about this week, but also wanted to start with this debate and really what you think the implications of it are. We've gone back and forth about, whether another nominee is going to emerge.
Mm-hmm.
But my question to you, as somebody who was part of the former Trump administration and sort of thinking about sort of what this means for the Republican side, is if in fact another nominee were to emerge, is that better or worse for Trump's candidacy here?
Okay, well, let me say, I think another nominee is going to emerge.
You do.
And let me put it in a context that I think people in this program understand. It's imperfect but illuminating. Imagine if a CEO gave that performance in an earnings call. The board of directors would
they'd pull them off.
But pull them off. And let's go to the next level of analysis. You're a board of directors. You have a problem like that. Years in advance, at least months in advance, you have to have a succession plan. You always have to have a succession plan. And what do we have here? We have
Nothing.
We have nothing.
No plan B.
No plan B.
But that's what Ron Klain's been saying for the past 2 years. There is no plan B. You can't consider, because they wouldn't.
But that's not an acceptance.
They wouldn't allow that.
Imagine if a board of directors said, you know what,
I
we
don't
have,
disagree
we
with you.
have,
I
we
think
have no plan B.
Well, except you could argue that the plan B is that there are, I don't know, half a dozen potential nominees, governors and others in the Democratic Party that maybe could take the place. The question that I'm asking is slightly different, which is what you think that would do to the overall election, and to the extent that there were people out there, voters, who said to themselves, you know what, and I put Bill Ackman potentially in this category, but maybe not. You know, for a long time he was saying he was very critical of Biden with the hope that a third candidate or another candidate in the Democratic Party would emerge, because he was not necessarily in love with the former president. He is now, appears to have switched allegiances, and now would say that he is for the former president. The question is, if another person came in to replace Biden in this sort of A/B test that Peter Thiel talks about, where with all of a sudden, if the A is a different human, do they say, okay, actually, I'm now, the whole thing is scrambled?
Okay, so of course you will be changing the context. You change the person, you change the context. Absolutely. I think the question for the American people, and look, I think, here's what I think. Why do I think he's going to change out? Because the American people are smart. And the market is the American people. And just like in the CEO situation, the market is going to tell them that they have to change.
Yeah, you just heard how difficult that is, that you will then have a person who's never run a national election, who's got 2 months to try and run it. You figure this is just a Hail Mary sort of pass. They figure they can't win otherwise, and so they give it a...
I have no idea what's going on, but you usually give somebody who's in a position of authority to come to the conclusion on their own. My hope is that what's happening is we're giving Joe Biden, who deserves a lot for his public service.
Does Trump win the battle but lose the war then? Is that what you're saying? Because that's the interesting part, right? He could have won the debate, but if you're telling me that then the whole dynamic changes, then you lost the war.
Let me go back to, again, the context I know, which is the corporate context. You've built a strategy around one set of facts. We are going to scramble the eggs, right? And the Trump campaign will have to build a new strategy depending on how this unfolds and who falls into that position. And what you're seeing, I think, is a strategy around border, economy, inflation.
Okay, so
right? And if I'm, we were just talking off air, very interesting thing, which is if you look at the lineup of prospective vice presidents, I think every single person could be president tomorrow on the Republican side. I think that's an incredible strength that the Republicans have going into this period of uncertainty. You know, whether it's Burgum, Youngkin, Scott, Rubio, every one of them, I think the American people would be comfortable with as president.
Councilor Clayton, I want you to put your lawyer hat on for a second here, because we may hear from the Supreme Court about this immunity decision on...
We will hear.
We'll hear about President Trump. How do you think that plays in the American public on either side of how you think that they land?
Okay, the Supreme Court's performance over the past month has been something we should all be proud of.
I agree.
The Supreme Court has restored what the founders envisioned, which was 3 branches of government that were in tension, but that were be accountable.
You saw Amy Coney Barrett taking the opposite side of Katan's.
I've seen certain decisions.
That's not what you would have.
They have done an absolutely. The administrative state had gone way beyond any kind of thought of its power, and they've reined it. This is also a very interesting issue for this period. Of course, presidents have some level of immunity. You have to, right? And of course, there are limits on that. This is the first time they're going to really reach out and try to define that in the context of specific facts and circumstances. What I would say to the American people on this is, look at how well-reasoned this is going to be. I have no idea what they're going to do, but I know that the way they've been, you have Barrett on one side, you have 9 people who are going to bring a lot of wisdom to this decision. Because we can't constrain future presidents. Just because some people don't like Donald Trump doesn't mean you can constrain future presidents.
As somebody who's in the business, how do you feel? And I think there are Americans, maybe you say they're on the Democratic side, who look at a Clarence Thomas or they look at an Alito and they say, there's a problem. There's corruption in the system if, Clarence Thomas is effectively taking money from people and not disclosing it. He ultimately disclosed it, but years later, only after pressure from the press, talked about the fourth estate having some value, hopefully, in the world. This Alito situation with his wife and the flags upside down and everything else. I'm just curious because I know you just said, look at these decisions and how proper they were. And then there are people who look and say, these people may be making decisions that you think are proper in this particular moment, but there's other things going on that's completely improper. You agree that they're improper, right?
Well, any time that you have a quid pro quo, okay,
right,
which we talk about all the time.
Right. So in the business context, these people will be fired. I mean, let's just be honest. In the Clarence Thomas case, if you had an employee taking money on the side without disclosing it, you would fire that employee.
Well,
you don't think?
Andrew, it depends on the context. We have an employee.
As a journalist,
okay,
if I was taking money from people I was covering, I would be fired, and rightly so.
If you have a best friend from high school or college,
and then I wouldn't cover them.
Okay.
And then I wouldn't cover them.
Let's go to this. Is there any indication that any of the justices go across the board has deviated from their articulated judicial philosophy in any of these cases? If somebody brings that to me and says, you know what,
that's the same excuse they use for Biden and all the money flowing from Ukraine and China. That his brother and his son and everybody got rich, but it never caused Joe Biden to do something different than he would have normally done. That's the same excuse here. You don't have much of a problem with all that influence peddling in the White House, right?
I have a problem with influence peddling and of all
You've never brought that up.
Let me affirmatively agree with you on something. Transparency is absolutely important. Those rules in the Supreme Court needed to change. The rules in Congress need to change. Right. I've been on this program advocating time and again for rules around trading. Let's let Congress people trade one time a year, absent hardships. That would eliminate all this. They could still be fully invested. Right. They could participate in the prosperity of America. But you know what?
How are you going to effectuate that? Remember, I think we talked about that when you were in that position. We talked to Gary Gensler about that. And nobody in the SEC wants to do it because Congress is the hand that feeds the budget of the SEC. So then you're going to have to you're going to have to wait for Congress to do it to themselves. They're never going to do it.
But I'm not going to change my position. My view is that Congress should pass, just like the Supreme Court passed its own rule on transparency. Congress should say, you know what? You have a window from January 1st, or for tax reasons, make it from December 15th to January 15th. You can readjust your portfolio. You can sell. You can do whatever you want. Absent that, apply for a hardship exemption. Get out of the business of trading.
Jay Clayton, we will see what happens a little bit later. This is going to be a big week. Last week was a big week. We didn't really get into some of those decisions as well. Thank you.
Thank you.
Coming up, a call to prevent China from going the same economic playbook that it's used in the past when it's been in trouble. We'll be joined by the ranking member of the House China Select Committee. And then the key points that former Council of Economic Advisors, Chairman Kevin Hassett, heard in last week's presidential debate. You don't want to miss that. Stay tuned. You're watching Squawk Box on CNBC. We were watching the Euro and French stocks today following a strong showing by that country's far-right faction in first-round elections yesterday. Analysts say left-wing and centrist parties are now scrambling to try to block the rival French national rally from winning the ongoing parliamentary contest. French stocks are thought to have rallied on relief that the right wing's current showing wasn't even stronger. The second round of voting takes place next weekend. So I was thinking when we're over there for the Olympics, I was going to try and vote over there. And then we can do it here.
Too late.
You need an ID over there?
I'm sure.
You know what? I might not speak enough French to. I couldn't even ask where's the voting booth. I don't think.
Excuse me, where's the Louvre?
There was one time where I did say that. I was like,
Just to annoy them?
no, I had to go to the bathroom so bad. I'm like, yeah.
Where's the
I'm
loo?
like, bathroom, lab, every word, and the guy's like, what? And finally, I think toilet. Finally, but it was too late.
All right, when we come back, China, the economy, and fundraising for President Biden in the aftermath of last week's debate. We will talk about all three with Illinois Democratic Congressman Raja Krishnamoorthi. Stay tuned. You're watching Squawk Box, and this is CNBC.
Made affordable.
In a Newsweek op-ed, our next guest is warning America that an economically struggling China is trying to revert to a dangerous gambit of the past. That would be exporting overproduced goods at artificially low prices. Illinois Democratic Congressman Raja Krishnamoorthi writes, "We are at a pivotal moment in which China depends on the rest of the world capitulating to its predatory practices to avoid making long overdue reforms." The congressman joins us right now. He is the ranking member on the House Select Committee on the Chinese Communist Party. And, sir, let's talk a little bit about what you laid out in your op-ed. We've seen this before from China, but you say that this is unprecedented in both the scale and the scope of what they are undertaking this time around. You want to explain?
Sure, and thank you so much for attention to this. Essentially, the Chinese economy is tanking right now, and Xi Jinping, the leader of the Chinese Communist Party, has decided that to reinvigorate the Chinese economy, he's going to double down in an old Chinese playbook for economic reform, so to speak, which is overproducing goods far in excess of what internal demand requires, and then exporting the surplus to other countries at a price designed to undercut the competition and really destroy it. And so he's doing this across a range of goods, including goods in strategic sectors that they have decided that they want to dominate, from everything from semiconductors to shipbuilding to drones and so forth.
I think some of the numbers kind of jump out. I've heard Janet Yellen has talked about this, the Secretary of the Treasury, has talked about how all of the money that was previously being spent on infrastructure on China has been funneled into this, and the numbers kind of back that up. 4 years ago, there was $83 billion that China spent on new lending for industry. That skyrocketed, you say, to $670 billion, and those are numbers that are coming from the Bank of China.
Yeah, these are astronomical numbers. Just take one example, which we highlighted in our hearing the other day, shipbuilding. Essentially, China is building 359 new ships for every one ship that the United States builds. And that points out two problems. One is they are building far more ships than their internal demand requires. But secondly, the U.S. has ceded leadership in global shipbuilding, and that impacts our national security as well. So we have to fix both of those issues.
You look at what we've allowed to happen in areas like semiconductors and even manufacture of medical supplies, and you understand how this can be a problem. We've run into some pretty serious issues recently with this. What's the way to solve this, though? Are you talking about tariffs that you make on all of these products that are coming, not just out of China, but if China transports these things to Mexico, they have an easy way to get in with NAFTA here?
Part of it is tariffs, and that is something that both the Trump and Biden administrations have pursued. But part of it also is working with our partners, friends, and allies to boost our own capacity for manufacturing the items at issue. So just one example are semiconductor chips. The United States used to be a leading power in manufacturing these chips, but we lost our edge in manufacturing them a long time ago. And ever since the pandemic, when we recognized that supply chain shortages were driven in part by these shortages of chips, we have enacted the Chips and Science Act, thanks to President Biden and Congress, on a bipartisan basis. And now we're seeing a renaissance in the announcement of chip factories throughout the country, and so that's going to be a real help going forward.
If you talk to, let's say, the biotech industry, they will say that there's no way to manufacture biotech medicines here in the United States, that's kind of another issue that we've ceded to WuXi. They've suggested doing something like a CHIPS Act for biotech, where you can manufacture those things here, but it seems to me like you run out of money at some point. How do you prioritize what you do, whether that be steel, whether that be shipbuilding, whether that be household appliances, whether that be biotech issues? How do you figure out what we have the money for, what we don't, and how you rank that in order?
Sure. I think in certain areas, certain strategic areas such as chips or biotech, I think that the government should assist to some degree, whether it's in the form of, for instance, those tax credits and other investments in the CHIPS Act, or whether it's in the form of government purchasing. In the case of biotech, I think the government should help. With regard to consumer goods, with regard to certain food products and other items, I don't think the government should necessarily step in. All that being said, I do think that an examination of all of these industries to see where we are competitive and where we are ceding leadership and where the Chinese may become the sole source and then exert, coercive practices to get us to try to do things that we might not otherwise do is really necessary now.
Is this a bipartisan issue in Congress?
Oh, absolutely. I mean, this is something that people on both sides of the aisle agree needs to be tackled right now.
Congressman Krishnamurthy, thank you.
Thank you.
Up next, we're going to focus on the potential economic policies in another Trump administration, or also contrasted to another Biden administration, or whomever. Former Council of Economic Advisors Chairman Kevin Hassett is going to join us. Stay tuned. You're watching Squawk Box on CNBC.
All right, everybody, welcome back to Squawk Box. The futures this morning are slightly higher on this first trading day of the second half of the year. Right now, you're looking at the Dow futures up by about 10 points, S&P futures up by 7, the NASDAQ up by close to 30. It is the first day of the third quarter. For the first half of the year, the S&P clocked a gain of 14.5%. It's on pace for its fifth positive year out of the last 6. It gained about 4% just in the second quarter. The Dow was down by 1.7% in the second quarter, and the NASDAQ was up by more than 8% for that quarter. It's up 18% so far for the year to date.
Well, aside from lobbing a myriad personal attacks at each other, President Biden and former President Trump spent last week's debate laying out what they do for the country economically. If given another term, join us now to talk about the different plans. Hoover Institution distinguished visiting fellow Kevin Hassett. He served as a senior counselor to President Trump in the White House and was chairman of the Council of Economic Advisors. How you doing, Kevin?
Hey, good morning, Joe.
Is it too simplistic to say we got two guys? One's going to blow out the deficit, spending like a drunken sailor on social programs or whatever, investments, and the other is going to blow out the deficit with tax cuts. And either way, we're headed to the same place. Just the age-old Republican versus Democratic strategies.
Well, I think it's inaccurate. I agree that Joe Biden doesn't seem to have much of a plan on reducing spending. And recall, Joe, that spending right now is about $1 trillion a year higher than we thought it would be looking ahead from 2019 before COVID. So what Biden and the Democrats have done is they took the COVID spending and then they decided to use it on other stuff. So what that does for a potential new occupant of the White House is it creates an enormous policy opportunity, because you've got almost $10 trillion over 10 years of spending that you can reduce, and then you can do other stuff with that, like save Social Security and extend the Trump tax cuts. And then finally, on the Biden side, don't forget that he says that he wants to renew the Trump tax cuts for people making less than $400,000 a year. And so in terms of the cost of the tax cuts, before you get to dynamic scoring, Joe Biden wants to renew most of them. And so most of the cost is things like the child credit and stuff for people that go to people in the middle class.
And it's the old FedEx commercial. Donald Trump likes tariffs, but we like tariffs. Because I said it this way. Our tariffs are targeted. They're both, there's tariffs from both. But I think there would be more if you put a tariff on everything from Donald Trump, wouldn't you?
Yeah, I think that that's still a work in progress, but what I expect is very likely to happen if there's a reconciliation bill next year is that it will include something like President Trump's idea of a reciprocal tariff act, where if there's a company out there or a country out there that has big tariffs on us, then we match those tariffs. If they have no tariffs on us, then maybe we don't. But he has talked about an across-the-board tariff, but he's also talked about wanting things to be more reciprocal. And my guess is that once you start moving Congress, that the reciprocal idea is going to be the more popular of the two.
And it's really, we've just seen this movie again and again and again. So to handle the built-up debt that we have, we're going to need growth. I don't see any other way.
Yeah.
Do you think that if Trump were to win back the presidency and would cut a lot of the regulations that we've seen layered on the economy during the Biden years, and do you think that trying to stimulate business with tax cuts or however he wants to do it, do you think that would be the way for growth? Because Democrats think the way that you engender growth is through investment in infrastructure, in chips, and the transition to green energy. They think you got to spend to reap the rewards. Which way works? Does either way work?
Well, it's all about demand and supply, as you know, Joe. And so what you have to do is you have to feed supply as well as demand. And what the Democrats have been doing is they've been spending on stuff, but they've also been attacking supply with higher taxes and higher regulation. I think the top priority for the tax bill next year should be to return the expensing measures to law, which are expiring. And so if you buy a machine, you get to expense it. That's really, really important for driving up supply. In fact, equipment investment last year in the U.S. was negative, in part because of the expiring expensing. And then the second thing is that we've got the small business 199A deduction, which allows small businesses to get some of that benefit from the lower corporate rate. Well, that's expiring too. And so there are a couple of rifle shots, right at destroying supply on the tax code side. And then Joe Biden is launching new economically significant regulations at about double the rate of President Obama, who was the previous record holder. And of course, that would stop in its tracks the minute that President Trump were in the White House. And so there's a lot of reason to be optimistic about supply if we can get some policy changes in there.
Kevin, there's a couple of different narratives about let's just for a second focus on if Trump did win. Some people say 44 out of 50 of his former people that were in his administration would never work for him again and wouldn't vote for him. Other people are surprised and thinking, last week we saw someone say, Bill Ackman said, I'm shocked at the quality people that would be willing to serve in the next Trump administration. Would you serve? Do you think he can put together a top-notch team?
Right. Yeah. Oh, he absolutely can, Joe. And yes, if the president were to ask me, I'd certainly take seriously the opportunity to work with him again. I really enjoyed it before. I'd like to do it again if the right job comes along. But the fact is that if you look at who's around the president now, it's pretty much the same people that were around him in the last year or two. And I think that what happens at all White Houses at the beginning, there's kind of a shaking out, and you find the people that do the job the way a president likes and the people that don't. And the president, fired a lot of people, but ended up with a team that he really enjoyed working with, and all of those people are still lined up and helping him out as much as they can. And then there's also some new people coming aboard, like the Doug Burnhams of the world. And so I think it'd be a very, very strong team should get back into the White House.
What do you think happens with the Fed? And we've seen all the scuttlebutt that he wants it as an arm of the White House, and wants to be. Maybe he wants to be on the Fed himself. Maybe he'll nominate him. He could be president of the United States and president, and Jay Powell at the same time.
I can remember. You remember this, Joe? There was some discussion about firing Jay Powell, and one day out in front of the White House, I came out and said that we had a meeting with the president, and we had discussed it, and there's no way the president's going to fire Jay Powell. The president respects the independence of the Fed. The day I did that, you might recall, the Dow went up 1,000 points. And that night, the president called me up and said, "Hey, Kevin, we got to put you on TV every day."
What do you think?
He absolutely understands the independence of the Fed. And that story in the Wall Street Journal, I talked to the president and know a lot of people that do, and none of us could figure out where that story came from all the way up to the very top. So I don't think that story was true about the president wanting to eliminate the independence of the Fed.
There's no one in the that said that there were. What was it, Andrew? Remember there were an actual a cabal that had formulated that or something of his advisors. It said. You don't
knows who those guys
think
are.
they made it up? Think that was made up, Kevin?
So, well, one of the things that happens is that people want to seem important, and so they say that they're talking to the guy, and maybe they said hi to him on the golf course or something. But no, absolutely not. We were unable to track down the source of that story.
When's the last time you spoke to President Trump?
About a couple weeks ago.
A couple weeks ago. So you figure you'll be doing something.
Excuse me?
You figure you'll be doing something if you were to win re-election?
Oh, I'm not sure. Again, we have to see what happens. But I am, of course, willing to serve my country.
Okay. All right, Kevin. Thank you, Kevin Hassett. Okay.
Bye-bye.
Coming up, the third quarter and beyond, we're going to talk markets ahead of the first opening bell of the second half of the year. Squawk Box returns right after this.
What are you waiting for?
Welcome back to Squawk Box. Just a half an hour till the first opening bell of the third quarter. Joining us right now is Nadia Lavelle, Senior U.S. Equity Strategist at UBS. Good morning to you. So we're into the second half here. What are you expecting and what are you doing?
Yeah, we expect the market to remain in an uptrend in the second half of the year. Of course, not to the magnitude that we saw in the first half of the year, over 14%. What's really needed to be able to drive this market higher is going to be the earnings season. The fact is that valuation, as we know, is really stretched. As we head into the upcoming earnings season, expectations are high versus the first quarter because the forward estimates has remained quite resilient coming into this quarter. But we do think that, with better economic growth, we're seeing that Atlanta Fed GDP now at 2.2%. And the fact that we've had a pretty robust AI investment cycle, that should be enough for companies to be able to meet those higher expectations.
How much of your thesis is premised on a rate cut in this calendar year?
Our expectations is 2 rate cuts. However, that does not mean that the market needs that to move higher. The market has already shown that to be the case in the first half of the year. It's really the earnings that's going to drive it. But our expectations is 2 cuts starting in September. We think that the economy is pointing towards a soft landing when you look at the upward trend in unemployment as well as the initial jobless claims. Of course, core PCE that we got last week was quite encouraging. We're still on that disinflation path, and so we do think that the Fed will have enough data by the time we get to September to be able to start cutting interest rates.
The election, does it have any relevance or bearing on anything you just said?
The election, of course, we're watching it, but we've been advising clients not to make any major shifts in their asset allocation due to the looming election. Of course, we expect volatility to pick up. It typically does every election cycle. We're already seeing a kink in the fixed futures contracts around the November elections. And what we're watching for, of course, is the rhetoric around tariffs. We know that former President Trump has proposed a 10% across the board and 60% on imports coming from China. That has implications for companies as well as inflation. It could help some of the sectors that are more exposed to competition for China, but at the same time, it will be a headwind for those with supply chains abroad. We're also, watching for, corporate taxes. We know that President Biden has proposed an increase in the corporate tax rate to the high 20% range. And so that obviously has implications for corporate earnings. So those are the things that we're keeping an eye on, but we're not making any major shifts to portfolios due to the election.
If you could pick one stock right now, what would you buy?
I can't comment on stock. However, I can comment on sectors. We continue to like tech. We are definitely believers of the AI story. We think that there's a lot more to go in that. We think that by the time you get to 2027, this could be an over $1 trillion revenue opportunity across the stack. So that stack includes the enablers like semis, the intelligence layers, cloud providers,
Right.
as well as the application layer.
Okay. Nadia, I want to thank you. Appreciate it.
Thank you.
Before we go, I just have one. I just realized we have not talked about this front page story in the Wall Street Journal about Davos all morning.
Oh, yes.
I mean, how did we get 3 hours through without even
I
mentioning?
didn't read the whole thing.
It was
It's a
actually
long, long
Is it
story.
just the typical, well, he got rid of anyone over 50, even though he was 100, Klaus.
Well, they said there's this toxic atmosphere. What I couldn't tell about the story was
This is news to you?
there's about it seems like there's a half a dozen examples over the course of 30 years, and so there's part of me that was like, well, maybe that's how life is, and then there's part of me that was
They
like,
talked
maybe
to
this
a
is
lot
much
of people.
worse.
The Journal talked to a lot of people in this.
Right.
They also said that
couldn't-
Klaus Schwab didn't step down from his position until after they had reached out originally to get
You
verification.
really said anyone over 50 is gone?
I don't know. They say they.
According to this.
Right, they report that, and then of course they say
for the kind of drivel
the forum
that-
says the opposite.
The
So,
kind of drivel that they
I don't know.
push at WEF, it doesn't surprise me. You need clueless younger people to be able to say some of that stuff with us.
No.
What?
No.
To say some of that stuff with a straight face, you got to be like 30.
I'll say it with a straight
You got to be
face.
30. I rest my case.
Let's take a very quick look at the markets. It is the first trading day of the second half of the year, of the third quarter. You're going to see right now there are some green arrows across the board. And by the way, both the S&P 500 and the NASDAQ closed at new highs once again on Friday. You can see the NASDAQ indicated up another 37 points this morning. Right now, it's time for Squawk on the Street. We'll see you later.
Monday morning and welcome to Squawk on the Street. I'm David Faber with Leslie Picker and Mike Santoli. We're live from Post 9 at the New York Stock Exchange. Jim and Carl both have the morning off. Let's give you a look at futures as we get ready to start the second half of the year of trading. Man, half of 2024 is already gone, going by very fast. All right, let's get to our roadmap. It does start with, of course, big tech, which was the big driver of stocks for the first half of the year. But one question, can NVIDIA and AI excitement fuel further gains as we get underway for the second half?
Plus, Boeing agreeing to buy its supplier Spirit AeroSystems in a $4.7 billion deal, and meme trader Roaring Kitty adding fuel to another big stock move, Chewy shares surging as Keith Gill reveals a more than 6% stake.
All right, let's start with the markets, of course, as we kick off the second half of the year. I was not here for the last 2 weeks of that first half. I can't say that I'm sorry I wasn't, but of course following, Mike, all the ups and downs, in particular, some of that bit of a sell-off in NVIDIA and the like. But the talk has been and will continue to be much of the same, I would assume, in terms of the power of AI, what that will mean for these biggest of big companies that we follow so closely.
Yeah, I mean, we held it together somehow. So did the market with you gone, David. But honestly, it really is one of the better halves of a year. 15% plus total return for the S&P per unit of volatility, right? The extent of the biggest pullback was 5.5%. So yes, a lot of that was due to the not just technology, but I would call it just the quality mega cap sector of the market. The quality S&P 500 ETF up more than the S&P this year, up 16%. I wouldn't say it's been only that, though. It's not as if tech is kind of throwing a shutout against the rest of the market. The equal-weighted S&P is up 4%. That's kind of no big deal, but it's a 9% annual, compounded rate. So it's not as if it's completely being left behind. The other things I would note, the cyclical parts of the market are still hanging in there against the defensive part. So if the market were narrow and it was these defensive type sectors that only benefit from a poor economy that were leading, that would be a little bit more of an issue. I do think the seasonal effects are on everybody's lips this morning in terms of first 2 weeks of July being the strongest, among the strongest of the year historically, and then also what happens after you have a big up first half. And usually you get upside bias to follow through. I will say that the final 2 weeks of June were supposed to be bad based on history, so that didn't happen. So I don't know how much you defer to the seasonals. You just say, hey, in a strong market, even the times that are supposed to be poor end up being okay. Earnings hurdle, I think, is a big question. How high is the hurdle for earnings? Expected to be close to 10% with the standard beat rate. And you've seen some stocks get punished, like Micron last week when they were kind of slightly less than completely optimistic. And finally, the yield move. I mean, after the first quarter, we finished on a high. Everything was at a record. And then Treasury yields crept up toward 4.5% on the 10-year and then beyond, and we had that old debate of can the economy handle it? And we have seen since, especially the debate on Thursday, yields going up, and also globally yields are pushing a little bit higher. So not alarming, but something that I think might get the market's attention at some point.
Yeah, it does really feel like an inflection point. There was a piece from Goldman's prime brokerage desk this morning which talked about how alpha generation and performance has really stagnated in recent weeks, and it's created this dynamic of kind of what's next for portfolio construction, and this idea of is now the time to really be truly diversifying away from some of the key winners that we've seen earlier this year, and it goes into this whole dynamic of breadth and versus the narrowness that we've seen, and is now kind of the time to really mix things up, or do you risk being left behind because the strong momentum-based winners of the first half, if you weren't in those? There was that journal piece that quoted a portfolio manager who happened to not be in NVIDIA, and he said that every day it is like getting a root canal without Novocaine. And you kind of think about this idea of taking NVIDIA off the table right here.
Although to your point, Mike, if the equal weighted S&P, let's call it, annualizes at almost a 9% gain, coming into the year, most people would take that. Obviously, you're going to lag, though, if you don't own NVIDIA, for example.
It's exactly how you frame it. Is it just, I need to keep pace or beat this index, and therefore I can't? Or is it unnerving to, and it is to a lot of people, that the aggregate dollar amount of value being added is so lopsided toward a handful of companies, right? So it's like a third of the aggregate market gain is just NVIDIA. I mean, that doesn't seem, it doesn't feel right to me.
You should, well, it is something worth pausing on because it is stunning. I don't know if we've ever, I don't know that you have the historical references, but I can't imagine we've ever seen that.
I don't think so. Certainly not this scale. Like there's always been the hot secular growth stock that was up a couple 100% in a year, but it usually isn't one of the biggest. So yeah, I keep saying we are in a market that the defensive, the quality, the faster growth, the most reliable earnings momentum, all that stuff is represented by the same relatively small subset of stocks. And so therefore you have all these multiple reasons to buy them. What's interesting too, Leslie, though, is that because the surface of the market has been so calm, right, very low volatility at the S&P level, it's because of this divergence underneath. And so hedge funds and many other traders are saying, we're just going to bet on that continued dispersion and low volatility. And that's a very popular trade right now. You don't have to get into the weeds of it except to say, index level, calm, under the surface, you have slightly more volatility and kind of divergence among stocks. And there's a way to capitalize on that. And it seems like it's become pretty popular. And it's fine until it gets turned upside down by a market that responds to some kind of stress and everything moves at once.
Well, because another thing, too, is we talk about seasonality. I mean, this is a pretty low liquidity week,
Sure.
Given it's July. But as we move ahead, the presidential election becomes more in focus. A lot of people have said that kind of in those years that can create an additional spurring of volatility. And then earnings expectations, as you mentioned, and David Costin had a note out about this, that it's the highest earnings bar in almost 3 years for 2Q, just kind of given the expectation, single stock analysts predicting profits at S&P 500 firms to rise 9% in the April to through June period.
And the estimates were not revised down over the course of the quarter, as usually happens.
Right.
So that's a positive sign in the sense that people think they have visibility into these, pretty good growth stories, but it does not sort of reset the hurdle lower as often happens by the end of the quarter. So we'll see by the end of the week. While it is a low liquidity week, that can work in both directions. I mean, pre-holiday trading tends to actually have a little bit of an upward drift.
And finally, just in terms of historical references, Mikey, you may have already mentioned this quickly, but first half versus second half and what it does typically imply when we've seen the kind of gains we have?
Something like better than 75% after you've been up big in the first half, let's call it 10 or 15%, you are up in the subsequent 6 months. So that's a little bit better than the historical average of just all years. And the actual returns, median returns, are like the high single digits or close to 10%. This is all depending on how you slice it and what time period you cover. I will say, though, the 3 months, like from here through the end of the third quarter, are a little choppier. In other words, you've kind of made a lot of those gains in the latter half of the year. We all know the cadence, right? It usually is, certainly last year we peaked in late July and then had a proper correction in the fall, then rebounded. So something like that wouldn't be surprising, but that is the cadence that, the almanac says we should expect.
Yeah. Of course, we do have an election, too.
Yeah, exactly. Yeah. And in fact, this is, I believe, the best first half of an election year. Is that, you have to go back really far to find a better one than this.
All right, let's move on to a little M&A this morning. We have Boeing finally getting that deal done to buy its supplier Spirit AeroSystems. It is an all-stock deal. It's valued at about $4.7 billion. There's actually a collar that will preserve that value down to $149, I believe it is, on Boeing's stock price. The commercial jet maker, of course, is grappling with safety issues. Phil LeBeau joins us with the details on the deal. We've been waiting for some time for it, Phil.
Yeah, 4 months. 4 months ago is when Boeing said, we're interested in buying Spirit. And a lot of people thought it would come together quickly. Well, there is a big component of this that involves Airbus. We'll talk about that in a little bit. Here's how the deal is structured. Boeing will be buying roughly 80% of Spirit AeroSystems, including 3 plants in the U.S. We'll talk about the most important one in just a little bit. Airbus gets most of the remaining 20%, including Spirit AeroSystem plants in the U.S. and in Ireland. The most important plant, the one that gets the most attention when it comes to Spirit AeroSystems, is in Wichita, Kansas. That's where they build the 737 MAX fuselage. Boeing wanted to buy that plant and buy all of Spirit so that it has better quality controls, because so many of the problems that have hurt Boeing over the last couple of years, many of them originated at the facilities in Wichita, as well as the other Spirit facilities. Boeing now believes that it can improve quality control. As you take a look at shares of Boeing and Spirit year to date, or actually over the last year, keep in mind that Boeing is also assuming $3.5 billion of Spirit AeroSystems debt, and the deal is expected to close in the middle of 2025, so about a year from now, which means a lot of people in the market will be pivoting to the next big story involving Boeing, which is who will replace Dave Calhoun, the CEO of Boeing. He has already said he is resigning at the end of this year. A lot of focus will be on Pat Shanahan, who is the current CEO of Spirit AeroSystems, worked for many years, was a high-ranking executive, well-regarded at Boeing, and many people have said, is he possibly the next CEO? He's widely believed to be in consideration, but whether or not we get some type of indication about the CEO search over the next several weeks or months, that remains to be seen. Finally, take a look at shares of Airbus. I mentioned that there's a component of this involving Airbus where they get just under 20% of Spirit. They're being paid to take those operations that where Spirit was building parts for Airbus, $559 million. But again, the deal is finally done, or at least it's done in principle. We'll see how it shakes out over the next year. It's going to take about a year to be finalized, guys.
Yeah, and as I pointed out, a bit of a complex deal in the sense of it's all stock, as you well know, and it's got this collar that I pointed out earlier. So you get 0.25 at the bottom of the collar, 0.18 at the top.
Correct.
Obviously, if the stock runs beyond, I think it's 206.94, then you get.
Yep.
You stay at 0.18, but you gain value, and conversely, you lose it below 149. Boeing shares obviously at 182, so that would be a long way to go to drop. Not that we haven't seen it. What are you hearing on beyond what you shared? I mean, I guess Steve Mollenkopf, right? He's running the committee that's going to pick the successor to Calhoun, the former CEO of Qualcomm, who's on Boeing's board.
Well, there has been speculation that they might be moving to a point where the search will take up a little bit more momentum. Now that they've got this out of the way, theoretically, the DOJ case might be to a point where there is some resolution. There were reports over the weekend that the DOJ, after meeting with the families of victims of the two 737 MAX crashes, told the families, look, we want them to plead guilty overall, basically extend a deferred prosecution agreement. Families aren't happy with that. They want a much harsher penalty for Boeing. And they have until July 7th, David, which is 1 week from yesterday, to make some type of a decision. Boeing does, or the DOJ does, and we'll see what Boeing says here. I mean, Boeing could come back and say, no, we're not going to plead guilty for a variety of reasons. Does it mean they can't bid on government contracts? If there's a guilty plea in there, that's a big unknown at this point. There's probably more negotiations going on this week between the DOJ and Boeing. So that's the next big one. Once that gets through, then I think you're going to start to see real momentum pick up in terms of the CEO search.
Yeah. All right. Well, we know you'll be following it closely. Phil, thank you. Phil LeBeau. Coming up right here, the Supreme Court will be in focus. We're going to get its decision on former President Trump's immunity claim. That is expected in the next hour. Plus, tomorrow at the ECB Forum in Sintra, Portugal, Sarah Eisen's going to sit down with Fed Chair Jerome Powell, EC President Christine Lagarde, and the head of Brazil's central bank as well. That is a program you're not going to want to miss, and it will be right here. Let's walk in the street.
Welcome back in today's sector sort. Let's take a look at the top performing sectors for the first half of the year. Not surprisingly, tech. That was the dominant one thanks to the AI rally. Information technology surging by almost 28%, with communication services posting a 26% gain. Financials rounding out the top three, up 9.25% for the first half of the year.
Financials doing not too bad there.
Holding their own.
Yeah.
Yeah, non-bank financials, a lot of it, but yes.
And what's in that telecom? Yes, communication services.
That's
What's
Alphabet, Meta.
It is, right? Yeah.
And Netflix, yeah.
So that's in part why. Same theme. All right, let's talk a bit about the Supreme Court. It is about to wrap up its decision, or all the decisions for this term. A ruling on former President Trump's absolute immunity claim expected to be revealed. That would be in the next hour. Eamon Javers, of course, following it closely for us and has more on what we can expect. Eamon.
David, that's right. We're about 45 minutes away. We expect a blockbuster day at the Supreme Court here. Today is the last day of the session, and we do expect decisions, as you say, on all the cases that are remaining now. The court will finally rule on former President Donald Trump's claim of immunity from prosecution for at least some of his actions in seeking to overturn the 2020 election. Even before a decision is rendered, though, the court's handling of this case has been controversial because it failed to rule on an expedited basis, causing a delay in Trump's case that now threatens to push it past the November election, rendering a court verdict moot if Trump wins the presidency again in November. The trial, remember, was supposed to begin on March 4th. And also remember, Trump has been charged here with 4 counts for his efforts to overturn the 2020 election and the January 6, 2021 attack on the U.S. Capitol. He's charged with conspiring to defraud the United States, corruptly obstructing an official proceeding, and conspiring to do so, and conspiring against the right of Americans to vote. He pled not guilty to all of that. Now, Trump's immunity claim was rejected by the lower courts, which is why he and his legal team have taken it to the Supreme Court. It could be a favorable venue for the former president. The court has a 6-3 majority with 3 justices that Trump himself appointed to the Supreme Court. Special counsel Jack Smith argues that presidential immunity goes against just about everything the founding fathers wanted and would raise American presidents above the law for future generations. But Trump himself took to social media yesterday with a long post urging the court to do as he asked, writing in part, "Without presidential immunity, a president of the United States could literally could not function." We also expect decisions today, guys, on cases involving social media companies and challenges to federal agency rulemaking. So there will be some other headlines here coming up starting at the top of the hour. Back over to you.
Eamon, what does this ruling mean as it pertains to the campaign season for Trump?
Good question.
Both from a dollars standpoint as well as a time management standpoint.
Well, look, I mean, Trump has obviously had a big week with the debate. He is riding high right now. The Biden campaign is sort of wallowing in questions about whether Joe Biden should continue as the nominee. So all of the momentum campaign-wise is on the Trump side right now. You look at a ruling here that gives Trump immunity broadly. That simply takes a lot of the legal wrangling off of the former president's plate as he campaigns. I think it energizes donors. I think it energizes supporters. It certainly will energize the former president himself, and all that momentum will continue. If you get a ruling which says, blanket, no, forget about it, there is no such thing as presidential immunity, that's ridiculous, then I think you see, the former president looking into what his options are at court. That becomes a distraction. It's a time management issue, as you suggest, going into the fall. But the idea that it has taken so long to get to this ruling does seem to indicate to court observers that they're coming up with some more nuanced take on this, some kind of test saying, well, there is presidential immunity, but only in certain circumstances, and we're going to spell out the circumstances. That would be the kind of thing that would require this lengthy delay as they sort of hash through what kind of immunity would be given on what kind of a basis in the future. But anything like that would be seen as a win for Trump.
Yeah. Obviously incredibly important, Eamon, but from a perspective in terms of impact on markets or business, I would assume you'd agree the Chevron ruling from late last week, much more salient when it comes to those.
Yeah, absolutely. I mean, the Chevron ruling, people outside the Beltway don't necessarily focus on the arcana of the inside the Beltway regulatory agencies, but removing all of that power from regulatory agencies and saying that's got to go back to Congress That's a huge win for business, right? We also saw rulings earlier in the week against the regulatory state, so to speak. So I think this court's term will be defined by this Trump ruling, no question. But the lasting legacy for business, I think, will be this question of regulatory agencies, what kind of power they have, whether the SEC, for example, can operate its own in-house court, so to speak. That is vitally important to business as they tangle with regulatory agencies here. And the court is clearly on business's side there.
Yeah. Eamon, thank you. And obviously, we'll be seeing you in the next hour. Eamon Jabbers. Still to come right here, Wedbush Dan Ives is out with a new note. Hear what he thinks is ahead for the second half when it comes to technology stocks. And tomorrow on this program, be sure to watch Sarah Eisen's conversation with Fed Chair Powell, ECB President Lagarde. She'll also be joined by the head of Brazil's central bank. That's live from the ECB Forum. It's held in Sintra, Portugal.
Goodbye.
Happen, in between earnings, or do you kind of look at the?
I used to enjoy listening to him, but not no more. What's NVIDIA up to here? NVIDIA got down to 120. So we've had a little bounce back.
We're slowly moving.
Oh my God, you're right. There's no.
All right. GME 2269 pre-market here. We got a symmetrical flag on Tesla at open above 200. It's a big deal. If we maintain that, we'll go higher. Dell had a double bottom this morning. Everything kind of looks like it pulled back to a pivot point area today. A support. Pivot point by stating that it could go either way. The Mero just looks more like a scalping trade than it is a holding long. Because of the volatility in it. And we got the Donald will sell into the news. Intel just can't get a grip. I mean, they're in the masses. Now we got Apple down good. Hit that 210 area, which has been a pivot point for Apple. And PLTR is at resistance. We could break a little higher. AMD, kind of the black sheep of the family. TSM hit my support, but I didn't take it. We had, CCL. A lot of talk about it. ARM. Data support, but I don't know. We got Meta. Meta had a good sell-off on Friday. And I'd keep an eye on the reversal on Meta. I mean, one under 500. Yeah, man, I'm talking with smack, baby. Bring it down to the Kool-Aid. I'll be ready for that, baby. Whoa. And we get this one right here, which we might have hit. Yes, we are above it right now. So let's see. Let's take it down a notch. There you go. Let's play some blackjack. The best. Oh, I want to look at that Moroni again. We have less than 1 minute to go. I hope we're all tensed up for the market. Something went wrong, huh? With the chat. Whoa, here we go. There we go. Good morning, Ivan. Good morning, Mannequin. Right out of the gate, she decided to break out. Oh, well, not really. Pre-market. We could get a head and shoulders. Someone set an alert right above, right here in the gap. On the SPY. I'm not sure my platform. Mondays are always different now. We had a pretty good pullback Friday. It's July 2nd. Today, today's the 31st. Oh, wow. Damn, there we go. There we go. SPY options are pretty high. The 547s. Oh, here we go. What happened? They adjusted real fast right there. They can bring it up one more candle if they want. We have 1, 2, 3, 4. Good morning, Tom. Good morning, Randy. Magnificent. Mike. Franchise. Link. Michelle. Ricky. Realized Gains. SPY July 21st, the 546 strikes, the ones I'm watching. Get 5 or 10 of them when it comes time here. That's July 1st, 2024, the 546. We got another little support level right here that looks kind of attractive. Right there at 545.20. I saw some conviction here, but I don't know if I'm seeing it now. I'm going to just give it a little bit more time here. What am I watching? I'm watching the SPY, the 546 strike for tomorrow. Now the SPX is at a pivot point area. For it, I mean, it can go up. $54.78.98, $54.79 resistance on the SPX. Now it's got a descending flag, so it could drop here. Well, it kind of does. But it is more descending than it is ascending. Yeah, it's just wait. We got the VWAP now on the SPY. And watching Meta, Tesla. Let's look at my watch list real fast. I got to keep a good eye on this one. This might be ready. Today's loser, GME and Donald and ARM, CCL, AMD. AMD's down $4. Watch AMD. Yeah, watch AMD. What's going on here? There's a big knife on AMD. Keeps dropping what? Concerning the market. NVIDIA stock keeps dropping. So it's sister to NVIDIA. And they're going to try to manipulate NVIDIA. They, as in the fat cats. I'll tell you that right now. Okay, we're just now getting ready to squeeze on NVIDIA, on the SPY. We're going to find out here. Watch NVIDIA, SPY at 79. Hurry up. Yeah, I'm getting a little 2-second delay, second and a half, whatever, microsecond. Come on, SPY. SPY off the 50. We could easily pull down more. Today's winners, Mara broke 20. Tesla at 205. Boeing's got news. I mean, it makes sense. Boeing shares are trading lower after lower at the company agreed to acquire Spirit Aerosystems. So that is good. That gives them some control. I mean, it might not give a crap, but here we go back to the 200 right now. SPY. July 1st. It's dead. Here we're getting about ready to hit my support line. July 1st. Strike. 546. 68 cents. This is scalp. We were just real close to my support level right there. Way to go, booty. Way to go. I'm looking at the SPX or what? 546. July 1st. 68 cents. Yeah. One not out of the money. Could have went to 545s. No, July. Oh shit! Today's the 1st. Yeah, I got to get out of these things. I thought it said the 31st here on my computer just a second ago. What the hell? So I'm going to scalp these real fast. I don't want to stay in them too long. I do need to get in July 2nd. Yeah, this can drop. Yeah, I don't want to trade the same day on the SPY. We're going to see if we have any conviction here. If not, I got to get it right out. I don't think we do. There's a droppage. So I'm going to be looking at the next day. Got out of those. July 2nd. So that cost me commissions. How in the hell did that happen? More drama. So the 546 for tomorrow. NVIDIA now is under 120. Do, 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 do. We're at the RSI now on the SPY. We got 543.91 next. And we got a double bottom right here at the opening, pre-market. So we'll see if we hold that and start to revert. Nope, didn't hold it. $544.18. PMI is down. So we got a double bottom here on SPY. See what I can get. Could be it, the double bottom. Bitcoin ETFs are up. I gotta go get paper towels. Oh, I don't know if they're gonna be open today. I made a big mistake. Oh, they're open? No shit. God. Oh, I'm surprised. I thought you were going to be closed this week.
No, we're just closed on the 4th.
Oh, huh. I thought it was a whole week off. Did it used to be like that?
No, not since I've been here, but I've only been here for 6 or 7 years.
Yeah. Okay, I want to. This is Jim with Always Clean. I need to get a case of paper towels and floor soap.
Anything else?
No, that'd be fine.
Disinfectant. Do you want a case of the disinfectant or a gallon?
Just a gallon.
And then what was the other item?
A case of paper towels, brown, folding.
Alrighty, I'll put that in for roll call.
Okay, I'll be in there today.
Sounds good, thank you.
Yes, ma'am. Randy, I'm in the right one this time. I'm still not too certain about it, but we got to break the 9. Just not enough conviction yet. Officially, we're still inside the snake. It's a big snake. Okay, get ready, baby. Believe it. Break it. Fuck. Break it. If we break 544.73, I mean, you can get out now if you like. I got the second now, Randy. So today I gotta go get some paper towels. We're at 114. I don't know if we're gonna have enough conviction yet because we're still inside of the snake. Get out 110. Oh yeah. What happened to the chart? There we go. Now, Boomadaka, 127. Turned down for what? Randy? Turned down for what? That's how you do it. That's how you do it. Good job, Jimmy. Excellent job, Jimmy. I was thinking about getting it cheaper, but I just didn't want to do it. Damn, Jim. Good job, Jimmy. Mike, where's your little login thing in here? Thought we would put something new in there, man. It's easy street. That's how you do it. Did y'all see that on YouTubers? That was called a double bottom, right? Pre-market low. So that's an indicator. You got to have two confirmations to get in the trade. And that was definitely a good one. The double bottom and the double top. So once I hit my head and shoulder here, this is a head, that's your left shoulder, and that's your right. And that's Kid Dynamite. Hickory dickory dock, the mouse line up the clock. So $1,000, you netted 270. Over 25%. A plus yay. So many trades going. Oh my. Don't get confused, Randy. Might need some super haze there, lemon haze. I bought some cannabis the other day. I'm afraid to smoke it. I am. So now we're retesting. So today was a double bottom. We had the snake, the knife with a double bottom. Jumped in right here under the 9. And when she broke the 9, I felt fairly confident by that time. Mike's looking at it in the video. Oh, you have... Oh. You're in the video? Yeah, that's quite a bit of trades. I don't think I can handle that many. NVIDIA supplier parent company pledges $56 billion investment in AI. Spies flagging out. We're at the VWAP. Pot stocks are stagnant. Now GME. See, I think one thing we need to learn as monitors, once you get a lot of notoriety, you don't want to be like a kitty litter stock. You go out and make a little fool of yourself. I mean, you probably didn't mean to, but people are going to look at that and bring attention to you. So that little escapade, to me, you know, a lot of people loved it. I didn't personally. But that doesn't mean it can't run or nothing, but I think I would have done it a lot different. If the point was to get across that you're in for long, it could be 3 years or 2 years. You know, not come out looking all fucked up and got band-aids all over yourself and drinking a beer and saying it. That's kind of laughing at the retail trader. I'd been on the other side of the street. I'd been saying, oh, well, this is what my plan is. And I'm going to keep buying shares on the dip, and I'm going to hold it for, I think it'll take more, could take up to 3 years. But I'm going to let everybody know there's a little bit of risk in this trade. But eventually, fat cats, that's the way they trade. They buy it, and if it dips, they add on, and then they sell it. It's nothing different than what Buffett does, or let that be said.
They're going to have their shareholder meeting. Expectations are, that we're going to hear more about this robo-taxi. We've heard a lot of people say that is kind of that could be a big catalyst in terms of revenue in the future. And then, of course, China, and that's where some of these numbers for NIO and BYD, although they're competitors, point to some positivity for Tesla. NIO's Q2 deliveries more than doubled. First half deliveries top 500,000. BYD reported June sales. They're about 340,000. That was up 35% year over year. So those numbers are looking relatively good. We know the car companies have been kind of in a battle to cut costs or cut prices. Now Tesla's looking to cut costs as kind of their next venture to start generating better revenues.
Okay. So maybe we're starting to see some of that pay off here, the sacrifice of margins for scale to just get those off the production line and get them sold.
Yeah, I think so. I mean, Tesla's been cutting those prices to drive demand both here in the U.S. and in China. That's put a lot of pressure on margins. We know
Tesla
margins back in 2022, we're looking at 17%. 2023 is a very different story. They certainly have a lot of competition, right? You think of names like BYD, which certainly made a big name for itself. They've also got headwinds like interest rates, inflation, some of these hybrid vehicles that are becoming more and more popular. But as you look at investors, obviously seeing some positivity here. We're seeing analysts weigh in with positivity. Wedbush, DNI, they've moved into an outperform rating, 275 price target.
God.
350 bull case price target in 2025.
Dan Ives.
They're looking, at August 8th for that robo-taxi event. They think that could be key to getting Tesla to the $1 trillion valuation once again. And then Stiefel as well, buy rating 265 price target. Thanks to the Model 3 upgrade, Model 2, next-gen Model 2 vehicle, all could be positive catalysts as well as that full self-driving potential that Tesla has.
Right. That's also important too, which is I think that narrative around the robo-taxi, Tesla, AI is starting to pick up. Some of this chart really did seem to latch on to their discussion about AI, and I do think that that can't be ignored here.
Yeah, absolutely. I mean, it's certainly another way for Tesla to fight against some of the pressure that they have in terms of just selling cars, just selling EVs because they're the best EV, right? If they've got this full self-driving, if they've got the robo-taxi available, you pair that with some of the other business ventures that they have out there, that does help them as a company and maybe gives them a little bit of edge over major players that are coming into the EV space, especially in China, and trying to take away more and more of their market share.
Oh, knife on Spy here. Watch Spy.
For deliveries to help keep this trade going. After we got through $200, it's almost like the stock is really trying to break out and happening.
Watch Spy right here.
Some of the other mega cap themes, which have slowed down in the last couple of weeks.
Well, that's a huge knife on Spy. Watch Spy here.
It's just kind of softened a little bit while Tesla's...
Is that my bottom support channel?
I feel like some of that's kind of the narrative around it. Some of it is also the expectations for deliveries to pick up. So it should be an important number.
Very important spot here.
Doing great this morning too. Tesla right now up 5%. I mean,
546. I'm moving up to 545.
Tesla kind of coming back out of nowhere here, Tim. What do you think?
Yeah, coming back in a big way, no doubt about it. Getting to about the most overbought levels we have seen over the past year. Previous times it got out over the skis this much usually caused a period of consolidation, at least for a couple of weeks here. We do have, earnings coming out in several weeks here, so I think that might dampen some of the enthusiasm in this rally here, but certainly Tesla has been the star performer and, kind of benefiting from indirect AI play as the other AI names.
Get ready, we're getting close.
So I think the rally is getting a little overdone in Tesla. Certainly some short covering because this stock is still heavily shorted here, but I'm taking a guardedly bearish stance here.
Watch SPY right here.
The traditional July options and selling iron condor, selling out of the money call spread and put spread both to capture some pretty rich option premium. IV has elevated because of those impending earnings as well. So selling the July 19th 210, 212 and a half call spread, and also the 190, 187 and a half put spread, getting over $1.50 for
Here we
that
go.
trade. So risking $1 to perhaps make $1.50. I love that risk reward trade-off. And I think Tesla, today we're seeing that big move higher, but this market lately has been kind of the, stock du jour play where one day it's, the big AI names, the next day it's kind of the recent underperformers. So I think Tesla at some point the rally will stall out here and this trade will take advantage of it. Plus I can always sell shorter term put spreads against it if need be, bring in more premium, even move up my short 190, 187 and a half put spread to a higher strike price, maybe turn it into an iron butterfly and get some really rich option premium with reducing my risk to virtually zero on the trade.
Okay, so what about the top? What about the upper bound of it? Because we're pretty much there, 208. Well, not pretty much there, but we're close. I mean, you don't have a lot of breathing room to the upper bound at this point, but I guess that's kind of the point of the trade is you're betting that this is maybe kind of a more extreme move. Like you've got a couple bucks, right? If it goes to 210, but then from there it starts to work against you. So it's more kind of like a bet that it's not going to rally too far.
Yeah, exactly. It's a guardedly, bearish stance certainly here. And I think given the move on the stock we're seeing today and then over the past several weeks, like I said, the stock technically getting overbought here, running into some gap resistance as well, too. So I just like the fact I would not mind being a seller on a further rally from here in Tesla, to say the least. Plus, I'm only risking $1 max on the trade here. I think that's the way to almost play any of these big moving stocks these days, simply because these moves, as we can see in this kind of a little bit lower volume world we're seeing as we enter into summer, can be exaggerated. So Tesla, like I said, I think we're seeing a big move today, but I think that move may come to a halt here fairly quickly. If not, I can readjust and rehedge, sell shorter term bearish and bullish spreads against it, bring in even more option premium. So I like it on that front as well.
All right, nice. And I gotta say, it does look a little bit suspicious, Tesla rallying like this when the rest of the stocks that have been doing well have slowed down. I mean, it's like they're trying to do like a
Come on, baby.
rotation basically within.
We're at 104.
Or whatever. So especially as we fade today, I think your trade is making money as we're talking, Tim, because it's already lost about like 50 cents there.
Yeah, absolutely. I think you're looking at another beaten up stock recently. Merck is seeing some, buying today here. So I think we're starting to see a little rotation out of the high flyers that have worked so well until just recently into some of the beaten down names. Certainly Tesla has been one of those. How long this lasts is the $1 million question. I think it will be very short term in nature, hence kind of the trade structure here in Tesla.
All right, nice. Good stuff. Thanks, Tim Bigham.
You bet.
Trade. All right, got a little bit of buffer, a couple dollars to the upside, but mostly looking to fade Tesla down into a range. Stocks lost their bid, by the way. Dow is trying to hang out positive thanks to the Boeing rally, but everything else slipped. Nvidia down 2.5%. That's actually not even the lows of the morning. Nvidia was down pretty substantially earlier. but overall just some softening and a curious response to more weakness in manufacturing. Bonds are selling off and back down again. The dollar actually has caught a bid, so at least that's normalized. As we did talk this morning, the dollar looked a little bit weak compared to where yields were. But you could have also thought that bonds would have caught a bid and yields would come down after a bad manufacturing print, but that's not the case. Bond bears are still getting after it. This
118, get out here.
Firm up a bit, while equities and risk generally come off.
$123. Do. $125. $135. I'm taking some here. Fuck.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management.
That was nice.
Invest on my own and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
I remember when I first started flying, and we would experience turbulence.
Turbulence?
I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in the
Lulai.
situation. The relief.
Just in case you don't know what Lulai means, it's a new federal holiday that I'm putting out.
Through, I definitely feel privileged to be in that position.
It's called Lulai.
S&P is trying to hang in there, but we definitely got a little bit of a fade here in the last 30 minutes. Manufacturing data came in light. It didn't do anything to turn the bond sell-off around. Joining us, Jim Smigel is the Chief Investment Officer at SEI down at our site at the New York Stock Exchange. Jim, thanks for being here this morning.
So,
Appreciate you joining
why
us.
did I pick this number? Look at it, right to the penny.
Have me, Oliver. Give us kind of the general
Let's
thought
discuss
here,
this.
kind of big picture as we go into the second half of the year.
So I'm sitting here and I scalp this baby. I get out of the trade. I'm up $270 some. Then I wait again. We got another big knife here. So I had another, this was a double bottom. Now watch this. Don't trip out on LSH when you see it. Whoa! Whoa! Jim, you charted this thing around 5 o'clock this morning. And you told everybody that we have a possibility of hitting 542.60 on a 5-day time frame on 5 minutes. And so I'm sitting here. I had a big of some hash oil I needed to smoke up. All of a sudden I look up there at the screen. I said, whoo, whoo, whoo. Oh, be careful. This could be coming down. This could be coming down. So I get a confirmation of that 546.20. It's not, it's so beautiful that it went right straight to the penny, mind you. 542.60. So I had me a snake drawn up with it head and shoulders. And I got another knock on the door. And I said, Jim, man, I sewed it at the right shoulder line of that head and shoulders off the snake. That was a brilliant call. 5-day low support on the 5-minute. Brilliant. That's a hole in one. Do you understand? Say yes. Somebody say yes. Please.
Affirmative.
I mean, that tickled me to death. Come on, YouTube, say yes. Oh, I can't tell you how good that makes me feel. Mondays, you know, are always, like I told you about, me being a little bit like Elvis. I get a little bit nervous. Today I got all shook up. So here was my morning alert, YouTubers. And I had this up in the room when I was gone. Low support channel of 546.36 to 542, 543.36 to 542.60. Now these were rising, so I had to put that trend line in here. So that could have been the first support or the second, and then the bottom one would be that one right there. So that was at 5 o'clock this morning. 10-4. Amazing, Jim. Now we're at 135. The video's at the 200 SMA. Riding deep. All good traders today? Pretty good. We don't mess around here. Did you get out at the 200 SMA, brother? Tesla boom. They don't know what to do about Tesla. CNBC's probably having shit fits. $210, baby. Tesla was the first meme stock. Might have been some cannabis. Yep, I agree. With some clout. Well, if Buffett had enough sense, he would have bought it when he had the chance, and he didn't do it. Here, that's one trade I know he regrets. Elon went to Buffett and asked him, "You want part of this?" "No, I'm not into technology. I'm into building houses." Everything I trade has something to do with housing. From sheetrock to concrete to transportation. Tesla's a baby today. They're cutting costs. Oh my God. That's going to hurt margin. You can't be doing a tractor trader. Time in sales. CNBC saying, "Oh, we got to short it." Some Nile rallied. No, not really. That's what they said, but it's not really. Tesla's the leader, no matter what they tell you. And Dan Ives is pumping Tesla. We're at the 50-day on the weekly time frame, so that's what we got to break. If we break that, my next target will be $230. You have a problem with that? That's what I thought. Now on the daily, I got to look at the daily. Once you look at the weekly, oh, we broke the 200. So the catalyst is now support level will be off the 200 SMA. We'll get that in here right now. If I can get it in here. We'll just put it at 207 for right now, but we know it's 205 area. Damn it. Can't you do anything right? That was a big catalyst last week when we broke the 200. I said it. Now you put a 50% tracement on this here for proper entry, Fibonacci. Which is just right under my alert, right where I said it would be. So that's my story, and I'm sticking to it. 206.22. Going to be a great summer for Tesla. I agree. We're talking about NVIDIA right now. Let's see what these turds want to say.
Exactly, and those kind of fast movements result in thin volume here. You can see our volume profile shows these key areas. So perhaps around here, near like 114 or so, and then maybe around 103, around those levels. Those could be bumps in the road to the downside where price could consolidate or even find a foothold and recover.
If we were looking for a real correction, something to really kind of clean out some of the excess, it looks like $90 basically. NVIDIA has, the big volume profile down there. That certainly would be a bit of a wake up reality if it did, but so far, we're holding on, but that just kind of
hell yeah.
There was such thin.
And we just had another knife here, did we not?
This area, which starts basically right below where we're at right now, that if things got hairy, then
So we made the perfect exit.
It could happen,
Now, do I want to trade this before I go to lunch?
Prices here, I mean, we've come very
Randy.
quickly. It wouldn't be unheard of for a little air to be let out of the balloon for a while,
All right, but the RSI is still above 50. That's good. I don't think we have any reason to think it's going to have a steep drop off until it breaks the near-term support, at least at the 121 midday, 117 that you got there too, and then RSI below 50. So a lot of things that I think would have to come into play before any bears feel comfortable in this stock, even though there doesn't seem like there are any. Let's talk Amazon, Jenny. Amazon's been doing pretty well generally, and we talked about the e-commerce trade too. I think folks are realizing that prices on Amazon actually are decent in an inflationary environment.
Even prices at Whole Foods, I feel like, are decent, especially if you're like living in an urban area. I feel like there was the perception that Whole Foods was very high end when it first opened. Now with Amazon, I mean, like they're doing something right because they've been able to keep their prices relatively, I'd say, in the inflationary environment low, or just like more maybe like on par with
2 for $15 and their pre-made meals at the Amazon store.
Yeah, those were the best too.
They're not bad, actually.
They're really not bad, and gosh, I pay more than that for like my.
There's always like one weird piece of chicken though.
You know what? That's what you get for the 2 for $15. You get a few weird pieces of meat. But I think that this is a really interesting story. So we did see Amazon is planning now to spend over $100 billion over the next decade on its data centers, meaning the company is basically devoting more and more of its investment money to its cloud computing, AI infrastructure, than its network of e-commerce warehouses. We've seen AWS open data centers for years, but executives recently have said there's this surge and need for investment given the excitement around AI. I also think it's really interesting because with this resurgence of interest in data centers and growth in data centers, there's also then the need for more energy, as like the grid right now is not capable of withstanding some of these major data center production facilities. So in March, Amazon had purchased a nuclear power
95 cents again for one ticket.
Million, and only continuing to expand its investments in that world. And this is the highest buy rate I really can recall seeing. There's 61 analysts, 60 buys. There's only one hold. I mean, 60 buys is like the most I've ever seen analysts agree on anything.
Yeah, there's even more consensus here than in NVIDIA.
It's been that way for a while. I don't really even know why. There's just a flock of these like bulls that don't really move. They've just been basically buys for like months.
Yeah, perma bulls.
Yeah. But it hasn't been like a change recently. It's just like everyone's been stuck with their buys, which hey, I guess it's worked out because Amazon's chart looks great.
Yeah, one of them that's making records as we speak, basically, in a pretty big.
Anthony, quit picking up on her.
Last week, Rick, that breakout.
Yeah, I was going to say, being a perma-bull in this name seems to be working out pretty well here.
Very much so.
Had a strong rise upward off of these yearly lows here near 118. Now we're up 65% from that point here. We did have a bit of sideways price action here between about 174 to 190 or so, our light green and dark green lines respectively. We did have this rather odd outlier candle here. You know, that gives us the basis for this upward sloping trend line in white here, but we've moved a good way away from that point here. So we can see that we topped out
get ready.
at this green line near 190 several times here. Then we had an energetic reaction when we broke above it finally. And that's why these levels here where price stops repeatedly, there can be strong breakouts when price eventually does breach this area. All the orders start kind of piling on, and it causes like a waterfall
at 86 cents.
Of, you know, in this case, buying to the
Get
upside.
ready.
We culminated just shy of 200. We've given back a little of those gains now.
Get ready.
Actually on pace to form a harami candle right now, where the real body of today's green candle, the distance between the open and the close, completely fits within the body of yesterday's red candle, suggesting some indecision, some kind of stall in momentum on the part of traders here. So let's see what happens as this plays out today. RSI looks pretty good.
I'm up $100
here, above the 50 midline. Could not quite hang on to that overbought area. You know, just spent one day above that threshold here before falling back downward here. But definitely more geared toward the upside in this name still. If we were to keep moving upward,
I'm up
standard
$100
deviation channel plus one above. Our blue our linear regression line here, that comes in around 213. That could give us an upside target to watch. To the downside, it wouldn't be crazy to retest this old level near 190 before continuing to move to the upside. This is a common situation, but beyond that, 21-day EMA comes in near 188.
Okay. So if the market does stay firm and keeps going, then Amazon seems like a great way to express that view, given that we just got that fresh breakout. Perhaps a little listless in the last 2 days of trading, but nothing really negative you can say about this beyond that. I guess the test will be if it holds $190, that old resistance, right? Does that become new
Break it.
Kind of the next thing to check for Amazon.
Old resistance commonly becomes new support, and
yeah, I used to say that.
When you get a breakout, prices will kind of retreat, fall back to earth a little bit before regrouping, pushing up to the upside once again. I'm not saying that's going to happen. I'm just saying that's a common situation.
We kind of had this like ascending triangle situation going on here.
Yeah, kind of.
So like usually when it breaks out, that's a pretty good sign, right?
Yep, usually more biased toward the upside. A strong breakout on a large green candle is a more
You two are getting along way too good today.
is there to last.
Also impressive because all these reports continuing to show how much they're spending on the data centers and the market likes their investment. So, all right, last one. Let's talk some Meta here. Jenny, what's going on?
So this is actually really interesting because this is like, I respect a note that has like conviction. Raymond James gave a $600 price target, which is the new street high. I mean, it's about 20% upside from at least where we closed on Friday. So that's an extremely bullish call. And they said that Meta's CapEx budget could total about $50 billion next year. Such a budget they do believe would put a modest degree of gross margin pressure on Meta. However, they see big potential as AI overall investment intensity eventually lets up, driving what they said is improved incremental margins with an attractive
We're at 98 right now.
They believe we could see some top line benefits. Now, they said that there's still this underappreciated opportunity to monetize generative AI. I think underappreciated is maybe like underselling it or overselling it, because I think like at this point we sort of are appreciating that, but they believe that they have a pretty good spot to capitalize on overall AI given their Llama open source large language model. So nothing but optimism as far as this analyst is concerned. This name does have, I think,
Jenny, you talk too much. God.
They're appreciating their push into AI. Actually, I feel like they've been relatively one of the more quiet of the Mag 7 with their latest AI advancements, but still a name that's held on. I mean, we've only pulled back about 6.7% from all-time highs. So we've been now sort of trending upward, which is encouraging. It's like we broke down and we're recovering now.
Yeah, big year still, 40% rally.
Yeah.
And it seems like they're, taking all the AI to even further improve the morphine drip of all of our content that they're bringing us.
They have it already like in most of their apps too. That's like Instagram, Facebook I've seen, and it's not like crazy impressive, but it's there already.
Sure. Okay, chart-wise, Rick, we came
Come on, Anthony.
short of the previous high,
Blake
this
it.
last push.
Very true. And oftentimes earnings kind of rewrites the landscape here. So I think it makes sense to start our analysis from this point here where we had earnings last quarter, because we've been traveling upward in a pretty neat upward channel type shape here. Draw a trend line going across these lows, duplicated it, happens to match up pretty closely with the highs there. So this can give us a good potential guesstimate.
As we go closer to lunch, which I'm getting ready to do here in a second.
However, as you said, Oliver, we made a low.
Oliver!
We didn't quite take out those previous highs. We've fallen off on Friday and today here. We're falling below our yellow 21-day exponential moving average, much like our first chart. The difference here is that we're breaking below it here. So the support is not holding right at this time here. The day is still young. A lot could happen here. But this green line here, 482, this is one of these areas where price stopped repeatedly around this area, then topped out around
I want Oliver to interview me when I take my job at Schwab.
Line up pretty closely with our orange 63-day EMA and our white trend line here. So this area near like 482 to 484 could be an important support point here to hold on to. There's a lot going on in this small area here. So be on the lookout for that. RSI, once again, a bit of an interruption here. Kind of had a test to the downside.
AMD starting to cup and handle J-hook.
Broken through this trend line. We are just hanging on. Oh no, we are actually below
the
midline, just a hair below it right now. So that would be a more bearish sign. Couple that with a break below support. That's not necessarily what the bulls want to see. But as I said before, we've still got plenty of time left in the trading day for this to recover.
It does though look a little softer. It looks significantly
Anthony, we got a higher low
right now, and it does look kind of like Nvidia to where it's a little up for grabs somewhat, but different from Nvidia in that there seems to be more support to the downside short term and near term on the chart than for Nvidia that gets super gappy from here. So kind of a different perspective, a fairly unique one. They all look fairly different from each other, I have to say. So nice to see that kind of dispersion within the mega cap category. So all right,
Anthony has a lot of clout
with the pretty soft session. Thanks, Rick. Nice look at the charts. Appreciate it, Jenny too. When we come back, a little market meetup discussion for the day so far. red, but talking basis points, not too bad, but definitely a fade for sure from the morning with the Russell fading the hardest. And pretty much exactly what Kevin and I talked about at the top of the show.
The Russell.
Where with bonds selling off as hard as they are and no reprieve despite weak manufacturing. We'll be right back.
Fuck. That's not good. Not good, Anthony. Do, do, do.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Since the bell rang, basically, stocks have been coming off. Joining me, Caroline Woods, alongside Mr. Kevin Hanks. Caroline joins us from the New York Stock Exchange. Kevin back here with me in studio. We talked about this risk right when the show started, Kev, that things didn't quite add up.
I just want you to know that I'm not usually right this quickly, but in today's
Caroline's
case, it
here.
happened pretty fast. But you know, this is. Don't look any further. Don't complicate things. Look at yields and look at stocks heavy because we're at pretty lofty valuations and yields have spiked. I wouldn't look too much further past anything like that.
All right. What about the fact, though, that it doesn't seem to go with the data? Like, you know, it's kind of weird. Data miss, bonds selling off this hard. I mean, that part to me is a little bit of a head scratcher.
Yields did drop down briefly when the number came out right at 9 o'clock Chicago time,
and then went right back
up.
So
there's teardrops and tidal waves, Oliver. None of this data is monstrous. So it tried to change the path, didn't.
Well, I guess it's also kind of which way you look at it, Caroline, because obviously activity slowed in manufacturing, but the prices paid are still high. They're still sticking around. Even though they came in a little bit, it just seems pretty clear that inflationary pressures very much remain.
And we know that, and I don't really necessarily think that manufacturing data is going to be all that market moving, especially on what is typically the slowest week of the year. We have the shortened holiday session on Wednesday. Of course, Thursday is the holiday, so I don't think it's any big surprise that we're not seeing a whole lot of action today. I think really what stands out to me is that what worked in the first half of the year isn't necessarily what's working in the second half of the year. It's just the first day. I don't think that this is necessarily a broader indictment on the AI trade, but we are seeing weakness there. NVIDIA already off the lows, but still down about 1%. We're seeing a 5% drop in AMD. Micron Qualcomm, Intel, all lower. Even an AI trade like Super Micro is seeing a 2% drop. I will say Broadcom is kind of the holdout there, basically flat on the session. So we aren't seeing a weakness in overall tech, though. I did notice only Nvidia and Meta are lower out of the Mag 7. Tesla is seeing a really, impressive, almost 6% gain. But, not a whole lot working today. We're just seeing a lot of back and forth across the unchanged line. But healthcare, consumer discretionary, IT, and the S&P 500 were in the green. Financials were in the green as well, but have since turned red. So, I think that the AI trade potentially waning a bit today. I don't think that that's what I'm hearing from a lot of the conversations I'm having in terms of still a lot of bullishness around that trade, not just in terms of, the NVIDIAs and the Broadcoms of the world, but continuing to see strength in utilities to power the models. And also, I even heard a bullish call for FedEx, a few bullish calls for FedEx because of the fact that you have to ship those chips. So, I think that's still going to be very much in the picture, not necessarily today, though. I will say, I don't know if you saw Jay Woods' note from Freedom Capital Markets. He said that the data shows that the S&P 500 gained 14.5%, obviously, in the first half of the year. The data shows that this is the 24th time since 1950 that it was up over 10% to start the year. And when this happened, the index added to those gains the rest of the year on all but 4 occasions.
That's
so
pretty good.
I saw that Sam Stovall was on earlier. If history is on our side, it could point to further upside. Not necessarily today, though.
No, that's a good reminder, too. And thanks for watching, Sam Stovall. As, his historical indications are pretty solid here. The thing that this second half of the year, though, does present some complications, Kev, as we talked about, I think maybe this is part of the reason why bonds are selling off, is because there's just no optionality for the Fed, really, for 2 months. No August meeting takes us to September, and we're not going to go in July unless something crazy happens. If we get like a 0 unemployment print, maybe.
Jimmy said so in July. We're going to see if he's right. That's my battle cry.
The bond selling makes sense, right?
The path from where we are to 2% is going to get a little more dicey.
Yeah, it already has.
It's not just gravity that's going to take us down there. And I think that, some of the, I hate to keep harping on crude oil, but crude oil is going to affect inflation.
Sure.
This move in energy is going to affect the overall inflation picture, and I don't mean make it better.
Yeah, especially when crude's up and risk assets are down. Generally, that's usually one of those moments where crude is looking pretty strong.
Yeah, and so there's just a lot of reasons, one of them being valuations, just to be a little hesitant. And by the way, we're not down that much.
No.
I mean, we've opened higher, now we've come lower. It's actually a great day to be a scalper.
Yeah. NVIDIA's $2 off right now, so certainly recoverable. Thanks, Caroline. Thanks, Kevin Hanks. Thank you for joining Morning Trade Live. Trading 360 with Nicole Petalides is up next. Have a great day.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hanks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
There we go, baby.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once a client knew that she was heard, we were able to help her move forward. Your client won't care how much you know, how much you care.
I don't care. You don't care. You left us in the streets.
Technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services.
Scaled some at 104.
A fresh take on the hottest trends in the market, from every click to every tick.
There's no fear of missing out on Next Gen Investing. 1 p.m. Eastern, only on the Schwab Network.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. So glad you are with us on this Monday, a shortened trading week as well, an abbreviated one with Wednesday and Thursday. In fact, we are closed Wednesday, a half day.
Can I lower the TV a bit? Yes.
Dive into mega caps as we look at names like Nvidia and Meta receiving bullish notes from analysts this morning. The announcement that Amazon will be investing over $100 billion
Okay.
next decade on
Not a bad day.
and our
Now I'm gonna go make lunch.
Snowflake. This after Goldman Sachs released a bullish note on that stock.
Goldman Sachs? Cheating?
We dive into alternative investments to consider for the second half of the year. In the meantime, stocks are somewhat mixed. As I mentioned, you have this abbreviated week. I see JP Morgan's about to close at a record high today. We'll have jobs throughout this week. Jobs on Friday will be very key. Here's a look right now. The S&P is down 0.1% at 54.53. The Nasdaq is down 17 points. The Dow's down 25 points. And the Russell losing 0.75%. As you look at oil and gold, oil's at 82.36 the barrel, and gold's at 23.34 troy ounce, down 5.8. And as we look at 63.175 is the level of Bitcoin, 105.58 for the dollar, and the VIX sitting at 13.09. So we have a lot of story stocks for you. Let's start off with this one. Jenny Horn's with us, markets correspondent here on Schwab Network, taking a look at Boeing, which got its done deal with Spirit Aerosystems. And we've been waiting on this, and finally now we're getting more details.
Yeah, I think that that's a really good point to start with, Nicole, is that we first got wind of this deal back in March, so finally some clarity on what obviously the financial details are, but it wasn't a huge shock. So we did get reports this morning that Boeing has agreed to buy Spirit Aerosystems for around $4.7 billion, or around $37.25 a share. Now, we did see that including their debt levels is around $8.3 billion in terms of their total transaction value, roughly. But Boeing's current executives have admitted that actually back in 2005, when they spun off Spirit, they saw that overall it's been a mistake for Boeing as it's hurt the reliability of their supply chain. And at the time, Spirit was only valued at around $900 million. But what this means is that we will see the
It was a big mistake, Boeing. Who was the CEO at the time?
that are related to Airbus will be
Another one of your dipshits.
for a nominal $1, according to Airbus in a statement. Those activities do include the production of their A350 the fuselage sections, again, according to Airbus, but it would also receive around $550 million from Spirit as compensation. Now, Airbus's business with Spirit accounted for around 19% of its revenue in 2023.
Okay, I'm going to go make my lunch.
Boeing, which is around 64% of its business, was with Boeing. So I think it just seems like the natural progression that now it would be acquired by Boeing because the majority of its revenue is funneling through Boeing, basically. They were
Don't
also
fight the trend.
Of course, in that fuselage blowout we saw back in January on the Alaskan Airlines flight of the 737 MAX. So I think the idea is here, in terms of this.
I want to reiterate one thing and one thing only. It was me they called the pullback in July. The first one. It was me. Now they're coming out saying it. They're late.
To a lot of the victims of the 737 MAX crashes
That debate.
Years ago. So lots of right now, I'd say pending headlines.
After listening to these dipshits on CNBC saying that all their Fortune 500 companies were behind Biden, right before the debate, I had to choke.
All right, thank you so much, Jenny Horn, markets correspondent. Also, we have some breaking news on NVIDIA.
I had to choke. I said, there's no way that you're going to, unless you know that the rig is rigged up, you know, that Biden ain't running the country. It's their buddy Obama and George Soros. So Biden comes out, I mean, looked horrible after a 7-8 day rest. Are you kidding me? Whatever they shot him right before the show really hurt him. I mean, you know, when people get real stoned, their voice will change. And he was definitely on something. As it started wearing off, he started acting a little bit better, but I think they might have set him up. Now, as an ex-psychopath Democrat, I can tell you how they think. Just like they got to throw in a Hail Mary, and I don't know if it'll bring some back, but I mean, there's a lot of loyalty. Then people are a major cult, Charles Manson kind of type.
See kind of that small, you know, kind of the small caps and more economically sensitive areas of the market, you know, continue to underperform.
I'm gonna have a salad and some salmon.
Fundamental reasons, you know, at this point, right? Markets,
I think that's what I put out.
When you look at kind of positive first halves of the year, right? We do tend to see kind of gains beget gains. We've seen pretty solid, kind of back halves of the year when you've had.
I'll be eating leftover salad stuff, so I ain't gone grocery shopping yet.
That first half, right? And then we also kind of all know that the kind of election years also do tend to be kind of positive years for the market.
Right. So gains bring on more gains, and then you have the election year situation here. So what do you think will be the catalyst? Is it just that because
earnings?
We really saw tech and AI take over, right? When you look at the equal weighted index, that was up 6% compared to 14 or 20%, right? And so, but it was really tech and AI.
Rivian last week had that Volkswagen investment.
What do you think might be like some winning looks for the back half of the year?
Yeah, so I mean, I think as you just highlighted, one area it is pretty interesting is energy, right? You've continued to see kind of oil prices moving higher, and that does seem to be kind of driven by more geopolitical concerns at this point. But that sector has pulled back pretty significantly over the last couple of months. If you look at it, right, the sector is yielding over 3%. Right at this point, right? So you do have some yield protection, along with some equity upside.
And if you do, even if you do start to see some of that geopolitical risk premium come out of energy, I think that will potentially be the catalyst where if energy prices stabilize, that'll be the catalyst to get people to move back into the equities because they haven't, right, the equities haven't been moving higher with the oil prices currently.
I was just thinking about last Friday where, we had the reconstitution of the Russell. The prior Friday you had Triple Witch and a rebalance as well. And those were the heavy volume
very,
days,
very big
right?
liquidity events here on the
huge
exchange.
event. So is there anything that's coming up soon that we should sort of note that you're thinking about?
Yeah, I mean, not from an index perspective, but I mean, as you know, this is a holiday week, but it's a week jam-packed full of kind of macro catalysts. Right, so we had the French elections over the weekend, which has kind of given a little bit of a relief bid to Europe. The Sintra conference is ongoing in Europe. That's really the equivalent of the Fed's Jackson Hole Economic Symposium. We'll hear from Chair Powell tomorrow. Right, and then we also have the ISM surveys. Manufacturing came in a little bit light today, but the details within that were actually pretty good, with new orders coming in better and prices falling. And then we'll have the ISM surveys, the ISM services on Wednesday, and then on Friday the very big jobs report number.
Yeah, I mean, as you talk about economic news, and I do want to get to jobs, but just to back it up, and for the inflation print for the PCE, I mean, we basically saw it came in as expected pretty much, but really at the lowest levels in some time. So inflation being in the right direction, going in the right direction, right? What does that mean for the Fed? Do you expect the Fed to cut once this year?
Yeah, but I still think they've kind of set the bar pretty low
Blake.
for a cut. If you look back at their summary of economic projections,
Be careful, Jill.
They had their unemployment rate at the end of the year at 4%.
VWAP.
Right, so
Use the VWAP.
They had suggested that PCE was going to actually move higher, right? So they've kind of really anchored the market in the fact that they can.
And we're still low early,
pretty easily.
so anything can
and
happen.
I think we're going to need to continue to see the data moving in the right direction. But from here, I think the labor market data is really, really the key. If we start to see that the labor market start to roll over, right, that's going to give them a little more leeway to move more aggressively if they want to. Right, but that's also the key from an economic perspective. Right, we're starting to see some signs that the consumer.
So I'm going to see what I can get for lunch. I got a zucchini in there that I need to cook.
Multiple.
I got a tomato. I could have I could do a tomato
and if you start to see that labor
tartar.
market start to slow down, right, that's going to have implications going forward.
Yeah, so if we start to see, I mean, if they don't want hot inflation, right? And they knew if they start making the moves, unemployment may rise. And if unemployment starts to rise even this Friday, they're okay with that, right? I mean, they want sort of a slower economy, I guess,
to
right?
some extent. To some extent, they want that.
What else are you watching that maybe we're missing? I mean, you noted recent easing cycles, small caps have reversed. You talked about that a little bit.
Yeah, so if you look back historically at kind of the easing cycles back through the 1990s, right? This cycle's played out very similar to what we've seen historically, in that large caps tend to outperform in that kind of 6-month window heading into the first cut, right? While small caps do tend to significantly underperform. You see some of that begin to unwind as you start to get kind of the first rate cuts. Right, and that some of that performance unwind does kind of happen in that 3-6 month time frame, kind of following the first cut. Right, so we're getting close to theoretically that window. I mean, whether we're talking September, December, kind of early next year, I think we're kind of at that point where we know they're coming. Right, so we're starting to potentially be setting up for a little bit of that kind of rotation.
In more than it's time to go, but I read in more than one place about a pullback. I read about a 10% pullback. I read about a 30% pullback. Do you think these pullbacks are coming, and if they are they opportunities for buying?
Yeah, I mean, I do think that we're kind of overdue for one, right? I mean, the S&P very recently has been trading in a 50-point range, like a very tight range.
Yeah.
We had a very modest attempt to break out on Friday. I would expect to see some range expansion here in the near term. I don't think it necessarily needs to be all that a very significant pullback. But if you look at historically, right, markets see an over 10% pullback on an average basis every year. We barely sniffed a 5% pullback in that April time frame.
They'll buy the
But I think there is an opportunity for markets to kind of settle in, pull back, but I do think you use those to be opportunistic.
Interesting. Michael Ranking, thank you so much. Senior market strategist here at the New York Stock Exchange. Thank you, Michael. Plenty more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the technicals. Scott Bauer of Prosper Trading Academy takes us through the trades for Kava, Tesla, and Albemarle. Next, here on Trading 360, right here at Schwab Network. We'll be right back.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time for the big three. 3 stocks, 3 charts, 3 trades. And Ben Lichtenstein will take us through the charts. Here to take us through the trades, Scott Bauer, CEO of Prosper Trading Academy. Nice to see you both on this Monday. Scott, how are you feeling about the market? I mean, I just saw a moment ago, JP Morgan was going to probably have a closing high. You know, sort of exciting. We've just been climbing and climbing, and you know, for example, Michael Brinking just said, you know, gains get more gains going forward.
Yeah, I mean, the trend, Nicole, is certainly higher here, but I think, you know, we all have to be very cautiously optimistic. There's so many things, in my opinion, that could derail the market, but boy, the momentum is squarely to the upside right now.
All right, let's get to your first name here, and that is Kava. The Mediterranean Foods had their IPO here not that long ago. Tell us your thoughts on this name, which is up 2.1% today.
Yeah, this is one here that, you know, is probably not for growth investors unless you're really willing to take, you know, some volatility with it here. Like you said, just had its IPO. You can't measure this stock with its PE ratio. It's in the 100. So, you know, if you're going to look at that and say it's overvalued, you know, this stock is not for you. But when you look at the analysts out there, there has not been one earnings estimate that's been lowered in the last couple of months. In fact, 7 analysts have actually raised estimates, and the overall consensus estimate has been raised as well. When I look at a technical look at this, and you know, the stock hasn't been trading that long, but there's been some pretty big resistance right where we're trading right now, and I think this thing is going to break through. This, you know, but besides when I've been to this restaurant, besides it being what I think is just fantastic, doesn't really matter what I think, but when I look at this is a little bit of a cult right now, if you will. This has a huge huge following, and I think there's going to be a big upside breakout. So I'm buying a September call spread, like pretty wide call spread, the 100, 115 call spread, because I think we break through these, this resistance area here, and that's kind of the next stop up around 115.
Yeah, it's interesting because, you're talking about making brand new highs. This is about a year old from that IPO.
Yep.
The high was 97.64. So this, move that you're talking about with these calls would mean new highs for this company.
Yep.
Let's take a look at the chart with Ben. Ben, your thoughts on the chart?
For sure. I was actually at one of the locations last week, and Scott mentioned the devout followers. They were halfway out the door, full of devout followers, right? And by the time I was at the counter, the line was out the door. So we had good timing, but the place was packed, to say the least. And the stock, I think, is a reflection thereof. Let's take a look first and foremost. I wanted to begin with a more intermediate time frame because I started off with a 5-minute candle chart. It was just a mess. There was really not a lot of conviction there over the last week or so. But as you step away and look at some of the price activity we've seen since the beginning of April, you're going to see a lot of conviction here. Bottom left, top right, exactly what we like to look for. Areas of consolidation that have formed at higher and higher levels. You can see where the market's kind of paused and sort of regained composure. Scott was talking about potential for a breakout. That 97 level, that's the upper extreme that we're looking at. And you've got a kind of a line in the sand in terms of this momentum to the upside being 80. Now, the bulls don't want to necessarily see it below that June low that we saw down around that $84, $85 level. But again, the area of balance that I'm focused on is the one prior to the one that we're currently forming. Bulls want to see another breakout to the upside to continue a staircase type pattern, which has been continuing, not since just the beginning of April. Here we're going all the way back to, again, October last year. We're talking $29 all the way up to $97.64. Again, now we stepped away from an hourly candle chart into a daily candle, but look, almost an identical situation playing out. A well-defined trend up, simply put, off that October low, bottom left, top right. It was around 29, just shy of 97 back in May. Currently in a balance, it's forming up around 90. I like this in many ways. This is acceptance of the most recent run-up that we saw into the beginning of June after earnings. If you remember, a high conviction move up through that $90 level, and then basically no rejection as of yet, overlapping rotational price activity. Last chart I wanted to show you real quick where we are relative to the 50, the 200-day moving average. You can see, again, holding above both convincingly that test of the shorter dated, again, back in April, providing, again, just support for the bulls. Here you can see RSI, no real lean one way or the other, but well-defined trend up here, that's for sure. Looks like bulls remain in control.
Okay. It's interesting. Thank you for that. So the bulls remain in control, and then Scott was talking about new highs. But what's interesting is a lot of the analysts who some have buys, some have equal ratings, but they're not. I don't really see a lot of price targets over 100, Scott. So you're sort of an outlier.
Well, that's good. I like being an outlier, but I'm not sure that there are those price targets just because we're in, a territory that we've never been at before, and because the stock is so new.
All right, next up, we're looking at Tesla. I saw that it broke 200 back above the 200 level, so that's exciting for folks. 209.75 here. I think people are sort of eager to take it out of the Magnificent Seven, but they won't because they are waiting for the August 8th date.
Yes, and listen, there's so much that everybody can debate about Tesla, about Elon Musk, right? So we don't need to get into the give and takes. Here's the bottom line, in my opinion. The quarter two delivery figures are coming up. Their margins keep compressing. China's not improving. Now, the stock on this morning is rallying. It has actually traded above the 200-day moving average, which is something I was looking at for some resistance. It is hard to fade the Musk. However, I am buying an August expiration put spread, which will take into consideration the next delivery figures, I think the next earnings cycle. So I'm buying the 190, 170 put spread. This stock, honestly, there's so much on both sides. You've got the bulls, you've got the bears out there. I like the downside from here. I just think that it's really up against a stiff fight at this point.
Look, there's been a lot of complaints about the PE ratio, that it is overvalued. Most recently, the Cybertruck drivers have been listing the shortcomings, saying the battery power, lack of full self-driving, things like that. But there are others who still love Tesla and Elon Musk.
Yep.
Let's see what Ben says about the chart. Ben?
Yeah, I do feel like there's lots to get charged up about when you're talking Tesla, especially when you're talking about the technicals here as well. Scott mentioned the fundamentals, and I can understand why the bulls are excited, to say the least. Let's start off 5-minute candle chart. Perfect example of what I like to look for, guys. Two-phase in price development. You have that horizontal overlapping, rotational, kind of random type price activity, and then bam, you get an open like what you saw today, and you get that high conviction move up. And then we transition back into that overlapping kind of rotational. You found the stopping price up around 211, and you sort of start to balance around it here. Let's take a look, stepping away from the 5-minute into a hourly candle chart now, adding a little bit of time on here. Stock was trading down around 138, if you remember. That was back in the end of April, and you can also see here a well-defined trend up. Again, bottom left, top right. You can see a few areas of consolidation that have formed. And here's that 200 level that we were just talking about. Again, the breakout right now that we're seeing above that. Nicole, you mentioned how we're recapturing that level. You can also see the vertical nature associated with this move here, the high conviction move up. So you get that higher highs, higher lows. Green candle, simply put, participation, energy, exactly what the bulls are looking for to start the week, the quarter, the second half of the year. Taking a look here now, they really got some heavy lifting to do, though. Get back above 250, ultimately you could, hey, I know this is a stretch, but you could regain those all-time highs up around 400. Another thing that I like is that you held key support around 100 here. Recent test held above the lows that we saw end of 2022, beginning of 2023. And again, if you get through this 250 level, you really build momentum to the upside. I got one more chart for you guys I want to show you, because Scott did mention that 200-day moving average. Here it is. We're just back above it right now. Been kind of forming a bit of a bottom here around this 50-day moving average. Look at RSI here. We were talking a minute ago about how there wasn't really a lean one way or the other in terms of RSI in our last example. This one's screaming. The bulls are in charge here right now. It's screaming energy to the upside. It's screaming a nice big move here, again, to begin the week.
All right. Any thoughts here? You want to add anything, Scott?
I've got the contrarian position on, but that's why I created with options. So if I'm wrong, and I am wrong at times, if I'm wrong, I know what my maximum risk is.
Right, I understand. It's even when I'm wrong, I'm right, all right, last but not least, let's take a look at Albemarle. We think of materials, chemicals, the manufacturing of that.
Cost has a 1, 2, 3.
1 year, it's down about 56%. This year, down 33%. What's going on with this name, and where do you think it's going to trade in the future?
Yeah, you talk about a stock, when you look at the charts here, falling off a cliff. This one is really represents that. Lithium prices keep falling, and the EV market, even though we just talked about Tesla, and I'm not, so enamored with Tesla, what is the EV market doing? There's a lot of...
Nailed the SPY, we're at 106.
About it. But contrary to my bearish take on Tesla, I think Albemarle is a really major value play here. This area here, around 95, if you look back going to 2020, this is a major. It was a resistance area, and then we broke through there. So as Ben will probably tell you, former resistance.
Always clean as Jim.
I'm looking at that. I'm buying an August call spread, the 100, 110 call spread.
Hello?
I just think this stock is really a big time value play right here. I'm a shorter term option trader, which is why I'm only going out 6 weeks or so to August expiration. But I think even if you went out further, September, maybe even the end of the year, I think this one pays off for you.
All right, let's get a final thought here from Ben on the technicals of this name.
Yeah, this one definitely has come off significantly, right? Fell out of a tree and hit every ugly stick on the way down. This stock is under pressure, to say the least here. Let's dive in first and foremost to an hourly candle chart. And you can see the pressure that it's come under over the last couple weeks. Sold off from, if you remember, it was trading up around that 118, 120 level all the way down to the breach of 192. a 29. Yep, there it is, that low recently below 92.30. Take a look at on the way down how, look, you get high conviction and you get this kind of hockey stick or type pattern that plays out where we go from a big move lower here into a sideways consolidation phase. Again, balancing around this $95 level, right? But I want to show you as you kind of take a step back here and look what happened on the way down. Again, how this pattern repeats itself. We're talking 1, 2,
115,
3. I mean, you can go 4,
118,
6 times along the way. So again, this high conviction trade, sideways consolidation really shows that the bears are in control here right now and they're pushing this thing lower. Taking another step back, adding a little time on, really well-defined trend. So we're going back to, we're talking about when, well, now we're looking at when the stock was trading up around 140. Just top left, bottom right here again. High conviction move lower here, but I wanted to look at this daily time frame because I've got a longer term queued up here where you can see, again, balances which have been and continue to be moving lower. 260, 205, 165, 125 along this trajectory and just kind of adding to this move lower off that end of 2022 high we saw up around 334. Again, breach of 100 recently. It does look like we're transitioning into something a little bit more horizontal here after breaking out right down and below. So that staircase pattern continues, but one more chart again to show you where we are relative to the 50 to 200 day moving average. You can see we're below both. RSI also has been accelerated to the downside. Coming off the most recent extremes, probably a reflection of that sideways consolidation. Again, price looks like it's become a little bit more overlapping and rotational, but still no rejection of these lower levels.
Right, understood. Great stuff with the charts there. Ben, final thoughts, Scott Bauer.
Again, I like looking back. It's 4 years now, so it's a long time where that 95 area or so was big time resistance. We're challenging that right now. I'm looking at that to hold. Not necessarily for Albemarle to make, a 50% gain back to, where we were up at 140, 150 or so. But that's why, this is a pretty modest call spread. I like it.
All right. And we like when you're on. Thank you so much, Scott Bauer, CEO of Prosper Trading Academy, and Lichtenstein there on the charts. Thank you both for the big three today. Coming up next, let's spotlight those mega caps. We've had a few companies get some price target hikes this morning. We had some breaking news at the top of the show on NVIDIA. What you need to know. We'll be right back.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. Also, you can trade brilliantly.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once a client knew that she was hurt, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Wednesdays I'll get this.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
It's like a virus. Price is supposed to tell you
Nike 1, 2, 3.
what's dear, what something is worth. But if it's telling me a lie, then you make decisions based on faulty information.
This week, Market Overtime features the sharp tongue of Steve Forbes, Diane King Hall.
1, 2, 3s ain't holding up well today.
Presidential candidate to discuss his latest book on inflation, from Forbes' strong disdain for the Fed's handling of inflation to his case for the dollar over everything else. Don't miss the interview debuting here, 4:30 p.m. Eastern Time on Schwab Network. And welcome back to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. It's time to spotlight some of those mega cap names. Paul Nashwabi is with us, practice lead at the Futurum Group. Paul, thanks for being here. How are you feeling, before we get in this name by name, because there are pieces of news on each of these, how are you feeling on the Mag 7 tech stocks overall?
Yeah, I mean, they're growing. It's obviously there's growing. You see that the industry darlings out there are taking some leads in the market right now, right? And there's reason for that, right? Monetization is a factor that we see that's growing across the industry. Organizations are under incredible pressures to grow, and with those pressures, we see that the vendors that are addressing these challenges are really going to be the ones that are going to excel.
For the people who think the AI craze may be overdone or almost done, what do you tell them?
Oh, that's an interesting perspective. I don't think it's overdone by any means. I think it's actually growing, and it's growing substantially. What we see in our research as an industry analyst, I see and do trends all day long on this, and what we see over the last 6 months is incredible growth. We see from 6 months ago, we saw an 18% utilization of AI and production workloads to, moving to a 56% increase just in the last 6 months. So there's definitely an increase in using AI and production workloads and how to overcome some of the challenges. And these challenges are not easy, right? When we look at what organizations are running into, they're challenged with skill gap issues, they're challenged with competitive landscapes, addressing some of those overarching movements that are happening in the market. So there's a lot that's happening here that organizations definitely need to look to vendors to drive forward, and AI, in my opinion, is just at the kind of the cusp of taking off.
Yeah, understood. Let's go through these one by one. Maybe you can give us some of your thoughts. I mean, first up, we know data centers has been an area of strength for companies, and Amazon announcing this company will be investing $100 billion in data centers.
Woo!
Did that seem surprising to you?
Yes.
Price tag seems surprising to you, and do you think it will benefit Amazon greatly?
Nicole sounds a little sick.
Actually, the investment in data centers over the next decade is really going to be an evolution of where organizations are going to have that burst capacity to drive to the cloud, to the advancements for that monetization effort. We're going to see that the organizations like Amazon that are investing in these areas are going to provide that burst capacity, to provide those resources that organizations just can't basically afford to run based on a number of reasons, whether it's energy consumption reasons, whether it's skill gap issues, as I mentioned. And when Amazon putting together these plans in place, they're not just looking at what's happening in their own cloud ecosystems, but they're also looking at what's happening on-prem as well. So they're really working with organizations to drive towards those results of those monetization, those applications towards the future, from on-prem to the cloud and also to the edge as well. So there's a lot of advantages here, and you definitely can see that the growth for Amazon to invest in these spaces is favorable, and you can see it with what they're doing with their announcements as well.
Yeah. Morgan Stanley was talking positively about NVIDIA today. We've heard a lot of positive comments about NVIDIA overall, even as it's been an incredible winner. It's come off those highs. At the same time, you have another antitrust headline, this one from France today. That was breaking news at the top of the show. Hasn't affected the stock really at all. Where do you think NVIDIA is headed?
Well, look, I mean, NVIDIA is the industry darling right now. I mean, it's out there, and anybody that's in AI and working on those production workloads I was talking about, are using NVIDIA, using those types of technologies to kind of push their production workloads forward. Yeah, there's some concerns about regulations and antitrust that's out there. I think that is part of our evolution and learning of what the impacts of AI will be on data in general. Overall, data is really where businesses are going to thrive and their applications are going to need it, and the performance of these workloads require technologies like NVIDIA to back it up.
Yeah, I mean, we know the new Blackwell AI chip is obviously big news here. That's something we're watching. Meta also talked about, that was the first name in earnings season last quarter when they started to talk about the spending they were going to do on AI. And I think people balked, and then they realized that all of these names will be beefing up. In fact, now Raymond James had a price target hike on Meta. Do you like this one?
That is interesting to me. I think it's. I think when we talk about the differences in compliance and regulation, I think that Meta also has some concerns to think about here. When we look at the price target moving for Meta, it's definitely showing that there's investment and growth within the Meta platforms. And again, I think it comes down to understanding how to monetize and utilize those platforms to address those business concerns. Of course, with monetization, that's my focus area, but that's really where I think that the Meta platform is going to help drive for success for organizations looking to move forward with those monetization efforts.
Right, understood. And what's the takeaway here? I mean, the whole group, it sounds like you're pretty positive on tech overall, on the Mag 7 overall. What are we leaving out? Why this group? Because it really led the market for 2024, right?
Yeah, I think it really comes down to the need, right? What organizations, what vendors are meeting the need for meeting those business concerns. And, what we're seeing in our data is we're seeing that the monetization challenges are driving those needs. And what I see from these big companies that are kind of driving the decisions here, they're really making it easier. They're reducing complexity. They're reducing the skill gap issues. They're providing ways for these monetization efforts to excel, which is what we're seeing as a reflection of the stock, right? We're seeing that these ways for adoption of these technology stacks into organizations is really starting to take off, not just because there's hype around AI, not just because there's a fear of stepping back and not using AI, but because there's a real business need to drive it forward. And that's where I think that these organizations are really starting to listen to the market, listen to the challenges, and basically address those challenges and needs.
All right, Paul, thank you so much. Paul Nashvati of the Futurum Group. Good luck there at those big cap tech names. Appreciate it. Coming up next, the disruptors. We will focus on Snowflake. In fact, there was a bullish note out from Goldman Sachs. We want to hear more about the details, have an example trade for you. It's up about 4.25% today, and it was added to the conviction list there. So let's get more on that. We'll be right back.
Yep. Well, we'll take a good look at it tonight. Yeah, but it wasn't day one. It was the second one. But I don't remember the name, no. But day one was the first one. Yeah. Yep, bye-bye. do. Successful. I don't want to overtrade.
When you get market news, it's market on.
Right now we got a 1, 2, 3 on the SPY. So we're at that point.
Coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device.
We got a flag. Any minute. 1, 2, 3, 4. Then you got the 200.
Trading 360. I'm Nicole Fedelides, live on the floor of the New York Stock Exchange. Look at developing stories, and I'd like to bring in Caroline Woods, senior markets correspondent here on the Schwab Network. Taking a look at Chewy, which has had so much volatility. We saw that cartoon picture. Then we hear about a stake from Roaring Kitty. And now, now what? We're down 6% today.
Yeah, Chewy's on a wild ride. In the pre-market, it looked like it could open more than 20% higher. Actually was up about 6% at the open, so a significant fade. And now we've seen it totally reverse course and actually trade 6% lower. You mentioned the filings that showed that Keith Gill, aka Roaring Kitty, disclosed a 6.6% stake in the online pet retailer. He bought just over 9 million shares, so invested almost $250 million based on Friday's closing price. So that stake makes him the third biggest Chewy shareholder. And as you said, Keith Gill posted this kind of cryptic.
So he did get in Chewy.
Dog last week on X. It looked sort of like the Chewy logo, so it started the speculation that he was going to be buying shares of Chewy. That speculation obviously proved to be true. We should note that the SEC
Always clean as Jim.
section that read, check the appropriate box to designate whether you are a cat. And there was an X next to response, I am not a cat. So that was a distinction he made to lawmakers back in 2021 during the GameStop testimony during that whole saga. But it's not clear if Gill sold any of his position in GameStop to fund this purchase. But there is a big connection, of course, because GameStop CEO Ryan Cohen actually was the founder and CEO of Chewy. So I should note
what day was that again?
Also lower today, down about 6%. So not sure that GameStop shareholders liked maybe Keith Gill focusing his attention on another darling there. But we don't consider Chewy a meme stock. That being said, there was this note out from a Mizuho analyst warning against that meme stock label, saying that on a fundamental basis, it's not a meme stock, but the fact that it's could potentially be unpredictable and difficult to track the news flow could actually be a negative for Chewy. They said we're buyers of the pet food, not this level of volatility.
Yeah, we saw Petco's shares surge as well on that doggy image, so it was unclear what he was really getting at and caused volatility in other type names too. Thank you for all of that. And good luck there at Chewy today at 25.62. Caroline Woods, thank you. It's time now for our disruptor. George Sillis is with us, senior markets correspondent, taking a look at Snowflake, a bullish note from Goldman Sachs on Snowflake. Some of your thoughts.
Yellow, it's me again.
Well, Nicole, if you look at Snowflake,
it's all right.
last week or so, the stock is starting to wake up a bit. And there's some, I think, reasons why. I think if you look at what's going on in the AI ecosystem, we're actually seeing sort of a transition now, at least from a market standpoint.
Yeah, I put that on
into the
on this coming month's invoice.
One of these names. From an application software standpoint, that fits right in with the data
for June.
And of course artificial intelligence narrative. And
you don't want the previous month?
Itself,
that's the one to do, right?
Trading at a significant discount to where it was going back to 2021, around $420. It's down about 70%.
Oh, I thought we were a month behind.
Essentially, a buy point looking at it from the standpoint of Goldman Sachs. Their call is essentially that they're looking at a reversal here for Snowflake based upon the premise of major customer adoption.
Oh, this is July.
Oh,
never mind.
Okay. The hardware is
it's in June.
Significantly because we're seeing huge uptake in NVIDIA's GPU technologies and servers from Dell and Supermicro, but software application names have actually been left behind. Now, one of the things about Snowflake is it actually has a very unique technology that's very cost effective for major enterprise customers because it separates computing and storage, which is more of a value proposition. So with their call at $220, I think they're seeing some major customer adoption going forward. for Snowflake, albeit again, it's still trading at a rich valuation around 200 times this year's earnings, or 2025's earnings, and about 113 times 2026 earnings.
So at this point now, very curious how you would go about an example trade on this name.
Yeah, so one of the things you'll notice is, looking at a 2-year weekly chart, there seems to be an area of support that goes all the way back to January of 2023 last year. So I think that's an area that's interesting, to say the least, from a technical standpoint. The other thing is it's actually had a 2-quarter step down. In other words, it missed on earnings last quarter. It's pulled back once again. But the thing about it is it's still trading below its 10-week moving average. So I'm not going to be trend bullish until it breaks above that. And that's corresponded to the 50-day moving average. So we still have to be cautious here, but I think that support area between 125 and 130 may hold. So what I'm going to do is I'm going to sell a put spread. I'm going out to August with 46 days to expiration for the monthly contract. I'm going to sell a 135 put and then buy the 125 put below that. So it's a $10 wide spread. I can actually earn about $3 a credit per share or $300 a contract. So ideally speaking, the stock just needs to hold 135 or higher by expiration, and effectively that $3 credit will erode to zero. Break even is at 132, and max loss, just in case that occurs, is at 125, and that's $7 a share. So you're earning over 40% return on risk on this trade. And the last thing I'll mention here is it has about a 65% probability that the options will expire above the short strike at 135, and that's what we want.
Yeah. Wow. All right. Thank you for that, George Sillis. Good to see you. Appreciate it. Good look at our disruptors, Snowflake, today, up almost 4% today. Coming up next, our 360 round, we'll be focusing on alternative investing for the second half of 2024. We'll be right back here on Trading 360 on Schwab Network. We'll be right back.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech.
Trends? All that research sounds exhausting.
Nope, Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
It's time to look forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next-gen investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. Time for a 360 round. We're looking at alternative investing. Let's bring in our panel. Brian Glenn's with us, Chief Investment Officer at Premier Path Wealth Partners, and Ed Bukowski, Managing Partner at Chapwood Investments. Brian, I'll start with you. It certainly seems that alternative investing has become more and more popular. Would you agree with that? Tell me what you're thinking. And what are people focused on?
We definitely agree with that at Premier Path Wealth Partners. Most of our clients were probably at a 10% allocation right now. We'd like to move that up over time. I think in the endowment space, they were at the forefront of this years ago. They're seeing very high allocations, so we probably have room to double or triple our allocation. We're excited about that. And two areas we like are net lease strategies and traditional buyout PE.
Yeah, understood. What's interesting, Ed, is you talked about a few ideas of different ways to do this. You know, you're looking at equities, but in a different way. For example, you looked at utilities 2 times, right? The utility index, or 3 times, I should say. What's the premise behind doing some different things other than just picking the Mag 7, Ed?
Well, the Mag 7, are going to do what they're going to do, but you have to have diversity just in case the Mag 7 don't perform. And I do believe in the thesis that interest rates are going to start to drop, and when they do, you're going to want to be doing better than just the indexes. So that's why I look at utilities, and UTLS is a leveraged ETF that is 3 times the move in utilities. It's up 17% year to date. It pays about a 2% dividend. Isn't the reason you're buying it. You're buying it because you do believe interest rates are going to drop. The same thing with Labu, which is another 3 times leverage. And you're doing that on the biotech index. And as interest rates drop, it proportionally helps small cap stocks and especially biotech stocks very well. So those are 2 leveraged ETFs that I like quite a bit.
Yeah, and you also said managed futures. Just quickly explain that, Ed.
Yeah, managed futures is non-correlated to the stock market. So I like WTMF, which is Wisdom Tree Managed Futures, and WTMF
116, baby.
Basically, it'll trade.
We're at the 200 now. VWAP.
And then once that
it'll make up its mind.
Starts to show some sort of long in
SPY.
the tooth, then they'll go short the yen versus the dollar. So it's trend following, and it's never really trying to predict where things are going to go. It just looks at trends. And when you have any kind of stock market, you should always have managed futures in your portfolio. It's sort of like having a spare tire in your in the trunk of your car. You always want it just in case you need it, and you never know when you're going to need it.
Yeah. Let's talk more about private equity buyouts. Brian, you were looking at that and seeing popularity and demand. Clients are looking to do something different with their money, right? What are they really looking to do?
That's right. I think what clients want is they want exposure. They recognize that there's a lot of value being created in the private space. Companies are staying private longer. That space is being democratized. There's funds that are that you don't have to be ultra high net worth to get into. And so it's really bringing it to our high net worth clients, not just our ultra high net worth clients. And we think there's a misperception that everybody looks at, as Ed noted, the Mag 7 and the S&P valuation on a PE basis. And the reality is corporate buyout deals are not being done at extravagant multiples. And the other thing is private equity guys and gals, they can model in interest rates. What they're not great at is modeling in interest
Always
rates
clean
when
as
there's
Jim.
large changes that happen over 3 or 4 years. So newer funds, we think, have great advantages. They know interest rates are high. They're able to put that into their deal pricing, and we think these are going to be great assets. And finally, about half of private equity
Now my soup
comes from operational improvement, and so that kind of pushes that multiple issue aside a bit. And these guys are really operators. They go in, they operate them
A little bit of Terminate
better than when they bought it at inception, and that's where we think it's a little immune to the interest rate / multiple argument.
Yeah, and one reason you've been using net lease assets as an alternative, Brian, and you talk about the borrowing costs, and while we're not at all-time highs, we're certainly seeing rates higher than they have been over the last decade. And so when they start to come down and you're looking at these net lease assets, you think that will mean good news for investors, right?
I think so. So if you think about what a triple net lease or what a sale leaseback is, a fund or a buyer buys.
Buyer buys.
These are typically strategic assets, so manufacturing facilities, distribution centers. That's purchased from the corporation. The reason they're selling is they have a better use for their capital than having it tied up in a building. And then the fund buys it. The fund's able to put in a 20 to 30-year lease. So we're effectively locking in cap rates. If we agree with Ed, we think interest rates are going to go down in the future, and we like the fact that we can lock into these cap rates over 20 to 30-year terms with, by the way, 3% annual lease escalators, and that's a very attractive proposition for our clients.
Yeah, and I was thinking at some of those alternative investments that you talked about that were 3 times leverage to the upside, right, for biotech.
These guys look serious. Everybody's serious today.
I believe if the market pulls back, people are buying the dips and will head higher and such. Because if we're going to sort of hit a wall and sell off in a big way, that means 3 times to the downside, right? So there is risk involved.
Yeah, there's no question. That's the other side to this, is that if interest rates don't go down or if they go higher, you're going to be looking at, some
Jimmy called a little cup right here.
So you have to be very, very cautious, and you have to, buy off on
AMD.
Make a bet. I hate saying that. but
Apple
you gotta make
double
a bet that
topping,
interest rates
sending
are gonna
triangle.
drop. And when interest rates do drop, you're going to see both of those ETFs.
Amazon new high.
And Labu, LABU,
Meta at the 200
very,
SMA.
very well. So I wouldn't put a lot of money into it, but 5 or 7.
This continues, we can break out here
Isn't a real stretch to put
on
into
SPY.
those.
Yeah, Ed Bataskia, Chapwood, Brian Glenn, and Premier Path. Thank you so much, Brian and Ed, for being here today. Thanks for being with me. Fast Market is next.
I gotta go get my. Oh, I gotta go get those towels. Shit, I forgot. I gotta do that.
Latest commodity action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
So I'll be gone for lunch.
Young lady who was
I could drop my
30s, couple of kids, recently
counting
went through a
off.
divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
NVIDIA's in the green now. Boeing's did a good move today. It's like me going out as a custom picture framer and asking someone else to cut my frame for me after I give them the measurements. You don't know what you're going to get when you get back. The corners going to be the way you like them. You got to cut it yourself. I gotta go do that. SPY broke the 200. hike. Oliver, where are you, Oliver? Apple calls, swinging, scalping of July 5th strike at 2:15, in at 2:07 is now at 2:40, 2:47. We're double topping, so it could be an exit idea. Apple. Randy. Okay. I hate driving this time of the day, but I got to get them towels. 249. Hello, my name's Oliver Reynolds. I forgot this guy's name. Hike. .545 strikes are now at 144. That'd have been a pretty trade if I held all of them on SPY. $20 contracts times 60 bucks. Oh my. I got some of it, but not all of it. That would have been a nice tritz. Okie dokie. That would have been a good one if you held on to her. I'm just nailing it to the penny was pretty good for me. Looks like we creeped on down a little farther now. 8 cents. So I'm gonna go do my thing. Turbulence.
Now, that doesn't mean their market share has gone down that much. That's exaggerated when it comes to social media data, but it kind of gives you a little bit of an indicator about what people are excited about. They might be buying Nike, but they're not as excited as they used to be, but they are excited about their on-cloud shoes or their Hoka shoes, even Skechers. And so that's going to lead to more sales in the future. So this is kind of pointing in that direction, in the wrong direction for Nike. Alo Yoga, another one, Viore. I mean, there's a lot of companies attacking this very, very large market. And even though Nike's the dominant leader, it looks like they've gotten a little bit complacent and competition's taking advantage.
They went woke, you idiot.
There's no guarantees for the future. Nike's an enormous company, but we're currently sitting in the, Montgomery Ward building?
The old one, yeah.
Yeah, the old Montgomery Ward building. So you're not guaranteed an existence forever because large retailers or large apparel companies can go out of business and can dwindle over time. The question I have for you is, who's the real, they hit Lululemon stock on the Nike's earnings. So it's not like, their earnings report and their guidance that was so critical took down the whole segment, right? So who's leader? Who's stepping up? Is anyone really gaining track? A lot of these companies are significant, but they're still tiny compared to Nike, Landon.
Yeah, they are. And you know what? I mean, I think that what it signaled to me, at least, is that the number one in the space is seeing a lot of little nibbles at it, right? And it's kind of hard to predict who's going to come out of this on top. I mean, we talked about this with Lulu when it comes to Viore, and they're a tiny company compared, right? Very tiny. OnCloud is very small compared to Nike. But it's just the fact that there's so many of these small companies, and I'm sure there's tons that aren't public that are just coming after them, that it's just kind of painting a picture as an investor like, okay, we weren't the dominant number one player. We still are, but there's 1,000 little bites coming at us from all directions, and they are taking away market share. And one of those may become the next one to compete with Nike. So I think that's kind of the fear. From what we're seeing, OnCloud is continuing to do extremely well. Decker's Outdoors with the Hoka brands doing well. So those are probably the two I'd bet on. To attack Nike. I'm not going to say replace by any means. We're far from that conversation. But that's the fear, is that they're so big. It's like, what valuation are you buying in at? And as an investor, I'm gonna just kind of give you the other side of this. I mean, we're talking now about COVID prices, the COVID quick sell-off, and where it bounced back and all the stocks were crazy low. I mean, I think Nike got down in the high 60s, and we're mid 70s right now. So we're not far from that. And at some point, you say, okay, this may be a little too far. This company is still number one, and all it takes is a little bit of innovation and focus on quality, and they can regain all that momentum that they had. So, I'm not surprised to see the huge sell-off, but also at the same time, at some point it turns into an opportunity. And so, I'm not saying that Nike's going to be dipping in the 60s and 50s. I think that we're getting pretty low here, but I think it's well deserved. I mean, we looked into a lot of the consumer mentions. People are talking about poor quality. They're talking about how some of the shoes cut into their skin when they're running. I mean, that's obvious. That's like 101. You can't have that in your running shoe, right? So OnCloud has got extremely comfortable shoes, and Nikes are cutting people's feet. The soles are coming apart because of cheap glue. There's some quality and innovation problems that they've got, but they're still well positioned if they turn that around to ramp back up to where they were. So at some point, as an investor, you have to say, maybe it's all bad. All the bad stuff's priced in. This could be an opportunity. And when we're talking about COVID sell-off, that quick spike down, we talk about those price levels, then I start to get a little bit interested long term.
Yeah, March of 2020 was the low for Nike on that dip. Previously, 2018 levels at that point. But Landon, they've already come out and said that, hey, they're going to start innovating more, get back to the way that they were, where they were the leader in this space. Is that what maybe sets them apart where, hey, we've gotten this drop, it's down over 30% this year, like folio data has been dwindling, but that could easily reverse because it's the same level as Under Armour, and I don't think I've seen that ever in any of your data.
No, I don't think so. I mean, those companies have always been pretty fairly separated. But yeah, I think I think people are starting to see a lot of the smaller companies with the better designs and the better quality. I think that's the main thing, is the quality. And they're starting to not just love these other companies, but they're starting to say, wait a minute, how come Nike's not as good? Like, I've always been buying Nike. Maybe I need to buy less Nike. And I think that's what investors are really scared of, is that number one automatic default position of, if you need something, you go buy Nike. That's starting to just slip away a little bit. It's early, so I think that it's a warning sign to the company. If you believe in the management and the execution, they can turn this around, but it's definitely a wake-up call, and there's a lot of smaller companies out there just dying to take a bite of this huge market.
Yeah, and you said maybe it's an opportunity, maybe the Olympics is a catalyst.
Bring back the waffle trainer.
Yeah. I know Michael Jordan's still taking money from Nike for every
and
shoe.
Jordan was one of the weaker brands.
Yes,
in the earnings
for one of the first times ever, because he is the best basketball player of all time. All right, great stuff as always.
Great stuff.
Appreciate it.
Thanks, Shaq. Bye.
I knew he was going to say that. I had to get him. Thanks to Landon Swan. He's a co-founder at Likefolio. Okay, Kevin, you got a couple different trades to look at in here. Go ahead and
So
walk
there's
us
two
through.
things to think about.
Two things.
Is now a 18 on the RSI, sold off to levels that you and Landon were talking about. If you wanted to put on something long term in Nike right now, the easiest thing to do, or the most basic, the most 101 thing to do, is buy the underlying, do a covered call strategy, right? There's the first thing you can do. So you buy the stock, sell. I went out to the July 12th expiration, sold the 79 call against buying the underlying stock. And in the next 11 days, that's 55, it was trading about 55 cents. The whole package was trading about 75 cents. It's trading right at $75 right now.
Right.
So it's the exact price.
Yeah, well, I think we had 74.80.
Yeah.
It's come back a little bit. Yeah.
So $75, you buy the stuff, and then you can still capture the dividend, which is about 2%, just under 2%. Now, that will cost you about $7,500 to hold that, right?
Mm-hmm.
You buy the stock, you sell the call against it. You've got some theta there. What if you want to do something like this, Tom? Instead of buying the stock, if you're okay with not collecting the 2% dividend, but saving money, buy the September 20th expiration 75 call and sell next week's July 12th 79 call. That's trading, I put it in 350, it's trading about 358 now, I think right around there, so under 360, but that's still a lot cheaper than you can do for the covered call. Now, you don't get the dividend. There's always going to be trade-offs here. But in terms of delta, the covered call's got about a 79 delta, and the diagonal has about a 36 delta. So if you did two diagonals, the delta would be about even, and you're still doing it for a fraction of what the covered call strategy is. Now, make sure you understand, you don't get the dividend with the diagonal. You do get it with the long call and the covered call strategy. So these are two ways to look at basically a similar profit graph in Nike.
Yep. Let's see. We've got the call diagonal up there first, so let's take a look at that. September option, so 81 days to expiration. Got duration, nearly 3 months in that one. Buy that 75 call, that's at the money. Sell the 79 call in the July 12th weekly options that expire in 11 days. 350 debit, there's your risk, $350 per spread on that. And your break even about around that $76 level, because you'll have opportunities to roll that short 79 strike call in the July 12th options repeatedly, because you got a longer duration and you're buying Vega on that call diagonal. That's one way to play to the upside. And it's not like you're expecting an explosive move. You're paying them $350, so less than the width.
Apple's kicking ass.
Everything above that break even will be potential profitability, but it's not like you're expecting this thing to rally back to $85 or something like that. So it's a conservative grind higher on that one. And now let's flip it over to the cover call strategy. As Kevin mentioned, for every 100 shares of stock you buy, selling out of the money call. In this case, Kevin used the July 12th weekly, that same 79 strike call, and you're paying roughly about, we got 74.80 on here. It's trading about $75, so about $7,500 in risk if the stock were to go to zero. Remember that. If you own the shares, you get to collect that dividend, as Kevin mentioned, if it gets paid out. Most likely it will, but there's always a chance that they could cut the dividend. But you got to keep that in mind. It's a lot more capital intensive to do the cover call strategy. But as you get closer to July 12th expiration over the next 11 days, you have that ability to roll or adjust that short call too.
In both trades.
Yeah, on both trades. You've got some adjusting that you can potentially do if the market's open, so keep that in mind. But you get to collect that yield that's created by the dividend on the cover call strategy. So two different
Always
ways
clean
to
as
look
Jim.
at same directionally biased type of trade.
Same idea, one using stock, one using options, and we highlighted the differences between the two.
Yep. All right, great stuff. Let's take a quick break. When we come back, we're going to take a look at DoorDash. Delivery stock has rallied over 40% over the last 12 months, but has been trending lower since that earnings event in early May. Stick around. Fast Market's coming right back.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com on all your streaming devices. Schwab Network is available anytime, anywhere, on any device for free. No place better than the Schwab Network.
Here on the Schwab Network. Before we take a look at DoorDash, let's bring in Ben Lichtenstein, Senior Futures Contributor here. Benny, stocks up a little bit, but I wanted to focus on oil here. We're hitting levels we haven't seen since the end of April. Is this, geopolitical risk, or is it demand? Because I haven't heard any rumblings that demand's picking up.
Yeah, I think there's probably both and a couple contributing factors on the technical side as well. To your point earlier, stocks just off those all-time highs that we saw last week. S&P's down off that high today, about 77 points on their low, down around 54.46, and you saw the NASDAQ about 440 points off that all-time intraday high from last week. NASDAQ down to 19,577, but recovering some, and crude oil has been on the move higher, Tom. I think it is expectations that we're going to continue to see strong demand. We have seen production cuts from OPEC, which saw kind of a counterintuitive reaction to about a month or so ago, and now it feels like it started to kind of kick into gear throughout the month of June. We saw rallies in crude oil, $10 basically, from 72 up to 82, starting off the week above the 83 briefly. Last I saw up to 83.02, but again, just really continuation of the trend it looks like and the trajectory to the upside. I would have been a little surprised to see it completely reverse or turn around to begin the month of July, considering again that it's been rallying for the last 4 weeks straight.
Yep, inflationary pressures may be coming back on those higher crude prices. All right, thanks to Ben Lichtenstein, Senior Futures Contributor. But now let's bring in George Tillis, Senior Markets Correspondent. George, we're talking DoorDash. Stock's fallen since that last earnings event at the beginning of May, but at a key level here, right at the 200-day moving average. It seems like it bounced off it. What do you got for us on DoorDash?
Yeah, you're right, Tom. And first, if we look at the technicals, it's starting to look constructive here after it's pulled back about 20 or so percent, going back to late March, where it was trading around $140. And you mentioned, 200-day moving average or 50-week moving average. It seems to be respecting that area. But, I think DoorDash is starting to look rather interesting here because overall in the last year, it's still higher by about 40%. Like I said, it's down in the past few months about 24%. But I think the challenges for DoorDash are really a margin compression story. One of the things about DoorDash is they are expanding quite aggressively. They operate in the United States about 66% market share in food delivery. They're expanding into other non-food items, which include things like retail, apparel. They also have a partnership with other retailers like Lowe's, for instance, home goods and accessories, health and beauty. So they're expanding quite aggressively. And with that said, it's costing them quite a bit of money to do so. And I think that's also one of the reasons why the stock is at the downside. But nonetheless, I think what's happening here is the competition is either being acquired or essentially being weeded out. Now, Deliveroo is essentially a UK equivalent to DoorDash, and there's some talk about the acquisition of that by DoorDash. And I think it's putting some pressure on the stock because it may be dilutive slightly to essentially core equity. But I think at the same time, we're seeing the development of an oligopoly here. You have to think about Instacart, Uber, and DoorDash. They're essentially encroaching on the total market share for food delivery, but also grocery delivery. I think this is important because, you're adding essentially additional revenues with additional sales, but you have to think about the cost of the driver and all the maintenance associated with that is still borne by the driver. So there are some cost challenges which are expanding their business, driver pay, but at the same time, there's quite a substantive earnings growth estimates for DoorDash relative to the slight miss on last quarter's earnings, and the stock fell commensurately.
George, they have about 66% market share in the U.S., 25 other countries, but 90% of their revenue comes from the U.S. Is there a market in other countries for DoorDash? Is this something that's going to make it across to these other countries, or is this are they going to have trouble growing other places?
So that's the thing. In order to grow in other places, they're going to grow through acquisition. And I think that's their strategy, which may essentially be a good one because it's tough. Once a brand gets set in terms of recognition in another country, it's hard to essentially compete. So I think they're going to be buying other brands or other companies like Deliveroo in the UK, which also operates in 10 additional countries. And that's their strategy. But that's going to be costly. And I think that's what's putting some pressure on the share price. But one of the things I will say here is the gross margins have pulled back a little bit compared to their 5-year average. The EBITDA margins are negative 5%. Operating margins are again negative. But if you look at the earnings for the last 2 quarters, they lost 44 cents. But for the full year of 2024, they are expected to earn $2.74 with about an 85% increase to $3.81 going into the following year. So right now, the growth trajectory seems positive, and it's only trading around 28 times 2025's earnings. So maybe this, 50-week moving average, or as Tom alluded to, that 200-day moving average, which is very equivalent, may hold for DoorDash.
It's so obvious that it's sitting right there.
Yep, bounced off at 107 basically is that area there. All right, great stuff. Thanks to George Tillis, Senior Markets Correspondent here, breaking down DoorDash. And, I looked at it just because of that slide and because, Kevin, of those levels on the technical basis. RSI is down to 37, so getting close to oversold at this point. But, as far as competition, Uber just announced a partnership with Instacart. So they're expanding their footprint, trying to dig into DoorDash's. If you use DoorDash, the amounts that I've watched a couple videos where, like, a small pizza owner, he talks about how much they take, how much of the cut, and the fees, and it's just, you think with inflationary pressures. So
everyone thought that this would be a flash in the pan during COVID, and it would eventually go away. So they've been incredibly resilient that they've made it this far, in my opinion.
Yep. So I looked at a strategy that if you think it's going to bounce and stay bouncing off of this 200-day moving average, that 107 level is a base case. Here's a strategy that takes advantage of it to the upside. So going out to the July 26th weekly cycle. Now they've got earnings on the 1st of August. So I'm avoiding that with this example trade here in case we see a grind back higher into that report. And then you avoid that event risk that they had last quarter where they gave softer guidance because they're still growing, but the growth rate has slowed, Kev.
They don't like that, as you know. Decelerating growth, no bueno.
Not when you're not profitable yet.
Yeah, no.
And that could be another catalyst to the upside if they turn profitable on EPS this quarter. But going out to the July 26th weekly cycle, so about 3.5 weeks till expiration. Buy one of the 106 strike calls, sell two of the 111 strike calls, and then buy one of the 112 strike calls. Basically buying this call butterfly to the upside, unbalanced. Paying roughly about $1.90 debit we've got up there. That's your risk. It's trading closer to 205 at this point, but if you pay that $1.90 debit, there's risk, $190 per spread, with that break even of 107.90 to the upside, Kev.
Yeah. $5 long call vertical, financed by a $1 short vertical. It's small, it's tight, you can see if this is a bullish move in DoorDash that insulates you from losses on the upside if it were a run. And looking at the chart, it's a very compelling case to look at this stock right here if you're bullish. Right?
Right.
If it breaks through there, it's a whole different story. But certainly a level in the stock where activity will probably pick up as it hits that 200-day moving average. But so this is one inexpensive way to do it because you're financing. You've got your direction, and then you're doing it for the cheapest cost you can.
Yep. When you look at this, instead of buying maybe the vertical on the 106 strike up to the 111, it's going to cost you a little bit more money. Now, you're profitable, apex profitability at the short strike, at the 111 strike, but then even if it goes above 112, it's going to be a double on this as far as profitability goes. So offsetting some of those costs, as Kevin said, when you combine the two strategies to create the unbalanced butterfly, reduces your risk and cost on that particular strategy. All right, that's going to do it for us today here on Fast Market. But stick around. Coming up next right here on the Schwab Network is Next Gen Investing.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere,
on any device for free.
Schwab Network, empowering every investor and trader
every market day. No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education crafted just for traders. All so you can trade brilliantly.
young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Alex, some strength to start the week with the only laggard being here, the Russell, which is actually down about 0.8%, but modest gains led by the NASDAQ after we closed out what was a really strong first half of the year, no doubt about it. Last week did see some selling into the end of last week, but I mean, still, S&P was up around 14.5%, I think, through the Friday's close so far this year.
Yeah, it's deja vu. Like the last 2 weeks, basically every day has been very choppy intraday, but we've largely gone nowhere. One thing that's been consistent, though, on these strong market breadth days, said another way, when a lot of stocks that make up these indices are doing better, you've actually seen the market do a little bit worse. Today, no different. Only about 110 S&P 500 names higher on the day, but you got a green S&P 500. Only 35 on my last check of the NASDAQ 100 names higher, but you got a green NASDAQ. So more stocks do well. It's been a recipe for bad news for these markets. More stocks do bad. Good news for the markets. Make that make sense.
Okay, to speak to that, I actually have a good stat on that. The top 10 stocks in the S&P 500 in 2023 was around 27% of the overall indices. So the 10 stocks were basically like the entire, a third of the index. That figure is almost 40% through the end of June. So the top 10 largest holdings in the S&P right now are dominating the index. And I think that speaks to like NVIDIA's momentum.
Yeah, no doubt. I mean, I don't want to make this too much on the macro, but I think you can make it make sense. On these yield-driven sell-offs, they've been short-lived because it's actually, I could argue, beneficial for those biggest companies. Why? More interest on cash benefits you if you have cash. Those companies have tons of money, but it also hurts companies that don't have cash, their competitors. So their competitors, it makes it more expensive for them to catch up, and they get paid interest on their cash pile all the while they're watching their competitors struggle.
And that's, I feel like, we started to see, especially since we started June, really the dichotomy of those like high-performing names that continue to grow and those that are falling behind and falling significantly behind. But to step away from the macro, as always on the show, we will focus on the individual movers. We'll kick things off with upvote and downvote. We'll chart and trade those upvoted names. For FOMO today, we're actually looking at a ridiculous move here in Chewy. As shares were up 20% pre-market, now are lower on the session after Roaring Kitty did disclose a 6.5% stake roughly in the company. So volatile day for Chewy, no doubt about it. We'll also be looking at overall Meta Platforms, which did snag now a new street high price target of $600 a share from Raymond James. So some optimism there. We'll end the show as we'll talk about a very interesting name, another volatile name, that is the DJT, of course, which is very closely linked to Donald Trump. Various headlines that are impacting that stock today, but shares are higher, at least as of right now on the session.
Yeah, I'll save my thoughts on both of those for those segments. Have thoughts on both, particularly the Chewy story and maybe why the move makes sense. We'll do that during FOMO. Let's do upvote, downvote, not endorsements, not recommendations. A little bit of a media theme, I would say new media theme here today. With some of these new shows that are popular coming out with new seasons, thought it'd be fun. Let's start with parent company of Max, formerly HBO, etc. That's Warner Brothers Discovery. House of Dragon is the season 2 seems to be getting Americans excited for Sundays.
I definitely feel so, especially because right now I feel like we are in a very like sports light time in like the overall season. So it does feel like this gives you something to look forward to on Sundays, as we are not yet in the NFL season, which that dominates my Sundays usually. But as a result of such the popularity of course, the House of the Dragon show, Max actually did unveil this 7-day free trial that ended June 23rd, but that was sort of gearing up in time for this new season of House of the Dragon, which returned, of course, on June 16th. But the max ad-supported version's price is unchanged now. It's around $9.99 a month. Max's ad-free tier in the U.S. has risen by $1 to just around $16.99 a month, and the ultimate ad-free tier is now around $21 a month. But all of these names, I think that it's important to tie into the Summer Olympics, which will begin, of course, on July 26th. Peacock is the biggest beneficiary of that. Just naturally, they have the massive rights. They spent about $7.8 billion on those rights, so they should be the biggest beneficiary. But right now, we've seen some of these rivals, like a Warner Brothers, start to pare down their new content, I think, as to not compete with what is something that's very heavily viewed typically in the U.S. And actually, I didn't realize this. I did realize the last Olympics was in Asia, but the last 3 Olympics have been in Asia with 12-plus hour time differences here. Now being in Paris, there's the thinking that we could see more viewership spike again because of there's just not as massive as the time difference. But last Olympics, you were watching it on a horrible delay. Now it could be like mid to late afternoon.
I will be shocked if those viewership numbers surprise to the upside. I don't know a single person excited about it. Maybe I'm just a hater. All right, well, we got one, so there we go. That can neutralize me a little bit. I don't think they moved the needle the way they did 20, 30 years ago. I think there's other stuff I think more people watch House of the Dragon in the U.S. on Premiere than watch Olympics. I mean, that might be crazy. I might be way wrong, but that's how I feel about it. Let's talk stock, though. This is the exact kind of stock that struggles with interest rates higher. They're trying to reinvent themselves, tons of debt, higher borrowing costs, kind of rolling that debt, trying to figure things out, not that tenable when yields are moving higher. So it makes no surprise to me that this stock's down 3.6% on the massive move lower in bonds, higher in yields here today. Next one is a name that benefits a lot from sports, for a sport that actually gets watched, and that's the NFL and football. That's, of course, parent company of YouTube TV, which has those rights to the Sunday NFL Ticket now, which is Alphabet. And the funniest thing about this, I'm not even sure if YouTube TV even moves the dial for Alphabet. That's how big this company is.
I know, it's remarkable. And I feel like for a while we were calling it like a social media network, but I would say it's definitely more of a streamer to me. I mean, maybe just my take on it. But I think that people are catching on how dominant YouTube is in terms of like ruling TV. Actually, the video platform did dominate streaming in 2023 as far as like overall numbers go. It's slightly ahead of Netflix. So it's also, I think, done a really good job pitching itself as this like one-stop shop. Of course, there's great NFL viewership. You can also get access to other streaming services like Showtime, Starz, Paramount Plus through YouTube, which is a great way. It's like a landing page now for all these other shows that it redirects you. But it's also the most used Android app after TikTok, with users citing an average of around 28 hours a month. It's also estimated to have the biggest social media advertising audience with around 2.5 billion users per month as of January. And in streaming, which streaming now accounts for about 40% of the overall TV viewership time, YouTube has been winning hands down for quite some time. I mean, 12 months in a row it has dominated according to some data I was reading out of Nielsen. So we talk about Netflix being king, but YouTube TV, or just YouTube in general, just quietly being so dominant. Anyone that uses it, I think, can speak to that because it's amazing.
Yeah, I think YouTube TV, related but separate. YouTube to me is far more individual content creators, podcasts, short films, funny things, things like that. YouTube TV is streaming cable. Let's just be fair. It's a little bit cheaper. You get it on your mobile device as well. And what is the one thing that streaming hasn't disrupted entirely? It's been sports. So they have a huge deal with Sunday NFL Ticket to incentivize you to do business with them for your traditional cable. I think that's a massive thing. But also, you know what else they have? They're the king of search. They sit on a ton of cash. So this is the exact kind of chart that does well in higher interest rates too. So there's a lot of things going well for Alphabet. It makes no surprise that this is essentially at all-time highs.
I think it's just plain old YouTube that is like what I get in rabbit holes on. You could watch videos on that for hours. It's like the documentaries are endless. That's what sort of draws me in. But next name today here is Walt Disney. And Walt Disney is, I'd say, still streamer, but also still has that massive, of course, like physical presence in terms of its parks and its merchandise, which is still a huge portion of its revenue. But this name, the popular title as of late, is The Bear, and Inside Out 2, as it did rake in around $1 billion in box office sales. So we did see that was the top domestic box office performer for the third weekend straight, as Inside Out 2 did become actually the first film of this year to top that $1 billion threshold. It's also the fastest animated release to ever gross $1 billion. It did so in only 19 days. And it's the biggest box office haul we've actually seen since Barbie, which of course came from Warner Brothers Discovery. They hauled in around $57 million this weekend, an estimated $470 million cumulatively in the US and Canada through Sunday. And I have to say, this isn't moving the needle at all, because that's what's so frustrating about Disney is we'll talk about these great box office weekends. I mean, Barbie was another one where it just didn't move the needle. So good for Inside Out 2, I guess, but Disney shares are down 1%.
I've heard it's a great film too. I just recently saw the first one. It was pretty good, so I heard the second one's as good or better. They also have the kind of the verticals though with their parks and merchandising and things. They could continue to monetize this brand going forward. So it's important to have successful launches for the company. But also the Bear, the Hulu, and all that. That's another really popular show. But this might just be one of those ones that it's sort of stuck in a flux. They're trying to figure out how to make things work in this new environment. They've been so disrupted by Netflix. And the parks business is so discretionary and so expensive. We talked about how much it costs to build these rides a couple weeks ago when we were talking, I think it was maybe Cedar Point and Six Flags.
Oh, yeah, like $10 million a ride.
For like one, yeah, or $20 million for like one roller coaster. So you look at that high overhead costs, trying to kind of find where they land in this modern economy. It's been a tough go, but this is largely what Disney is. It wasn't until Disney Plus and the pandemic that you saw huge swings in Disney. Disney was sort of like this $90 to $110 stock for like 10 years. And then it had Disney Plus and went crazy and was really volatile. But we're sort of just back to that blue chip kind of sluggish sideways activity.
Yeah, and I guess it is still higher on the year. So like in spite of the fact that we haven't been able to return, I mean, to 52-week highs, we've still been able to hold on, at least as of late, looking like a better Disney than what we saw through the end of 2023. But last name today is, of course, the behemoth in all things streaming as far as some of these more traditional streamers go. That is Netflix, which is up around 38% on the year. It's pulled back almost 3% from its 52-week highs. It still remains down over 4% from its all-time high, which it's actually nearing, I'd say, more rapidly than I was even paying attention to. But despite some of the overall like Olympic buzz, Netflix still does win on a month-over-month basis as far as like attracting the masses, and it's leaning harder than ever on its annoying habit of breaking up its popular series, as it is expected to unveil the 6th and final season of the Karate Kid spin-off Cobra Kai, which was split into 3 parts. The first 5 episodes will drop July 18th, with more coming in November, and the remaining ones coming in 2025. Also Suits, which has been this massive hit on Netflix, of course, as of last year. Viewers probably didn't even realize that there was a season missing, but that will soon be rectified as the 9th and final season, which previously was available on Peacock, now coming to Netflix as of today. So there's several new shows that are coming now in the month of July, but this is something they do where I cannot stand. I know it's like now, I think, a way to continue to obviously have you pay if your season is more prolonged, but it's annoying. I cannot stand the release in like chunks like that.
Netflix has so much content on its service, and it comes out with so much content regularly that I think unless you're in a pinch, Netflix is not really getting canceled. So I look at it as like, you know, Apple comes out with something new, maybe I subscribe to it for that and I cancel it right when I'm done. Hulu, maybe the same thing. All these others, it's almost like I go when I need to watch something. Netflix is just the one you keep. And I don't know if that's the same for everybody, but it seems to be the case. I think they know that. And so I think they've extended their releases out a little bit. They're not quite, plastering up quite as much content on the wall as they used to. But it's run into a little bit of overhead resistance. The all-time high was at 700. I don't know if it's breached that yet, but we're right there. And I think that's why maybe you're seeing a little bit of selling today.
Yeah, modest pullback today, and I agree. I held off on Netflix for like 6 months after I was kicked off my family plan, and then I resubscribed, and I can understand the draw. It's sort of like the pop culture of all things streamers. But we will be diving more into the technicals of Warner Brothers Discovery as well as Walt Disney, as well as looking at some example trades in both of those media names. Stick around, Next Gen Investing will be right back.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're gonna always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's time for our Chartmaster segment. So today, to discuss Warner Brothers Discovery as well as Walt Disney, I'd like to welcome in our Chartmaster himself, Rick Ducat. So Rick, we'll start off with the worst of the two, and that is honestly not my opinion at all. That is a very, very clear, I think, analysis by looking at both these charts. I mean, Warner Brothers Discovery has been one of the most disappointing, if not the most disappointing, in the streaming space this year.
Oh, for sure. I mean, objectively worse than our other chart here, because you can just see we're down from our highs on the year, 1476. We've lost more than half our value here. So we're down 51% or so. We can see that our blue trend line here, a series of lower highs here. We had earnings a couple quarters ago. From that point, we can draw this shape here between our two white dashed lines. Now, it's a little bit hard to see here, but these two lines are not parallel. They're actually diverging apart from each other. Both trending down, but kind of not really going exactly in the same direction here. That gives us a more difficult trading pattern to cope with here because our two potential targets are moving farther and farther apart from each other. Just kind of a more difficult situation in general here. But we can see as well, we're below all three of our moving averages that we typically follow. Yellow 21-day, orange 63-day, purple 252-day, exponential moving averages. All three of them are pointing downward here. Things are much more biased toward the downside based on these indicators. Now, we do have a low point here that we really need to keep an eye on. We've got our yearly lows near 694, just below the $7 mark. If we start moving beyond that point, that could be getting into some dangerous territory, making new lows here on a stock that's already gotten beaten up pretty badly. But, you know, unfortunately, just because you're low doesn't mean you can't go even lower.
Absolutely, and we know that to be true for so many of these names. At $7.18 right now and down 3.5%. As we just know from these prices, you think like, oh hey, you know, maybe we've bottomed, but calling for a bottom in these names can be almost impossible. So as far as the momentum goes, are we seeing RSI also match this downward overall price trend we've seen?
So what we've got here in RSI is a situation where, on one hand, we've got a series of higher lows, a very modest sloping upward trend line in green there. That happens typically when the RSI dips below that oversold threshold of 30. Typically, we make a recovery very quickly based on the past few instances of this happening, and we recover a little bit here. So we just had that situation that, with our quick departure from the into that oversold area and then the recovery here, but we also have a situation where we're making lower highs as well. So we've got kind of two competing trend lines, kind of a more very modest triangular shape here. Overall though, we're below the 50 midline, prices falling. RSI is not looking super strong at this point here. So momentum more geared toward the downside, especially when you couple it with our situation of our moving averages and our trend following indicators and our just general lines that we're drawing on this chart. Things are more geared toward the downside.
Yeah, and I think very apparent from like the continual breakdowns and continual gap downs, frankly, in the recent trends. But now, as far as some support and resistance, what levels are you watching here for perhaps some degree of optimism, or just levels we'll keep on our radar?
Volume profile can help kind of flesh out things here by showing us the areas of heavy trading here. We can see that we gave up the volume profile point of control. This thick red line here near 850, that was the area of heaviest trading on this chart. So we had this whole kind of sideways period right here. That was a key area that we have given up. We've fallen below that point. We're below our moving averages. Now, we've also included this blue line, our linear regression line, our line of best fit based on closing prices. This is another support or resistance point. It looked like we were perhaps peaking above it yesterday, but today we have faltered once again here. So now, we use this linear regression line to give us a potential support point here. So if we were to make new lows, break through those yearly 52-week lows there, the -1 channel comes in near 550. So that could be an area to look for price to find some footing here. That would be a severe drop at this point here. But, you know, I'm not saying this is going to happen. I'm just saying, based on our relative history, this is where a trader could start to potentially look for some support. To the upside, we'd want to break out beyond this ceiling that we have here, this red dashed line near about 860. So that coincides roughly with our point of control. So breaking above 850, 860, that would be a key point for traders to look for some additional upside.
Yeah, the one good thing I guess you could make the argument is with shares have been beaten down so badly, they're perhaps a little bit more on sale than levels, obviously. I mean, previous 52-week highs that are on $14, we've been basically cut in half. So with this in mind, say you were optimistic about all things Warner Brothers. Walk us through a more bullish leaning example.
I think you highlighted a key point, which is this could be a value trap. It could certainly go lower, but it's a relatively lower volatility name. It's a lower price name. I think the first thought for many is perhaps just buying stock as an investment if they believe in this company. But I did want to look at an option strategy that's a little bit more capital efficient that can seek to mimic a comparable risk profile, at least to the upside, using a call option purchased in the money and a little bit longer dated. So in this particular case, the stock was trading around $720, $725 at the time. I looked at the September $5 call for a $220 debit. This is basically trading for almost no extrinsic value and nearly moving penny for penny with the stock. So with that, instead of taking $720 in risk to buy 100 shares of stock at $720, you take $220 worth of risk with this call option, but still perform comparably to the upside where you have theoretically unlimited upside. So this would be buying the call to mimic stock performance, be a little bit more capital efficient, and of course risk defined. Not a lot of strategies on the table when you got a stock that's this low priced, this little volatility.
But of course, profits are unlimited with this strategy. So
yes.
you
want the stock to go higher.
Yes, nothing but upside you'd benefit from here. So you hope for some recovery, as I think we're all in hope of recovery when looking at Warner Brothers Discovery's start. But now, definitely a more promising chart. We pulled back substantially from 52-week highs, but we are still up almost 9% on the year. So I know we're lower today, but Disney is at least what we saw was attempting to make a recovery. I know it's right now looking pretty grim because we've pulled back so substantially, though.
You know, you can't argue that this chart looks better than our previous one, but the price action recently since our last earnings event, not very good here. You know, you can see that we had this sharp appreciation in price. We topped out just shy of 124. Since then, trending downward here. We had a significant gap down on earnings. That gives us our ceiling to look at, this red line near 108 here. But, you know, we've drifted below all three of our moving averages that we follow. The faster ones are crossing below the slower ones. You can see right here, our 21-day in yellow is on the verge of breaking below our purple 252-day. Now, this is not the greatest trading signal by itself here, but it's an important, easy sign that you can use to see which direction things are going here. So, additionally, we have this green line here. That represents the high point that we had before our gap up from earnings back in February. We touched on that point. We filled the gap recently. Now we're breaking through it. We tested it on Friday, and now we're getting a drop below those previous lows here. It's looking like it could be a difficult situation to recover from during this trading day here. So moves to the downside here, kind of falling apart here.
Yeah, I mean, totally falling apart. I don't think I realized the extent in which we've fallen apart as of late. So is now momentum RSI matching this recent selling we've seen?
Momentum was improving recently here because we have this situation where we were trending down for a while here. You can see that red line there. We were below the 50 midline, but we started to kind of get our act together. We saw a little bit of bullish divergence here. RSI was making a higher low as price was making a lower closing low here, but it was not to be. We had validated our trend line. We never quite made it above that 50 midline either. Now we're almost at the oversold area once again here. So a break below support and across into the oversold area on the RSI at the same time. That would not be what the bulls would want to see. That would be a much more bearish signal.
Oh, yeah, no kidding. And now as far as like some levels we're watching here, I mean, we're in a very catalyst light time right now as far as these individual equities go, because we don't have earnings for quite some time, but Disney moves. So what are we watching as far as some key price levels?
Yeah, you know, I looked at this one carefully because once you start getting below current price here, there's not a lot of clear support. So what I did was took a look at the 93 area, this light green line here. This was kind of a sideways price action area. Then we topped out at that point, we crossed above it, and then we kind of bottomed out near that same point here. That represents a low point during our rally here. So that seems like a place where we could start to look for some potential support if things really start to fall apart here. Notice as well, this is a more low volume area here. Our volume profile doesn't have a lot of trading in this range between about 93 to 100. So beware of fast moving prices if we start to get into this area here. Now, when we look to the upside more, we've got a confluence. We've got our two moving averages that are basically right on top of each other, and they line up with this volume node, this spike on our volume profile study here. That comes in right around 102. So that could be a key resistance point for price to overcome and rise above there. But ultimately, we'd want to break above the post-gap highs near 107.88. That's the mark to beat to really reestablish some kind of uptrend.
Yeah, a lot to think about here, especially on a day, and we're down about 1.3% in Disney shares, so appreciate the insight. As always, Rick Ducat, our chart master, and now we trade this name. So the chart looks better than Warner Brothers Discovery. I don't know if that's necessarily the bar you want to be at as far as like performance goes, but say looking to also lead into some optimism because Disney, as we know, this is the nature in which it trades. It feels like it's the constant giveth and taketh.
Yeah, and perhaps you think that the launch of that new film, its debut, and it's over a billion tickets or dollars, whatever stat you had for me, Jenny, earlier, where it was the most successful film thus far in 2024.
$1 billion for the first time this year, yeah.
There you go. And then, of course, The Bear, its success on its Hulu platform. Maybe you think that there's some optimism in Disney. And so going into the summer, seasonally strong period of the time right now. So perhaps some things working to the advantage of investors, looking at a neutral to bullish strategy, though, risk defined, selling the August monthly. Now, this will capture the earnings event, so maybe a trader who establishes this may have within their mind that they seek to close this before earnings, even though the expiration is after, but just something I wanted to mention. 95.90 put vertical for $1.35. Now, the more credit you could get, the better, but at $1.35, you have $135 in max profit, and you have a break even at $93.65 on your $365 in risk. That $365 in risk is below 90, max profits above 95, and of course break even. That's pretty straightforward. Stay above that at expiration, and this theoretically can make some money.
Yeah, and hoping to see some upside here. As Rick pointed out, the chart just looks brutal as of late as some of the selling has started to pick up, but maybe momentum showing us some signs of optimism. We will leave it there for our Chartmaster segment, though, today. Coming up next, it's time for FOMO. We are looking at Chewy, and we are revisiting the conversation of all things Roaring Kitty, as that figure did disclose about a 6.6% stake in the pet retailer.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab investing themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360. Only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
I'm Nicole Petalides, host of Trading 360 and The Watch List, live on the floor of the New York Stock Exchange, where we bring you breaking news, experts, CEOs, influencers, and analysts. It's all available on Schwab Network.
Next Gen Investing, it's time for FOMO. So today we are looking at the volatile day that Chewy shares have had as they were up 20% pre-market, now down about 3.7% in real time. Here to discuss more on this stock today and its movement, I'd like to welcome in Caroline Wood, Senior Markets Correspondent for the network. So Caroline, this is tied to, of course, Roaring Kitty, which I have to say that there's no better conversation to tie in with Roaring Kitty than Chewy. I mean, like, the name is so fitting. So walk us through everything that happened we saw over the last several days.
Hey there, Jenny. Yes, we're looking at shares of Chewy. They're off earlier highs and lows. As you said, it looked like shares were going to open more than 20% higher. Very early on, they were up about 6%, then down about 6%. Now they're down just a little bit less than 4%. This follows the filing showing that Keith Gill, aka Roaring Kitty, disclosed a 6.6% stake in the online pet retailer. He bought just over 9 million shares. So based on Friday's closing price, that was about a $245 million investment, making him Chewy's third largest investor. Roaring Kitty, of course, last week posted that cryptic photo of a cartoon-looking dog on X. It looked sort of like the Chewy logo. There was speculation that it meant he was throwing his support behind Chewy. Shares were very volatile, surging more than 30% and then parrying those gains. That speculation obviously proved to be true. I will note that also sent shares of Petco, Woof, higher. Those are actually down about 12% today on this news. But going back to the big stake in Chewy, the SEC filing also included a section that read, check the appropriate box to designate whether you are a cat. And there was an X next to the response that read, I am not a cat, just in case you were wondering, Jenny, about how he identifies. That was a distinction he made to lawmakers back in 2021 during the congressional testimony linked to GameStop. But it's not clear if Gill sold any of position in GameStop to fund this purchase, but of course there is a big connection because GameStop CEO Ryan Cohen was actually the founder and CEO of Chewy. So I should note that GameStop shares are lower today as well. They're down about 6%. Makes you wonder if they're not too happy that Roaring Kitty has another favorite retailer in Chewy. You know, Chewy is not a stock that we talk about as a meme stock, but it's obviously been trading like one since this cryptic post from Roaring Kitty last week. And I will say that there was an analyst over at Mizuho that really warned about the meme stock label, saying that Chewy is not like a meme stock in terms of the fundamentals, but it has an unpredictable and difficult, the unpredictability of it, and also the fact that it's kind of hard to track the news associated with it could be a bad thing. It could mean less institutional investors, a hesitation to own shares, or really it could increase chances to exit shares, as saying we're buyers of the pet food, not this level of volatility, so keeping a neutral rating on shares. But taking a look, shares are down about 3.6% right now, so they're still up about 11% year to date, but definitely not performing in a way that it looks like they might at the start of trading today.
I think the price action in the three names you discussed, Caroline, makes sense, right? GameStop, this is Roaring Kitty's capital going somewhere else. Petco, it was still kind of caught up in the speculation. Turns out it's not Petco. And then Chewy, it kind of is different. I mean, to your point, it's not these classic meme stocks, but also this isn't Warren Buffett. He doesn't have $100 billion to throw behind some of these names. This is kind of his big shot in terms of how much he can put into it. And if it doesn't work, in terms of spurring that excitement. He kind of relies on the rest of the retail base to kind of get behind him. What about the rest of the analysts, though? Do they like Chewy, X Roaring Kitty? Because I saw Seth Basham has the outperform 35. That was updated today. Are they more like Wedbush or more like Mizuho in general?
Well, that's the other thing, Alex, that very much shows that it's not a meme stock. There is a large analyst community that follows this name, and obviously Chewy had 3% revenue growth the last time it reported earnings, said it was off to a strong start, forecasting 4 to 6% sales growth for the year. So the fundamentals are there as well. But in terms of the actual analyst community, 60% of analysts have a buy rating on Chewy. So the majority in the buy camp. The median price target, though, is $26 a share. So that's 20 cents below where it's currently trading. As you said, there are higher price targets on the street, like that $35, but it's very much trading in line with the median price target right now, despite the fact that 60% of analysts have a buy rating on shares right now. So we'll have to see if that changes at all. But Chewy was talking about encouraging customer trends, and as I said, 2024 being off to a solid start. So quite a bit different of an investment than a GameStop. That the hope is that they can totally reinvent themselves, and that's what Roaring Kitty, Keith Gill, is really kind of hanging his hat on for GameStop. Very different story for Chewy.
I know in Carolina, it did crack me up the way that I saw the same thing that said he checked the box that he is not a cat. And I mean, we talk about this man as if he's just like the average Joe, but it was also like a $245 million stake, I believe. So this is like a very powerful investor, and I think that we should give him like credit where credit is due. I mean, that is a huge chunk of change. I think he's now one of their largest shareholders with that 6.6% disclosure. So amazing stuff. I love to talk about it because I do think it definitely moves the needle, but obviously not enough to hold on to a nice gain for Chewy today. We will leave it there. Caroline Wood, senior markets correspondent for the network. And so, Alex, I think you were the first person that made, I thought, the best point. We talk about analysts, the way they can influence stocks. We talk about some of these like notorious like investors that are just like sort of one men like that have gained traction. Warren Buffett's another one. I mean, I know that he's more powerful than just the average investor, but all of these people are influential, and we give them credit where credit is due. Roaring Kitty is the same way.
He is, it's different though, and the difference is I'm not going to go down the track record standpoint. I'm not going to go down the success. I mean, clearly he's turned in what was, a modest account into, like you said, $250 million plus potentially. But the difference is this might be all in for Keith Gill. I don't think he's got $1 billion behind. I mean, he's the third largest shareholder, to your point. This is 6.6% of the company. But one of the exciting things, I think, when somebody like Warren Buffett starts buying into a company is how much more is he going to buy? Is he just going to buy this whole company? And he has the track record of success over 50 plus years. But it's more that's a huge, flow of capital that can be behind that, where it's almost like you feel like there's a price floor. If it keeps going down, he might just keep buying more. And so Keith Gill might be all in. And so he kind of relies on the rest of the retail trading base that believes in his ability to find these opportunities to kind of be that follow-up capital. And if it's not there, then this is just another guy buying into a company. You just happens to have a cool nickname.
You're right. And when it works, it works. I mean, like there was one day where because of his massive positions in some of these names, he added like $190 million to his position because shares surged. Like this morning, Chewy was looking phenomenal, but now
he also had crazy leverage with the calls in GameStop too. Like and maybe he's got a bunch of call positions as well. But I think you'd have to disclose that. So you look at it and you start saying, this might be it. This might be all in Chewy, and that doesn't mean that Chewy has to go down if it didn't jump on this news. Again, this guy was, kind of a self-proclaimed value investor to begin with. So perhaps he sees something in Chewy beyond just, hey, this is an opportunity to spike the stock on my hype.
Yeah, and I think that's a really good point. Also, it's like, when do the funds run out is a major question. But as far as now trading this name, obviously, for example purposes, we pulled back. Initially, this was a very different story when I first looked at this headline this morning, but now we're down, obviously, 3.5% on the session. So walk us through your thinking here.
Yeah, I looked at selling a put vertical, but also quite aggressive in terms of strike selection, but still risk defined. Normally we look at these and we're collecting like a third the width of the strikes, and it's sort of a 2-to-1 risk reward. I actually set this up going out to July 19th, the 25-23, with an equal risk to reward. So it's still out of the money. The break even is still almost 10% lower than the current share price. but you take equal risk to equal reward because volatility got so excited around this particular set of news items. And so I don't know if that price is still there, but with this, that would be the 25-23 put vertical, $2 wide for $1 credit, $24 break even, risk $100 to make $100. Stay above 24. And you can keep that, stay above 24, you can stand to be profitable, stay above 25, you can keep that credit. But like I said, we normally look at these a third the width of the strike. So in theory, down to 60, 65 cents would be acceptable for our normal guidelines. So a little bit chunkier credit. This feels like a situation, Jenny, where Chewy might be $20 or it might be $40. This is a way that it can be kind of set up where if it stays above 25, you can make $100 on $100 in risk.
Yeah, and it does feel like Chewy tends to move, and I think that unfortunately for Chewy, what I need to see now is like how you're able to improve your company, because right during the pandemic, this was a major winner of like benefiting all things e-commerce and pet ownership, and since then it's just been so disappointing. So we'll have to see, but obviously lower on the session here. We will leave it there, though, for FOMO. Now, coming up next, it's time to shift gears and look at Meta platforms, as one analyst did initiate a new street high price target of $600 a share. But we're slightly lower, actually, on the session, down about 0.1% here in Meta.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
No politics, no noise, from bell to bell and beyond. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
If the Fed would just see its role as not trying to manipulate the economy, but stable value for the dollar, that would go a long ways, and stop having this crazy policy of having short rates higher than long rates, which hurts small businesses.
This week, Market Overtime features the sharp tongue of Steve Forbes. Dan King Hall sits down with the two-time former presidential candidate to discuss his latest book on inflation. From Forbes' strong disdain for the Fed's handling of inflation to his case for the dollar over everything else. Don't miss this interview debuting today at 4:30 p.m. Eastern, right on the Schwab Network. Now it's time to discuss all things Meta platforms. Here joining us to bring some light on some analyst optimism we're seeing today, I'd like to welcome in Charles Schwab's Jeff Pierce. So Jeff, walk us through this Raymond James note, which I did see, I believe, was a new street high price target, $600 a share. So that implies about 20% optimism for a name that's slightly lower here on the session.
Yeah, slightly lower, likely to do a little bit with some of that Digital Markets Act coming out of the EU and some of the potential fines that Meta could face. But as you pointed out, we've got a new note coming out from Raymond James. The analyst raised the price target to 600 from 550, kept a strong buy rating on the stock. The price target is based on a 25 times multiple of price to 2025 estimate earnings per share. Meta, according to the analyst, the valuation is justified in his view by increased conviction in the AI prospects. He said he's optimistic that Meta will benefit from all their spending, even if the company's total capital expenditure budget would reach an estimated $50 billion next year, saying that they believe the Llama and open source strategy is well positioned in the enterprise, and some of the combo of business and consumer AI will improve ad monetization. They said, it's worth noting that this analyst has brought this up about Meta before, and if you look back in April, they made Meta the top pick of the internet sector. They said it was the most credible and durable AI monetization theme across coverage. They also said that their AI work was improving the amount of time people were spending on their products like Reels, which is only making their advertising more relevant. They said the durability of AI is really underappreciated by investors. Now, it's worth noting, recently Goldman Sachs has actually shed some doubt on their potential return on investment for AI for a lot of these tech companies. They focused on the high costs with AI, like data centers, power grids, AI chips, all of that, and really questioned whether or not all the spending could justify the returns. They said the cost is also so high that even if you start to see that cost decline, it would have to do so dramatically to make automating tasks with AI affordable. So some different views there, but today we've got a price increase up to 600, so certainly a high price.
Jeff, going back to April, as you mentioned, this was one of the most crowded trades in terms of analysts. I think the only analyst I remember seeing that was a little bit bearish and had the short call going into that earnings was Andrew Friedman over at Hedgeye Risk Management. Everybody else was saying buy this thing, and we saw what happens when a crowded trade goes wrong. But hat tip to those investors who kind of plugged their nose and bought into that weakness, because it's been pretty much a one-way street back ever since. Now we're about 3 weeks away from the next earnings. Jeff, we'll see how short-term our memories are, because that was a painful trade on that day. It was a massive, massive move lower. This is not a name that is, immune to big moves in either direction. We'll see. I mean, are we starting to see some of that, wishy-washiness here ahead of earnings perhaps spill in today? Because the rest of the mega caps are doing good today.
Yeah, I would say, this upcoming earnings is susceptible to the type of move that we saw in the last earnings report and the one before that, right? If you look at Q4, you see that pretty big move to the upside. You look at Q1, the most recent report, obviously you see that big drop, and part of that drop was what these analysts are talking about. We saw disappointment in the outlook, but the company also planning to increase their investments in AI. CapEx, they said, is anticipated to be between 35 to 40 billion. That's up from the prior forecast of 30 to 37 billion as they continue to accelerate their infrastructure investments in AI. Zuckerberg said on the upside, once their new AI services reach scale, they have a strong record of monetizing that. But in February, if we look back to February, the finance chief, Susan Lee, said Meta's been investing in AI models, and that those can accurately predict relevant ads for users as well as tools for automated ad creation. That should drive more engagement, hopefully boost more money and cut down the spending. The good news for Meta, and part of the reason we're seeing them do so well is ad spending has been, stabilizing. We're seeing the economy stabilizing. We're seeing ad spending picking up. It rose 27% year over year in Q1. China-based advertisers have been certainly pushing that number up. Those increased 41% year over year. And worth noting, this potential TikTok ban could happen as early as April 2025. That certainly is probably helping Meta as well. Although on the downside of that, it shows that Meta is susceptible to some of these other platforms. If a ban on TikTok does that sort of push to the stock.
Yeah, and I thought the ban on TikTok was interesting the way when we first got wind of that, it was like the major catalyst. And I was like, this isn't going to happen anytime soon. And it's been that way, I mean, really the better part of this year, as we don't really have any major development on that. But I definitely think will be interesting to watch what happens with that, especially in this, very heavily scrutinized political year ahead of the election. But we will leave it there. Great breakdown on all things Meta Platforms, which I do think is still one of the most influential names in the market, despite some of the weakness we've seen as of late, lower today, but still seeing a phenomenal phenomenal 2024 thus far, at least on a relative basis. But we'll leave it there. Now, coming up next, it's time to talk another social media stock. That is, of course, DJT, as it is moving in regards to some political headlines, but also seeing some degree of strength today alongside the overall social media discussion. We'll dive more into what the latest is with that name coming up next with George Tillis.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Higgs. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Welcome back. It's time for Under 30 today, looking at Trump Media and Technology, of course, stock ticker DJT, parent company of the Truth Social platform. Joining us now is George Tillis, senior markets correspondent for the Schwab Network. George, looks like the stock made a run again at that 200-day moving average around 31 and let's call it 34. Been a reliable level the last 9 months or so for this stock, but I'm curious your thoughts on this one as we got kind of another slew of headlines surrounding this company.
Yeah, I mean, I think I'll start with the technical since you brought it up, Alex. I mean, I use the 50-week moving average just to smooth things out a little bit, but you could also use a corresponding 200-day moving average. And you're right, going back to the beginning of the year when the stock started to gain some volume and momentum, it seems to be respecting that area. So I think that's very meaningful, at least from a trader standpoint or a technical standpoint. And I think the news today on DJT is actually meaningful as well, because we know that the stock has been, I'm going to call it a meme stock, even though maybe it isn't necessarily put in that same category, but there seems to be a lot of interest in the name. There seems to be a lot of popularity in what's going on politically this particular year, because we know it's an election year, obviously. But at the same time, there was a catalyst today which essentially may be sort of an institutional acquisition of the stock, because the stock was listed or actively placed into the Russell 3000 and the 1000 index. So by default, that essentially means that it'll eventually be placed in the Russell 2000 index. So with that said, this is a benchmark, and anytime there's a benchmark, there are going to be many institutions and mutual funds and even pension funds which replicate benchmarks. And if they're a growth fund, they essentially will be purchasing DJT, again, for those that are including it into their benchmark portfolios, which again are used to mimic the underlying index.
So George, I'm curious because we oftentimes talk about this and like the nature in which that it trades in relation to the election, and not to dive too much into politics here, but is there just like an added interest because of the fact that we did have this U.S. presidential debate last week? I think that it was overall, I think, not necessarily like in favor of Donald Trump. I think there was a lot of backlash regarding like President Joe Biden's health and well-being. So does that help things? Because I have to imagine this is somewhat of a proxy now into like if you believe in the narrative surrounding Trump, you sort of follow the stock.
Well, that's the thing. I mean, if you think about the nature of the debate and the election, this may be a political, maybe based on political catalysts. So again, maybe it's essentially those who want to vote with their pocketbooks, essentially buying shares. And that's the way I look at it. It's sort of like a stealth, or quasi-political donation. And the reason I say this is that this is certainly a stock that can continue forward. But I will say this, the reason I put it in the context of a donation is because if you look at the sales in the past 4 quarters, they were actually down, $3.8 million in sales. These are revenues, down from $4.1 million back in 2023. But if you look at the market capitalization, which is close to $5.8 billion, it's about 1,500 times trailing sales with a negative earnings yield of about $4 a share on a trailing basis. So I think from an institutional investor standpoint, there first needs to be some analyst estimates, which I don't have. They are provided for this company. So what I'm trying to bring is context to this. So yes, is there a political catalyst? Absolutely. But is there a fundamental catalyst? That's questionable. And that's my point here. But keep in mind that institutions that are going to be reproducing the small cap index like the Russell 2000 will be purchasing this stock. And that might, again, drive some additional institutional volume.
George, the closest that I could compare this to, and I know they're way different and it's a stretch, is probably Virgin Galactic. One guy kind of behind those brands, kind of a futuristic idea, pre-revenue, pre-earnings, but excitement around the ideas. So we'll see, I guess, where things shape up. Different level of fame or infamy with Donald Trump than Richard Branson. So we'll see, but appreciate it as always. George Tillis, Senior Markets Correspondent for the Schwab Network. Jenny, we largely leave where we began. It's deja vu all over again. This market moves around, but it goes nowhere.
No, it's just looking at the Russell futures, and I'm like, we are exactly where we were to start off the show, to speak to that. So we haven't seen much movement here, but weakness right now, I feel like focus is on NVIDIA, still lower on the session here, but we will leave it there. For Next Gen Investing for this Monday, coming up next, we have the watch list with Nicole Petalides.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day. I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
trading the trending names every day.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was heard, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Good afternoon. Welcome to the Watch List. I'm Nicole Penelides. It's 2 p.m. Eastern Time, and we're coming to you live from the New York Stock Exchange. Glad you're with us. Here's what's coming up on today's show. We're focusing on Boeing. Of course, it's moving forward with those plans to buy Spirit AeroSystems. We'll look at which companies will benefit. Federal investigations into Boeing factor that outlook as well. Also, we'll talk about faith in investments. Yes, a new ETF basing its picks on biblical principles. And our panel takes a look at M&A outlook. First half of the year saw some strong growth in that space. In the meantime, taking a look here at the markets overall across the board. In fact, we are seeing some up arrows. The S&P is up 9 at 54.69. The NASDAQ is up 1/3%. The Dow is up 50 points, 39,168. We are seeing tech, consumer discretionary, and energy leading the way. Taking a look at oil and gold. Oil is higher. A lot of talk about summer demand. The Chinese manufacturing activity came in. That also may be giving this a boost. It's up $1.80 at 83.38. Gold pulling back a little bit, 23.39 a troy ounce. And we're seeing 12.43 on the VIX. The dollar's at 105 and change, and Bitcoin 64,000. That's up 6% today, folks. 64,130. Now, for some of the biggest stories in the markets, we welcome Kevin Hinks, host of Fast Market here on Schwab Network. And of course, this is a holiday, abbreviated week, right? So we'll have Thursday that we're closed, Wednesday's a half day. A week with some ISM numbers, the jobs data. What's on your mind here?
Hey, Nicole. Yeah, as we start the third quarter and start the second half of the year, there's, a lot of euphoria going on how stocks have moved the first half of the year. So, that being said, the market is stronger today. A little bit of a seesaw back and forth. Market was opened up, then sold off. Now it's pretty firm here despite sharply higher 10-year yields and a dollar that was down on the day, and now it's up on the day. We did get some data today from PMI and ISM manufacturing data. PMI came in 51.6. That's just a tenth less than expected. ISM manufacturing came in 48.5. That's 0.2 lower than a month ago, and about 0.6 lower than we thought it was going to be. Around 49.1 were the estimates. We also got construction spending. That was down 0.1%, equal to last month, even though that was revised to up. Now, take all that and take the overall good feeling about stocks being at or near all-time highs. Despite, like I said, yields and dollar being higher, the market seems to hang in there. You got good news out of Boeing. You got good news out of Tesla that you and I will talk about. So there's a lot of names up, but NVIDIA is actually, it's down just only slightly on the day, Nicole. So an interesting market that's higher without the help of NVIDIA.
Yeah, that's absolutely right. I mean, and also, I mean, it's worth noting that those prints less than 50 still show contraction.
Yep.
Not necessarily so great, right? That doesn't mean that the economy is booming or something like that. Though we're waiting on the jobs number on Friday, and the Fed's going to really hone in on that. They focus on the labor report. They wouldn't mind seeing a little unemployment, little rise in the unemployment. Let's get to Tesla. I mean, this is what, the 6th day in a row of gains. What are you watching it with this little rally that stock's having?
Tesla currently up over 7% as we get to the 2 o'clock hour, and that's why. Well, they're about to release their deliveries for the second quarter. We're going to watch what that is and see if they hit that 420,000 number that the street is expecting. There was some good news out of China insurance data that might mean Tesla's numbers are starting to rebound. But the real question is, why is Tesla up 7%? Maybe people are starting to look forward to that robo-taxi event that's coming up in early August, because this is a big move out of Tesla. If you opened up your Thinkorswim platform this morning, you would see negative articles on different aspects of Tesla, and this stock opened up and took off, Nicole. So they're looking for deliveries. They're looking for overall good news when it comes to the robo-taxi event in early August. So Tesla having a good, strong day today, Nicole.
Yeah, I mean, you think about Tesla, and it's really been the underperformer when you think about the Mag 7. So people are disappointed. You know, they really wanted a lot more out of Tesla, but the last 1 month, to your point, right, we've had 5 days of gains. This is the 6th, I believe. 1 month, it's up 19%. I mean, that's pretty great. People like that, at least, and I see it at 211. I mean, that's also the highest it's been in some times, and the deliveries are waiting on more on that. Thank you, Kevin Hicks. Great to see you. Thank you. Now let's get a look at the bigger picture. Anthony Siccaro's with us, President, Providence Financial and Insurance Services. Thank you for being with us. We just went over some of the data from today. Did anything in particular stand out to you?
Well, it really all boils down to inflation. I think that's the number one thing that is on the Fed's mind. That's the number one thing that's on consumers' mind, is things are costing more than they were a year ago, and certainly more than they were a couple of years ago. And it's that really that is driving what the Federal Reserve is going to do. A year ago, I think, when at the beginning of the year, actually, the Federal Reserve was going to lower interest rates 6 or 7 times. That was kind of what their goal was. Now it's down to like 1 or 2 times. And so it's kept dwindling, but they have to have a reason to lower rates. Inflation is softening. The labor market is softening. And it's looking like they'll lower rates sometime in maybe Q4, but it's really a question as to when. Are they going to do it closer to September or closer to maybe December? And I think there's still an argument that they don't lower rates at all, but I think that's not probable.
Right. Okay. So you do see some sort of rate cut coming. You just don't know whether it's September, November, December. September is 65%. November is 77% likelihood when you look at Fed funds futures. In December, 93%, which is slightly lower than it had been for December. And then they talk about the new year. If I see more cuts, maybe you get 1 in this 4th quarter. And then in the new year, what? More cuts?
Yeah, well, I mean, the economy is weakening for sure. GDP is slower than it was in Q4 of last year. Inflation is going up a little bit. The CPI numbers were a little softer. The PCE numbers were a little softer. The labor market's weakening right now. There's a 4% unemployment rate. It was 3.7% at the beginning of the year, so that's gone up a little bit. And it's all driven by the labor. If you were going to ask me what is the number one thing that is driving this, it's really the labor market. The fact that there's still 1.3 jobs available for every worker that's out there. But even that's come down. 2 years ago, 2.5 years ago, it was almost a 2-to-1 ratio, 2 jobs available for a worker. So everything is going in the right direction, but it's not there yet. What the Federal Reserve has to do, though, is they have to be proactive, not reactive. This was the problem when COVID happened and the Federal Reserve said, no, inflation is going to be transitory, and they didn't do anything. They weren't proactive, and from a reactive standpoint, they lost a lot of ground. Well, they can't do that again. inflation is a lagging indicator, so they have to lower rates before the inflation actually hits. So we don't want to wait till the inflation gets down to their 2% target for them to do anything, and it looks like they're not going to do that. So again, I think the fourth quarter of this year, and definitely some in the next year, is certainly gonna bring us more rate cuts. And we're still not out of the woods with regards to a recession either. So that's something that consumers and investors have to keep in mind.
I'd love to hear more about the investment strategy you talk about, particularly for retirees, you know, whether you're doing that ahead of time, if you're 30 or 40, or if you're 60 or 70 or 80. What's some of your advice these days based on the current market environment?
Yeah, if you're younger, I think you keep dollar cost averaging, keep buying the same mutual funds or stocks over and over again. If you've got 10 or more years of retirement, that's a great strategy. If the market goes down, you win because of the fact that you get to buy more shares for your same investment. When it comes back, you're going to have more shares. Just keep doing what you're doing over the long run. When you're retired, though, or close to retirement, if you're going to be retiring in a few years or you're newly retired, well, the market's at near record highs. And it may be some time to take some chips off the table and start focusing more on income, things that are going to give you interest and dividends. And I think that would be the focus. The interest and dividends are the bird in the hand, whereas the growth is something that you can't necessarily count on. So if you're retired, I want you to know that you have something that's going to be able to give you some income. I think that's the better approach. Oh, and by the way, these income producing strategies happen to be more conservative too. So you kind of kill two birds with one stone.
Yeah. When you think about Mag 7 and that kind of, growth strategy, do you like some of those names?
So the Mag 7 has been a lot of what's held up the entire economy and why the stock market is at record highs, right? Because of the Mag 7. You take the Mag 7 out and we don't have nearly the performance that we've had before. If you're a growth-oriented investor and you have time, or even if you're retired and you've got some money that you can set aside and throw into the Mag 7, I don't think it's a bad time to do that. But it really depends on your strategy. You have to have the money to be able to do that, to set it aside, to not need income on it. You've got to give yourself a 10-year time horizon. The last 12 years in the market, the market's been up 15% plus a year. The next 10 years or 12 years is probably not going to be the same thing. And when the market tanks, when we go into a correction or we go into a recession, as is likely to happen sometime, we're going to have another one at some point. When that happens, the Mag 7 may very well lead the way down, just like small caps may very well lead the way down. So you want to be careful. You want to know that whatever you put in the Mag 7, yes, you've got a lot of potential for growth, but you probably got a little more risk than maybe you want as well too. You have to have at least a 10-year time frame in my game if you're gonna put in the Mag 7.
Are you worried about, I don't want to say recession or hard landing, but, we keep hearing a little bit about a pullback, a 10% or 30% pullback, and those would be buy the dip opportunities. Are you thinking could be something different? Are you worried about a black swan event, things like that?
Well, we could always have a black swan event. The whole point of the black swan event is you don't know what it's going to be, right? There's a couple of things out there that could be the black swans. It could be another variation of COVID, although I don't think so. I think we're out of the woods there. I think, all the vaccines and people, I think people are over that. So I don't think that's a huge, but geopolitical is what bothers me the most. We've got a lot of terrorist things going on outside this country, right? I think there was a report just recently of a lot of people killed. There's wars going on. What if we have another terrorist attack in this country? That's not out of the question. That could be something that spooks the market in a big way. That's what happened when we had 9/11. So that, I think, is the biggest risk. But here's the key. If you're invested right, it shouldn't matter. And if you're retired and you're focused on income, then it doesn't matter because you've locked in interest and dividends. You've locked in income from your portfolio that you can count on no matter what happens. Doesn't matter who wins the election. It doesn't matter what wars are going on or what other geopolitical. If you have interest in dividends and you do it right, you can focus on your income. And the same thing, if you're a little younger and you're in the accumulation phase of life, you can still add in dollar cost average. It doesn't matter. You should be in a position to win no matter what happens to the market. But yeah, I have some concerns, but if you're invested right, then those concerns shouldn't necessarily be valid to you. And don't panic. If we do have a 20 or 30% correction or worse in the market, that's happened twice in the last 25 years. The worst thing you can do is panic. No good decisions happen when you panic. The time to make a plan is when the market's at record highs. That's where we are. Make a plan, stick to it, and make sure that your plan allows you to win no matter what the market does.
Anthony Sicaro, thank you so much. Great to see you. Providence Financial and Insurance Services. Thank you, Evan. Coming up next, Options Corner. Tom White standing by. He has unusual options activity that he's pulling out and sees for the day. Investors are looking at trading some of the recent news that we're seeing on Micron, Rivian, Tesla. Let's find out what Tom has discovered when it comes to the world of options. We'll be right back.
With the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. It's time for Options Corner, and where we analyze unusual options activity and trades that we've been seeing throughout the day. Tom White's with us now, host of Fast Market here on Schwab Network. In fact, taking a look at Micron, which you did see stock, right? Even after a dip or an early trading, you're seeing some bullish activity. It was funny because earlier I had read a note about some of the bearish whales, the options activity that I had been seeing based on that article. So there's certainly a lot going on in Micron. I think that would be fair to say. I'd love to hear what it is that you saw, Tom.
Yeah, we hit this one last week also, Nicole, where they were selling out of the money puts to the downside after that big nearly 8% fall post earnings. Now, I don't think it was a bad report by any stretch of the imagination, and I think the reason was because the bar was so high. The stock was up nearly 70% on the year going into that report, pulled back over 7.5%. After the report, they beat on revenue. Revenue grew to $6.8 billion. That was an increase of 81% from year-ago periods. Now, the comparisons aren't really fair because last year they had some awful numbers as this seasonal and cyclical type of industry in memory chips kind of changes on a year-by-year basis. But data center revenue shot up over 50% quarter over quarter. Solid demand for their HBMs or their high bandwidth memory chips as the AI boom continues, and the amount of memory that you need in these new AI data centers is, quadruple what the old standards were as far as DRAM and NAND. So really good. It's still a good quarter. Pulled back. It was down over 3% earlier in the session, just like NVIDIA was. We've rebounded to basically flat on the day, and we saw some call buyers in here. I think on that dip early this morning, Nicole, they were taking advantage of it, because one that stuck out to me was really short-term positioning in the July 5th weekly options that expire in just 4 days. The 126 strike call, they bought over 4,000 of those earlier today. Average debit of about $3.30. So that break even 129.30 over the next 4 days. The stock's already back above it on the snapback rally that we've seen in some of the tech names on that earlier weakness. So yeah, not surprising that we saw some buyers there in tech, and Micron was one of them, thinking that before the end of the week, we're going to see this stock continue to move higher.
Good to see that and see that action in the 52-week high, 157.54. So we'll watch for all of that. Also, when we turn our attention over to the EVs, you found a bullish play for Rivian, where we're seeing EV stocks on the move. Of course, Tesla is going to be your final play, which is up for 5 days, today being the 6th. But let's talk about the action in Rivian.
Yeah, we'll definitely talk about Tesla after this one, but Rivian up another, it was up over 6% earlier in the session. I think it's up about 3 or 4% right now. After rallying last week on that investment, $1 billion initial investment from Volkswagen that's supposed to expand to $5 billion as they explore their joint venture moving forward. Now, this helps Rivian because the stock was under pressure due to the fact that they lose a lot of money on each car that they sell. They're not going to be one of those left for dead type of EV makers either, but this definitely helps them as far as raising capital from other alternatives. And then they create this joint venture. Canaccord came out with a note along with a bunch of other analysts last week raising the price target. They put a $30 price target on the stock, buy rating on the shares, saying basically it's an unappreciated game changer of a transaction for Rivian moving forward on this one. And I just think it's positive in this type of environment where maybe some of these EV makers during a seasonal slow period for them right now. You've seen some of the numbers in Tesla and others where people are pulling back purchasing EVs. This is a good investment. Not only for Rivian, but probably for Volkswagen in the longer term. But we did see a lot of call buyers in here also. Really short-term positioning again on this one. July 5th weekly options. They bought over 10,000 of the 14 strike calls. Paid an average debit of only 50 cents, so that break even of 14.50 over the next 4 days. That's only about 3% above the current share price in there. So somebody expecting before the end of the week, we're going to see more gains in Rivian in this space.
Look, I mean, there's no doubt, to your point, the analysts were raising the price targets. Canaccord was on the high end of the street, looking at $30. But I saw a bunch of others that raised their price targets, but none of which were above $20.
Yeah.
I did see Goldman at $14. Barclays raised the price target to $14 as well. So RBC, $14. So those at Cantor had it at $19, so they were on the upper end. But the Canaccord was really exciting when they put it to 30 from 20. And maintain that buy rating. And then we had turned our attention away from Rivian, which is a clear winner today, up 7.5%, to Tesla, which when I couldn't believe when I saw it go to above 200 and then 210, now it's at 211. That's fun for folks because a lot of folks have that because of the indexes, and it's nice to see a bullish run for 401ks and IRAs and the like. Tell me a little bit about some of the options activity you're seeing.
Yeah, it's kind of a head scratcher for me, Nicole. Tesla rallied 11% last month. It's up another 7% today. There's going to be some catalysts out there over the next several weeks in Tesla. First and foremost will be deliveries for June. We saw a bunch of the Chinese automakers release their numbers. Tesla's usually a day or two behind them. So that's going to be one of the catalysts. Then also you've got the catalyst of earnings later this week. They report on the 17th. Expectations really low going into that report. But then also August 8th, their robotaxi day, where they're going to give us some clarity on what their plans are creating this robotaxi. So you've got some catalysts on the horizon for Tesla. And then also you look at Wells Fargo came out with a note. They added the Tesla to the firm's Q3 tactical ideas list for 2024. But they've still got a $120 price target and an underweight rating. So it's almost like they're saying things are bad. They've got an underweight rating, but then they named it to a tactical ideas list. If they're doing it on the short side, it's kind of getting pounded today because the stock is up, as we said, about 7% today. June delivery numbers, Nicole, that we're supposed to get over the next 24 to 48 hours, expected to be around 420,000 vehicles delivered. That'd be a decrease of about 9% from year-ago levels. But I'm hearing the whisper numbers are maybe under 400,000, but then I heard some other whisper numbers above 440,000. So everybody's kind of trying to get a grip as the slowdown in EV sales, getting pressured by hybrid sales and the old combustion engine sales have picked up recently. So this will be a big number. You're seeing a lot of option activity in there. Over 1.2 million calls have traded in Tesla today. One that stuck out to me, there was actually a couple of them, but really short-term positioning by these traders also in that July 5th weekly cycle that expires in 4 days. Over 100,000 of the 210 strike calls, so these are basically at-the-money calls. Over 100,000 of these were purchased, an average debit of about $5 on these. That takes your break even to 215. That's about 1% above the current share price, 1.5% above the current share price. So you don't need a massive move to the upside, but watch that number as far as the deliveries numbers go, because the bar is low on it. So if they even meet that number that the street's expecting, around 420,000 cars delivered in the quarter, we might see some reaction, to the upside for this stock. But at the same time, you've got all these other catalysts. But yeah, it's definitely had a good run from, the stock was off over 30% just about 2 weeks ago. So yeah, it's had a nice run back, and somebody expects that to continue into the end of the week.
Yeah, look, sometimes it's buy on the rumor and sell on the news. You'll have the deliveries tomorrow morning, as you noted, the earnings on the 17th, the big August 8th. And sometimes things get exciting. They buy up into the, rumor, and then they sell in the news. But to your point, when you've had lowered expectations, that they really just need to meet and beat those, and maybe you'll get this 1 or 2% move to the upside and suffice for those options that you were pointing out. Thank you, Tom.
Thanks.
For Options Corner every day, Tom White. Thank you. Coming up, we're going to talk all about Boeing, of course, the pros and cons of the big deal, Spirit AeroSystems acquisition, ongoing legal problems with the Department of Justice. We'll be right back.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 to $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Knock, knock. #1 broker here for the #1 hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Today, it's the usual greedy corporations, greedy unions, greedy this, greedy that. They never blame the true cause, bad government policy.
This week, This week, Market Overtime features a sharp tongue of Steve Forbes. Diane King Hall sits down with two-time former presidential candidate to discuss his latest book on inflation, from Forbes' strong disdain for the Fed's handling of inflation to his case for the dollar over everything else. Don't miss this interview. See it debut today, 4:30 p.m. Eastern, right here on Schwab Network. And welcome back to the Watch List. I'm Nicole Petalides, live on the floor of the New York Stock Exchange. I have a few more market movers for you. In fact, shares of Apple are up after Needham reiterating in the buy rating, citing possible changes to iPhone pricing that could be on the way. Note to investors, the analyst speculated Apple may increase prices on its high-end iPhones to subsidize costs of its entry-level models. The speculation was based on conversations with former Apple employees. The goal would be to attract more users into Apple's ecosystem. Well, it's been another roller coaster day for Chewy after SEC documents showed investor Keith Gill, known as Roaring Kitty, actually has a 6.6% stake in Chewy. Shares of the company surged late last week after Gill posted an image of a dog to his social media account. At one point, shares were up nearly 20% in pre-market trading before falling at the opening bell. And of course, it's been another busy day for Boeing in the headlines, in this case with the aerospace giant announcing the acquisition of Spirit AeroSystems. This, according to Bloomberg. Fraud charges are coming, and DOJ nearing a critical deadline in the case over two deadly 737 MAX crashes. Let's welcome in our next guest for a closer look. David Schreiner's with us, CEO at New Constructs. Thank you for being here, David. Some of your thoughts on this deal, Boeing, Spirit AeroSystems. It's obviously something they were working on, and it's finally happening today to about the tune of $4.7 billion. Does it seem right to you? Does the price seem right? Does the deal seem right?
Seems very expensive. Thanks for having me on, by the way, Nicole. Yeah, we're scratching our head a little bit. I mean, obviously, you can make a case that perhaps Boeing can shore up some of the issues in their production supply chain if they were to vertically integrate with Spirit. But, you know, if they're having enough trouble as they are managing their current production issues, I'm not sure they're in a great position to expand those by integrating. Also, the price tag seems pretty high for a business, Spirit, that's truthfully struggling. I think maybe if they didn't buy them, Spirit might have trouble surviving. So this feels kind of like a bit of a Hail Mary and just another way to maybe distract investors from all the other bad stuff that's going on at Boeing.
When I think about, Spirit AeroSystems being a fuselage maker and and Boeing being under scrutiny for using parts that were mismatched and ill-fitting, and I don't know, it just seems like maybe more is more right now. Do you think that's also part of just saving face?
Yeah, I mean, look, talking about an integration and how they can use that to improve, safety and production, quality control. I mean, that's a nice change in the narrative for sure. Whether or not they're capable is a whole nother question. I mean, I think Boeing is an example of a business that was run the wrong way for a long time. It was run for the benefit of shareholders and profits at the expense of the product and customers. And many years of that is going to take a long time to unwind. And I don't know that an acquisition on top of that big job is something that the executive team is really prepared to or capable of handling.
And what kind of timeline do you think this is? You know, it takes time to actually have the integration. What are the ramifications in the aviation industry? Are you watching for a big picture? Anything else that's happening there?
I would imagine the integration here takes a long time. And Nicole, I think that's part of what I was saying before is that they got their hands full with a lot of other issues. Integration is difficult and expensive. And I would imagine it takes a long time because they've got plenty of other problems. And I think the industry is kind of facing a telltale moment here. You know, are we gonna focus on producing a good product, or are we gonna focus on trying to improve our bottom line? And those two things used to not have to be in competition, and they are these days. And I think that's something.
A little expansion pattern. Jimmy's back.
You don't really love the stock right here either, right?
No, I think the stock, look, I mean, it's a bad time for Boeing, right? They're not profitable. Their returns on capital are going down. The valuation is giving them a lot of credit for turning things around already. There's nothing to like here. Adding an acquisition to the mix that I think is probably overpriced by, I don't know, $2 billion or more, is not going to help. But again, I think it's about changing the narrative that's just gotten so bad on Boeing that they're probably desperate to do anything just to get people to talk about something besides their safety problems.
Well, that's a good idea. Ouch. I'm not an expert when it comes to Tesla had new highs. litigation, and but when I read It's civil very bullish. versus criminal, and I start to see the criminality criminal. that could be tied to Boeing, Ugh. that seems scary. Doesn't It is They scary. actually have some criminal charges against them, right?
Nicole, I agree. I mean, it's looking pretty bad. I mean, there's some pretty serious, screws missing, doors not put all the way on. I mean, quality control seems to have taken a pretty big dip here, and that's just not acceptable.
No, it is
Not
not.
acceptable when you're selling a product that's supposed to ensure safety, that
Especially
has
when I'm
so
going
much
on a trip
safety
soon.
responsibility. It's simply not acceptable. And I don't think this was something that's just happened in the last few weeks. I think it's a product of years of being run more for shareholders than for customers. And that's a big cultural change that they're
It
going to have
is.
to push through. And it's going to be expensive. It's going to be expensive. I think they got in the habit of cutting a lot of corners, especially with respect to safety and quality control. And that's how they had to get their earnings up. And they're going to have to reverse a lot of that. And that's just not going to be good for earnings going forward.
So a lot of focus, I know you wrote this in your notes, a lot of focus really on the shareholders and maybe less so on customers and safety and the like. And, when does Boeing turn into that company that people say, ethics, integrity versus cutting corners? I'm hearing doom and gloom. I want to hear hippity hop. Easter's on its way. Now, SPY just hit a magical 200 SMA, kind of making up its mind. The QQQ also hit the 200 SMA. And it's 1:35, 2:35 Eastern Time. Jimmy's back. Jimmy's back. Okay, Apple's pulling back some here. Some. What's going on, Tetalini?
close here. Jimmy thinks. I had 2 strikeouts today. The recycling bins were closed, and my accounting was out to lunch. And then I bought a very impressive tire gauge. Gotta make sure I have that thing. Still watching SPY here. I haven't traded the SPX today. Probably won't. Yeah. That was a nice one. Might have to do a little bit more of that. Nicole's up.
Those move.
Yeah.
83 and change?
Yeah, I'm hearing a little bit over 83. Yeah, I'm hearing a little bit of speculation, but nothing really definitive, which is weird, right? Because this is kind of a high conviction move that we're seeing. There's definitely some energy associated with it, but again,
Tesla?
there's not a lot of news. So, but it's been going on for a while. So maybe just some follow through in terms of the technicals, just getting into a similar look at the price activity as we just did with the S&Ps, more granular first and foremost, and then we'll take a look at the bigger picture. And on the 1 minute candle chart here, you can see what I'm talking about in terms of conviction to the upside. Recently to 83.52. Now the concerning thing about this is, you know, we had an April high up around 87, but you know, so we're holding below that. But a big part of that progress we made on inflation over the last few months has been with crude oil coming off, right? Because we started off, if you remember, well, the lows, I should say, we saw in June last month were around 72. So to see it up above 83 right now, I mean, that's adding quite a bit on in a very short period of time. And that ultimately will become a bit of a headwind for stocks if it continues. But again, I mentioned that April high. I just want to point to take a look, because here it is, okay? So you've got the April high, and this is significant, and it's basically right where we are, again, right now at these levels here, 87, 88. So let's keep an eye on this area, because if we take that out, then ultimately you open up a door for a retest of that high from last fall up around 95. So a bit of a headwind for stocks. Take out 87, 88, aim for 95, and you can really derail some of this momentum we've been seeing into the second half of the year.
Understood. Ben Lichtenstein, thank you for all of that. Appreciate it. Thank you, Ben. Now we have something really different for you, a closer look at the role of your faith in your portfolio. Yes, joining me right now to explain is Robert Netzley, President and CEO, Inspire Investing. And you are ringing the closing bell here at the New York Stock Exchange today. I'm not sure many people are using their faith in their investment portfolio. How did you come up with this concept?
Well, I wish I could take credit for inventing the idea, but it's been a very old idea. Personally, I was working my job, happy as a clam, at Wells Fargo Private Client Investments, and then I discovered, quite by accident, kind of stumbled across this idea that, here I was president of our local pro-life pregnancy center at the time, and I also owned 3 stocks of companies manufacturing abortion drugs. So for me personally, that was a deep contradiction. And as I looked into it further, I just grew increasingly convicted, and I had to change what I was doing, and left the bank and started this firm.
It's very interesting. So PTL, where does that ticker symbol come from exactly? Is there
Praise the Lord, PTL.
Praise the Lord. I should have thought of that on my own.
Yeah,
I should have thought, I said, what is PTL? I should have thought of that. So this is very inspirational. I mean, hence Inspire Investing. We think about ESG investing, right? Environmental, social.
Know about
That's
you.
something else. People were very concerned about some of those things. And maybe some
I'm
of
not
these
too
things
interested in
overlap.
it.
What kind of companies are you really, putting your faith into and buying into?
Yeah. We have what's called our Inspire Impact Score methodology, which is a rules-based process of identifying the most biblically aligned companies in the world to invest in. Similar to ESG, we're using values, but very different than ESG are the types of values we're looking to implement. For example, on the social issues that I mentioned regarding abortion. So we don't invest in companies that are donating money to Planned Parenthood or paying for employees to travel to different states. We do seek out companies that are a blessing to their workforce, the world in general.
Boy, they're going to come after you, buddy.
Some of the largest companies holding in our portfolio.
You're in trouble now.
Broadcom is our largest holding, very large technology stock. Home Depot, Caterpillar, big blue chip names that everybody knows. And PTL in particular, it's our 9th fund. We manage close to $3 billion and are the world's largest provider of faith-based ETFs. But PTL is our
okay, a little
US
pullback
ETF
here.
9 basis points, and so invest in 500 of the largest faith-aligned companies in the United States.
We have people who come on and tell us about some of the ETFs that they've put together. I know this is following an index as well. They're talking about a few $100 million. You're talking billions. And according to Kingdom Advisors, it shows faith-based investors represent $22.4 trillion in investable assets. I mean, huge.
Huge. It's an enormous market.
And where is that? Is that now or is that in the future? What are some of the projections going forward?
That's right now. That is professing Christians, church members from recent surveys and census data, and their investable assets right now in stocks, bonds, mutual funds, etc. And so it's an enormous market, and there are a handful of companies that are now realizing that this is something that investors are wanting. People of faith are wanting to align their values with their investments. We're growing like a weed, praise God. We started in 2017 with our ETFs, and here we are again, close to $3 billion, and going great.
Pretty fascinating. There's no NVIDIA in there, or Tesla, or Apple, or Amazon, right? No Mag 7 in here.
AVGO's in there.
A conscious choice.
Right. Well, it's all a rules-based methodology.
QCOM.
We don't sit there with our finger in the air, kind of deciding which companies we like or don't. So we have several dozen objective criterion that we look at as it pertains to how a company is governing itself or engaging in kind of woke corporate activism, you might say, or not, in very objective ways. And it just so happens that the Mag 7, eliminate themselves for a variety of reasons. We have plenty of
someone mentioned that yesterday, too.
Again, it turns out that you don't actually need the Magnificent 7 to build great investment portfolios. And actually, we're seeing right now not only faith-based investors, but a lot of other investors are coming to look at our funds and investing because we don't invest in the Mag 7.
I see.
And they're seeing that trade rolling over. I mean, it's
Yeah.
an incredible concentration. If you're an investor in the S&P 500 right now, it's hard to call yourself an index investor when so much of your returns is coming from a handful of companies in the same industry.
Yeah.
And so with our funds, it's a side benefit that it's a little more diversified and
We
broader
even see
based.
that. We even see that in the S&P 500. It's so heavily weighted towards Mag 7. That's why people like the equal weight. They look to that. You mentioned here Inspire has engaged directly with ISS and Glass Lewis. Tell us more about that for those that don't know about that.
Yeah, so ISS Glass Lewis, they hold what amounts to a duopoly on the shareholder proxy market here in America and globally, probably. And you know, they have not had any robust faith-aligned voting benchmarks. And so we thought that needed to change, given the size of the market and the number of investors, institutions, and otherwise, state treasurers. They're looking for a more conservative, right-of-center way to vote shares. And so we've been engaged with them, and they're seeing positive progress in them respecting those views and making some changes.
What are those Bible blessed glory? Are those slightly different ETFs? I mean, the first one, we praise the Lord, was more of the large cap.
U.S. large
growth
cap.
ideas,
So we have,
I guess.
we
or
have
maybe
9
value.
funds, most of them index funds. Bible is also a U.S. large cap fund with a slightly different strategy. Bless is a global large cap fund. WWJD is one of our more popular funds. It's our international large cap. We have a couple active funds. Glory.
Is that What Would Jesus Do?
What Would Jesus Do?
Oh,
That's
my
right. You got it. Good job.
See,
Good
that's
job.
good.
You got
This is really good. It's sort of really fascinating. I mean, and if you think just even to Christian music, for example, that niche in music is unbelievable. It's
the
huge,
movies in
right?
recent years. So the world is, the secular world, I should say, the marketplace, is really catching on that there's a lot of people out there that believe the Bible, want to integrate their faith. When we first launched our funds, there's a lot of skepticism. They're wondering who we're going to buy our funds. We've proven that concept, and the market's growing.
Have you had to experience some backlash at all?
Well, you can imagine when you stand for pro-life values, pro-family values, there are a contingent in the country that express rather belligerently sometimes their views on those things, and we try to be respectful, but we believe there's a room for everyone's voice in this great country of ours.
Tell me about the last quick question. I mean, the bell today, you have family with you. I'm sure you have a whole team at Inspire Investing who will be cheering you on today. Last quick thought.
Yeah, we have over 100 guests joining us on the floor today, including our staff and Christian financial advisors from across the country, many different firms. I have my oldest son here joining us today, just fresh out of high school and going into business management, so I'm excited about that. And a lot of people ring the bell to celebrate their success or the growth of a fund or whatnot. We're really here to celebrate what we see God is doing in the marketplace, and here to truly praise the Lord for what He's done.
Well, congratulations to you and the team, and $22.4 trillion in investable assets, according to Kingdom Advisors. I mean, that shows some huge money that can be put to work. Thank you so much for being here, and we'll be watching later, Robert.
My pleasure.
Thank you so much. Robert Netzley of Inspire Investing. See him at the closing bell here, the New York Stock Exchange, PTL. In the meantime, we're ready to bring our panel in the outlook for mergers and acquisitions. The first half of the year saw some pretty good deals, big names like ConocoPhillips, Capital One. Let's talk about what the picture looks like going forward. We'll be right back.
So we got 8 minutes to power hour. Tesla had a nice breakout today. And I said that last week. We broke the 200 bucks. So that's probably upsetting CNBC. Meta, we got to watch Meta. It could be overpriced, but they bring in the bucks. And then called out Apple. AMC broke out today. Ooh, Disney. I forgot about Disney today. So I had 9726 alert set. Maybe one before that. Well, Disney. Levi took a hit last week. I don't know too many people wear Levi's anymore. LE, you idiot. Yeah, Levi's. Netflix down $2.53. You get that at the 20-day. Let's see what she's got to say.
So this space felt like it was taking off, and there were some good deals, but are things slowing down a bit? Joining me with some stats and ideas of what's really going on here. Matt Toole's with us, Deals Intelligence Director, London Stock Exchange Group, and Roy Barron, Co-President, Co-CIO, Westchester Capital Management. Matt, I'll start with you. As I was saying, you started to feel like there were some good IPOs, some mergers happening, and are things slowing down a bit? So maybe year over year or year over 2 years, things look good, but how great is it or isn't it?
We are seeing some weakening in Q2. So the year-over-year comparison is still up 18% compared to a year ago, but we did see Q2 down 12% from the first quarter, and the number of deals is still pretty concerning. So the mid-market, so deals under $500 million, under $1 billion, are pretty weak, and we're seeing that across most sectors and across most regions. So I think people are assessing the environment for volatility in the latter half of the year with elections around the world, and then the rates. Rate cuts were really a given at the beginning of the year, and now I think there's some more uncertainty as to what the credit markets might look like.
So that's what you would attribute the slowdown to, the uncertainty in rates, because we're being told higher for longer, right?
Right, and I think if you're looking to do a deal that needs a sizable financing and you need to kind of figure out what your business model might look like, right now is a little bit more uncertain than it was 3 months ago.
Yeah. I mean, Roy, do you feel we're being bearish or too tepid? Maybe we should be touting some of these great deals.
I'd probably look at it a little bit more from a glass half full perspective. Although deal activity was down from the first quarter to the second quarter, it's up from last year. And keep in mind that there was a $1.5 trillion worth of deals announced year to date. So that's a lot of activity, and I think part of it was driven, to take Matt's point, is by the kind of easing in financing. Rates have stabilized; they've stopped going up. People think they may go down, but corporate partners are not waiting for rates to go down to announce these deals. And particularly if you look at private equity deals or privately financed deals, you'll see that they've become a larger percentage of the overall transaction pie, which indicates that they are able to get financing. So we see that as constructive.
Yeah, Roy, I mean, there's so much money on the sidelines. All I hear all the time is there's so much money in private equity. There's so much money on the sidelines to do deals. But at the same time, maybe we're asking the question about rates or asking about geopolitics or the election. Is that getting in the way of deal making, Roy?
I think it is. I think it has slowed things down, but there is a very, very robust pipeline. The bankers that we talk to are hiring. We're seeing, as you point out, there's a lot of money in the sloshing around in the system, and people are dying to invest. There's a ton of money in treasury bills on the sideline. Everybody wants to invest in private credit now as well, and a lot of these private credit funds are investing in merger and acquisition financing. And you're seeing deals in financials, healthcare, technology, those are always very high profile. Energy, the Hess deal is pretty controversial. It looks like it's going to move forward. But to sort of take a different view of it, deal activity is high, but the spreads, which is the difference between where the stocks are trading and the deal value, are very wide. The government's become very, very activist, and so people are really demanding to be rewarded for investing in companies that are involved in mergers and acquisitions.
When we think about the advisors, you have in your notes that Goldman Sachs takes the top spot. Maybe not surprised to see that. Maybe you are. Tell me about some of the advisors and deals that are happening specifically. You don't have to name the deals that happen, but we're looking at Goldman and UBS and Morgan Stanley, right?
Yeah, I mean, Goldman is the perennial #1 in M&A, and sometimes can be a little bit, kind of choppy based on some of the sectors and some of the activity happening. We are seeing a lot of independent and boutique advisors come into the top 25 this year because of the phenomenon of all cash. Because we've seen stock markets at such good levels this year. A lot of companies are using stock as a currency, and so actually 22% of all M&A so far this year involves either all stock or a stock component, and that's where you don't need any kind of big financial kind of commitment from some of the larger kind of balance sheet banks. So we are seeing some of the newer entrants coming into the market in the boutique and independent space.
So the value of the deal versus the number of deals. Number of deals actually is lower year over year, right?
It's down 25%, a 4-year low, but the number of deals is up 18% and a 2-year high. So
the value.
Seeing the value, right?
Yeah.
So you're seeing that that large cap transaction really was a hallmark of the first quarter and into the second quarter. But that mid-market space, which is the lifeblood of M&A, is a little bit choppier. But I think the volatility around the outlook for the rest of the year.
Yeah, so maybe there's fewer deals, but they're worth beaucoup bucks.
Yes.
All right, Matt Toole and Roy Barron, thank you both for being here and highlighting what's going on in the M&A world and what to expect going forward. Thanks for being with me, friends. I'm Nicole Petalides. This is the Watch List right here on Schwab Network. Get the app. It's available in the Apple App Store. 24/7, schwabnetwork.com. I'm Nicole Petalides. Thanks for being with me. Market on Close with Oliver Rennick. Next.
Oliver!
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a
Damn, your dad was charging $100 a window? I was charging 300, man. Your daddy ripped himself off. No wonder you were skin and bones when you were young, and then all of a sudden, boom. Okay, Psycho Jim's about ready to have at it again. Randy. It's do or die here. Jimmy no trust. Yep. She's moving up. We're trying. Over.
Higher level than where they were a couple weeks back. And the dollar has been giving us some insight into that as well. So if you use the dollar more as your kind of macro indicator, not much has changed here over the last couple sessions. The bonds certainly have had a big move. Bitcoin's bouncing back. One could argue
13 cents right there.
An election element there, but that one I'm
From a
kind
buck.
of doubtful on as well. Bitcoin came down to 60,000. It desperately needed to hold that line, which I talked about on Friday. It's got to hold 60K, and it did. So we found support at a pretty clear support level. So we'll see if it lasts. Now, the more important stuff generally is that you just can't break tech. Nvidia, which was down earlier by 3.5%, came back, is now positive on the day, 0.5% move. Nvidia is just basically unbeatable, and anytime it swings lower, you see folks swoop in pretty quickly to buy the dip. So as long as that trade holds on, then
She moved it.
else kind of sticks with it. It's the glue still. You don't need a lot of
I
participation.
didn't do it either.
When Nvidia's up, and so are the
That'd
big
been 190 bucks right there.
semiconductor stocks as well. One notable event that's kind of out in its own world is crude oil, now pushing through 83. And it's a pretty big move on the chart. That's a big green candle. And it doesn't seem to me like there's any obvious technical resistance other than the one-year high. So WTI could have a ways to explore here a little bit. And it's certainly doing that with a nice rally. High for the year. Still lower than 90, though, about, what, $3 a week?
Could have probably got it at 90. I'm pretty sure it could have.
Definitely bears watching, though. Keep an eye on WTI, making a move. I got Kevin Hinks, Ginny Horn with me here in studio. Kev, we talked about crude earlier.
Oh.
That's a pretty big move in WTI.
That is a pretty big move in WTI, and it's starting to gain a bit of
545s were out of the money.
Talk about,
Now they're in the money.
figure out reasons why yields are climbing
July
higher.
2nd.
I don't think you have to look
Those
any
ones I've
further
been doing all day today.
than crude oil.
That's what you're saying this morning, and I think that's a fair point.
I don't know if it could be other things, but boy, it's hard to argue against the energy narrative and what it's going to do for inflation.
Especially since we started this bond sell-off last Friday after inflation, a print which did benefit from energy prices in the short term. So if the narrative is that that's changing, then whatever kind of downshift we have.
There it happened.
Those numbers from Neo and Xpeng and others.
I know we get a lot of more clarity. I believe it's before the open tomorrow is when we get their second quarter delivery. So I think there's excitement around that. I was reading a lot of different analyst opinions about what we could see for the second quarter, and consensus does have deliveries at around 440,000 units. That would be, if that number proved accurate, it would actually be a second straight quarter of year-over-year sales declines, but it would also continue, I think, be a modest improvement from what we saw last quarter. So I think right now we're just seeing optimism related to maybe what the expectation could be, but also weirdly enough, other strength we've seen is Ford, GM today, Tesla with, ripping, just continuing to see more and more upside as the session goes on. It's been amazing. I keep waiting for it to break down. But there's also this, I feel this sense of upside because of the fact that expectations have become so low. Several of these sell-side analysts
SPY
have taken down their
125.
estimates over the last 2 weeks. So, hey, maybe if we could see any degree of better than expectations, things could rally. But also now I'm a little bit nervous given the magnitude of the strength we're seeing today. I think a lot of the optimism was built is that we didn't see this 6% plus move on the session, but now it's are we going to rally again tomorrow? I'm not sure about that.
I woke up this morning, Oliver, and the two news stories were the 120 price target and complaints about the Cybertruck.
Right, and now it's up 6.5%.
And it's up 6.5%. My first thing was, Tesla will be heavy today. No.
Yeah. All right, so Tesla's working really well. Apple's working really well, too, as that's been up all day. You've got enough in the big cap category to keep the market in good shape. But otherwise, it is one of those days where there's not much else outside of it. You've got 8 sectors unchanged or lower on the day.
The first thing I should start any discussion with on a week like this is lower your expectations for follow through, for big moves, for big volume. It's just not going to happen this week.
Yeah.
There's just less eyeballs on the market. Machines don't have or need eyeballs, but the the overall trading public, there's just less eyeballs on the market.
Right, we got some time off, but we've also got employment on Friday. So
I'm not saying they won't look back. I mean, there'll be some attention on employment on Friday for sure.
But we'll be off, so we will care from afar.
Right, exactly. All right, well, some of us will be behind
I'll
the desk.
care. I'll care a little.
A little
Yeah,
tiny
me
bit.
too. Just a little.
Enough to watch. All right. So look, as far as the response overall to the main data, I mean, it's kind of a little bit of a head scratcher day to start the week, given that our main print was for manufacturing. It was pretty darn light. Like, it wasn't good. It's not what you should be rooting for. What we saw in that number.
No, the data this morning gave you no clear movement, and that's why the market is not giving you any clear movement. I thought it was pretty interesting that we opened up firm and sold off hard for a while there, and like a day in the summer near 4th of July, we just lost the momentum on the downside, and it just drifted back up.
Yeah.
It's actually amazing that NVIDIA has come back and we're not seeing more of the market come back, because that's always our barometer, right? I mean, I think it's really interesting that as of last year, we talked about how like the Magnificent Seven were dominating the trade, and like the top 10 S&P 500 stocks were like 27% of the index. Now, as of June, it's almost 40% that those top 10 S&P 500 companies account for like the growth of that index. It's amazing. So like we have to consider there's such right now like a lack of depth in this market that we're chasing. There's like the dominant players, and everything else is just falling by the wayside.
When you woke up this morning, did you think Tesla and Boeing to the rescue?
No.
I didn't either.
But generally, like a more than 1 percentage point spread between the Russell and NASDAQ, that's kind of what we've gotten used to. You know, that's sort of business as usual now. But yeah, a different cohort of leaders today. NVIDIA's sprint to the upside is definitely slowed to a crawl, if we even call it that. It's kind of still sideways. So, all right, thanks, guys. Jenny Horn, Kevin Hanks, thanks for the sleuthing in the market today. An interesting start to the second half, especially with bonds turning around and with the spike in yields. Karen Farrow is back with us from BlackRock, head of iShares U.S. Fixed Income Strategy. So, Karen, are we starting to try and like game out political outcomes and what it means for the market? Because I am hearing some chatter about the way yield spreads widened out here the last couple of days. Any thoughts on that?
Yeah, I think we're seeing a lot of investors who are wanting to be concerned about market volatility going into the fall. So I think there's still a big opportunity in credit. We're seeing yield-producing, income-producing assets are at the highs that they've been in really a generation, and even investment-grade credit still yielding about 5.5%. So we are seeing investors who are really rethinking some of their fixed income allocations and trying to size up how much they want income versus treasuries.
Is it economic data that's driving that, or is it trying to predict fiscal policy 6 months from now?
I think a lot of it's still economic data. So we had the May PCE print came in a little bit flat, which really shows some of that pressure on inflation is abating. Everybody's really looking at Friday's jobs report to try to make sure that
Friday's jobs
payrolls, is there going to be elevated pressure on wages, and what is the Fed going to do in response to that? So I think we've really seen the Fed funds futures market push out that first cut to possibly November, and then that puts us right smack in the middle of the election. So I think to help with that, investors are really putting on a barbell right now. We're seeing a lot of flows in ultra short duration bond ETFs like SGOV, but we're also seeing some investors add longer duration like TLT, really to hedge out some of that equity market risk and try to make sure that they do have duration just in case rates come down.
Okay, so kind of playing bonds for a more traditional kind of risk-off scenario in case stocks pull back, equities down, bonds up.
That's right. We've seen some model portfolios rebalancing and adding some big allocations to longer duration fixed income ETFs.
With the gap in the Fed calendar, no August meeting, how do you think that kind of gives us, how does that affect the window here for a couple months where there was like day-to-day, week-to-week repricing of Fed expectations, but now are we just kind of like fixed at September?
Yeah, I think a lot of investors are just going to wait. It's going to be a wait-and-see market. Investors are simply going to make sure that they have their asset allocation back on track. We're still seeing about $6 trillion sitting in money market funds, and we've been working with financial advisors who are maybe tired of rolling T-bills. So we've seen people coming to maybe ultra-short ETFs because by the time the Fed does start to cut, a lot of those prices have moved in anticipation of that. So we're encouraging people to just step out of some of those money market funds, ultra short exposures, and try to add a little bit of duration back into portfolios. I think that 3 to 7 year part of the curve is still fairly attractive. However, we're also seeing a different camp where people are looking to floating rate securities, whether it's bank loans, whether it's floating rate notes, or even treasury floaters. That's been a way to just to hang out in that inverted yield curve at the very front end and just wait. And if the Fed is higher for longer, actually floating rate could be a nice way to add some income and diversify out cash positions.
What are the sort of possible scenarios you see when you think about the yield curve and the possible outcomes? Is this basically cuts and steepening the only way we get that, or is it possible still we've got like another wave in the economy here to firm us up? Has hope been dashed on that front, or how does it look in terms of kind of the possible outcomes?
I think our base case is that this is going to be a higher for longer cycle. It's going to be very different than what we've seen the last couple of Fed cutting regimes because inflation is elevated. So we're not going to get down to that 2% range anymore. We're going to see the Fed taking a very measured approach, and they're also looking at the jobs data. So if they're still able to grow the economy, if we're seeing other risk asset prices like stocks continue to trend up, I think they're gonna keep it higher for longer. Additionally, corporate balance sheets are not under pressure with these higher rates. They took a lot of the low rates during COVID to really term out maturity stacks. So in fact, only 10% of corporate debt is coming due before 2030. So the higher rates have not affected corporate borrowers as much, simply because they don't need to refinance in this environment.
Okay. The expectations for this rest of the year also, though, include a debt wall some are worried about. Some have described it that way. Some have argued that's not the case. When you look at credit, is there a key point in the timeline that we got to like get through, or how do you see some of those risks from a credit standpoint, particularly in commercial markets where there's a lot of refinancing that needs to be done?
Yeah, we still see credit spreads are hanging in there at pretty tight levels, so that the entry point isn't as attractive as it used to be. But we are continuing to see investors using ETF wrapper as a way to gain credit exposure. Since 2022, we've seen credit asset AUM and ETFs increase by about 30%, where mutual fund assets have decreased by about 10%. So we are seeing more and more people are allocating to credit because you have that huge yield buffer. So even if we have more rate volatility coming in through the back half of the year, you've got 5.5%, 6% income that can help buffer that in some of these credit risky assets.
Okay. You mentioned on the Treasury side where you're seeing flows short in and then some of the TLT. As far as credit goes, are there any particular strategies that are standing out as the most popular?
One of our most popular strategies has been our BlackRock Flexible Income ETF, the ticker's BINC. It's a way to navigate these higher yielding asset classes without having to overload investment grade or high yield. It's going to have a mixture of both and also pull in some other assets like bank loans and even European credit, where we still see spreads significantly wider than the U.S. So I think it's a way that many investors have been looking at their core fixed income portfolio and they want to add some diversified income with less volatility, and they've been using BINC to do so.
Okay. All right, BINC, there we go. Always appreciate the insight and refreshed with some tickers for ideas. Thanks for your time, Karen.
Thanks, Oliver.
Appreciate that, Karen Vera, head of iShares U.S. Fixed Income Strategy at BlackRock. Right, good conversation for a day with Treasury yields, the main focus as 10 years popping. When we come back, let's talk some AI again. And also the comparison that everyone's tempted to make, of course, that is the old bubble led by Cisco in the 2000s, late 90s, and how it compares to today. We've got a decent amount of earnings behind it, but that was kind of a couple months ago. The last wave seems to be a little bit more bubbly.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Schwab.
Have a
choice in how you invest with Schwab.
Be part of the latest commodities action on Futures with Ben Lichtenstein, weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
All right, let's continue that discussion from the macro and move it into a stock-specific theme as well. Yang Tang joins us, co-founder and CEO at Arch Indices. Yang, thanks for being here on the Schwab Network with us this afternoon. We were just talking some bonds and the economic picture. Thought I'd start our discussion with the macro lens that you're viewing things. You've been watching volatility in long bond futures. So tell me about it. What do you see?
Hi, thank you so much for having me. So yeah, despite Q2 and all the discussions of the inflation data coming in hot and the Fed reevaluating a number of rate cuts, long bond volatility has actually been surprisingly stable. And then to add on that, the 10-year note actually round trip on yields throughout the quarter. Of course, today headlines are back. We have some discussions of fiscal, but on the same note, throughout the whole entire second quarter, the market expectations of rate cuts was also surprisingly stable, ranging between 1 and 2. So I think despite all the data and all the noise and the recent data coming in, right, the Fed has still been a little bit hesitant, solely because number one, there's plenty of liquidity in the market, and number two is the inflation data has not been going with what they thought it was going to be in the beginning of the year, and then number three is there's no recession on the horizon at the moment.
So we basically eliminated both tails of outcomes. Have we eliminated the reflation resurgence risk and eliminated the imminent recession risk? That seems like one way that volatility would subside.
Yeah, I think we're in a very Goldilocks environment right now. To point out, the job openings has been steadily declining throughout the second quarter. I think it pretty much peaked out last year, and now we're back to more of a normalized job openings per unemployed worker. The June inflation data was certainly softer. It should give the Fed some comfort. But just given what the Fed expectations were over the last 3 years of inflation and where they ended up today, you can sense that there is a good amount of hesitancy not to make the wrong move again now.
All right, so how do we use this in our approach to markets right now? If we assume that bonds generally remain calm and that's not the major threat to markets, is that part of the reason why equities have been buoyant and rallying, or is that more kind of a secular AI theme that we just so happen to hit at the same time?
Yeah, I think it's some combination of both. There's plenty of liquidity in the market. Financial conditions have actually loosened throughout the second quarter. They're still very loose right now, as we can see from credit spreads. I think there's a huge amount of discussion around AI and momentum. And this is probably one of those years where the market cap has so outperformed the equal weight that it just brings attention of, when this is kind of correct or normalize itself. And one way to think about it really is AI is in the very early innings of being played out, and the winners actually won't be known for some time. So it's going to continue to be a very volatile, very headline-driven, very liquidity-driven trade. When we think about the year 2000, when Cisco passed Microsoft in terms of market cap, the winners of Web 2.0, being Google and Salesforce, were in its infancy. And Cisco actually did deliver as a company. The revenues have actually gone up tremendously over the last 25 years, whereas some of their optical peers actually did not. But at the same time, the shareholders didn't really cash in on that reward because expectations were so high, and the expectation of earnings and growth extrapolation just ultimately did not occur because you were such early stages, you had no idea how it was going to play out.
Like that. Now, when you look at the trajectory for growth and earnings, does it match up with the valuations? Yang, how about these last, call it 4 weeks, basically since Apple's developer conference? It seemed to have taken on a little bit more of a speculative nature. Valuations have been moving quite a bit quicker than they were when it was just sort of NVIDIA's earnings boom in the first quarter.
Yeah, and I think I 100% agree with that. I think, if you kind of strip away maybe the top 10 or 12 tech names and you look at the S&P 490, the S&P 490 has actually been a relatively flat quarter, right? There's nothing exciting to write home about. Ultimately, the winners of AI is actually going to be quite broad. And AI is actually extremely wide space at the moment. There's almost no discussions around AI infrastructure. We've all seen kind of how, large language models have taken over people's imaginations, but you have to turn that into an application. That has to be made into a usable consumer product that somebody can monetize down the road. We're just not at that point yet. And many of these winners actually won't be known for years.
And to that point, is it advisable to chase those potential product or service outcomes, or should one stick with the hard, basically hardware kind of like build out, the infrastructure trade?
I think there's a lot of different ways to play AI. For example, at Arch, we just released a set of tools for investors, Portfolio Analyzer, that allows you to optimize, build, and analyze what you have in your holdings. Over time, we're going to incorporate an AI element. By no means are we a pure play AI company. We just happen to develop tools and optimization methodologies to improve investor portfolio outcomes. I think if you think about the year 2000, who knew that there was going to be a AWS, right? AWS didn't even exist in the year 2000. Microsoft Azure did not exist in the year 2000. So if you think about 10 years from now, it's really only going to scratch what is imaginable today. So it's probably good to spread your bets around. There's going to be ways to play hardware. There's going to be ways to play middleware. There's going to be ways to play infrastructure. There's going to be ways to play data. There's going to be ways to play infrastructure derivatives. And there's going to be ways to play applications where I think investors are keen to, be able to spread across their bets around a number of ways, as well as to have dry powder on hand for eventual pullbacks so they can load up on the names they like.
All right, good stuff, fun chat. Like the diversity, the transition from the macro to the micro. Thanks, Yang. Appreciate your time. Good stuff.
Thank you. Take care.
Yeah, likewise, Yang Tang, co-founder and CEO at Arch Indices. All right, we got Alex on deck to talk some options when we come back. To see what to watch into the close here is the NASDAQ is solid. Big tech holding us in, but Dow flips back red and the S&P is a little changed.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window when other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me, always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge.
And shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
With Schwab investing themes, it's easy to invest in ideas you believe in. Spot a trend in electric vehicles? Have a passion for online gaming? Or want to explore the space economy? Choose from over 40 themes, each with up to 25 stocks identified by our unique algorithm. Buy it as is or customize to align with your goals. All at your fingertips. Schwab Investing Themes, 40 customizable themes, up to 25 stocks in just a few clicks.
Very good.
Welcome back to Market on Close. This S&P just slipped there a little bit. Alex Coffey here is sleuthing through, doing some detective work for us. What happened, Alex?
Yeah, if we could pull up the chart, I thought we'd use today as kind of an educational day because it almost split perfectly into the first half of the day as a negative dealer gamma situation and the second half as a positive dealer gamma situation.
Okay.
And so our chart that we have here up on the screen, those dashed lines represent when that flips. I did red for negative, green for positive. And I added some arrows to represent, all else equal, what we would anticipate a market maker or dealer, as it's referred to, would act in regards to price action. So in a negative gamma situation, basically a dealer is getting more long into a down move. So in order to neutralize that position, they need to sell futures. So you see that kind of earlier on in today, we broke into negative gamma. You saw selling activity, but it works the other way. When it turns, it's almost manic. It's V-bottom-like whipsaw action. So they're contributing volatility. They're going with the move.
Okay.
When it flips to positive, their position's actually acting
Interesting.
alongside the market, so they act more contrarian and they compress the volatility.
Okay, so these levels are changing throughout the day. That's the dashed line, the horizontal dashed line. You got there, right?
Yeah, these are representative of that area. I mean, the range. I mean, it opened around 54.75, and then in that first half an hour, it's sort of established. Really, since then, it's been in about a 5-point range in basically the 54.65 range or so. Mid part of the day, 54.62.5. I would say it doesn't have to be exactly perfect, right? You're not looking, okay, dealer gamma's negative here, because it gets more negative as you go lower. But I would say it's more of, hey, this zone can be critical. And you can really see it in real time. So obviously my arrows stop about half an hour ago because I sent this in before the show.
Right.
But you can see when we're positive, very compressed volatility. The high to low range since we've been positive has basically been about 14 points. Well, we moved like 15, 20, 25 points in minutes when we were in negative. And you can see that we flipped to negative literally 5 minutes ago, and we moved in really about a minute 7 points, which is significant. I mean, that's basically the entire price action for the last previous 30 minutes in a minute once that happened.
Okay.
But as you can see in those arrows represented, I think it's really important to see when you're in positive, all else equal, it's compressing the volatility because they're going against the move. So they're selling into rallies, they're buying into sell-offs, and of course it's the opposite before. Now I have those two, bright zones there. This is where things can get interesting as well. They initially act as support or resistance because they're large position zones. Basically, this is intraday volume. There's a lot of call buying between 54.75 and 54.80 throughout the day.
Okay, that's the top.
If we assume the dealers on the other side of that, they're short those calls, okay, they're going to basically use that area as it's going to be a critical area. But if it goes through, no longer is that position really working. It's full value. So then they start buying with it because, okay, they're max short at that point.
And so basically, we didn't spend enough time in either one of those zones to really stress the dealers to have to try and chase them.
Yeah, it didn't break through the zone. So I would think of them as almost like walls. And once you break through the wall, it's like, okay, now there's got to be activity taken. But until then, they act as kind of guardrails.
Exactly. No, that's exactly how I think about it. Okay, so we've been in the guardrails all day, but even within those guardrails, there are various lanes we can choose from, and it seems like we kind of flipped a little bit there in the last couple moments. But we're trying to push back, so then I guess if we get above 54.68 here over the next 20 minutes, then we should generally feel a little bit. I mean, as long as we're not down, like breaking through at the lows of the day, we're in pretty good shape.
I would think of it as an area. So in this area, gamma's pretty negligible.
Yeah.
Just once it starts breaking lower as it did, you can see how that manic quick action can take place, but it works the same way. Once that move stops, it can quickly reverse, and you see that there. Again, what took 45 minutes earlier, when you see those kind of big V's, took a minute and a half, 2 minutes when your dealer gamma is negative. So I almost look at it as like it's like a roller coaster ride when you're a negative gamma, and it's a little bit more stoic, a little bit more calm and compressed when you're in positive. But these are just one factor throughout the day. Of course, a big order comes in, it's going to move the market. It's just how the market reacts to that is going to be influenced by how the dealers are positioned in reference to when that order comes in.
Okay, and there's always a temptation to kind of connect into the macro, but generally I also feel like it kind of fits all these gamma levels we've been watching, because we've basically been getting stuck at kind of some of these pins, and within these guardrails they've been pretty tight now for like almost 3 weeks, basically, kind of 2.5 weeks. We haven't really had any major moves to break into any of those stressed areas, because I think we haven't had any major macro news. We haven't really had much for like kind of 2.5, 3 weeks now, where this week we got employment, but we also got a day off. So I kind of feel like the path of least resistance still is sideways.
Yeah, it's totally been deja vu for a week and a half, 2 weeks, where we've gone a lot of places only to end up nowhere different.
Yeah.
We've essentially been 20,000 for the NASDAQ and sort of this 5470, 5500 range in the S&Ps, basically for what seems like the last few weeks. And it's because it's been choppy, but on balance, if you just had the price quote, hey, where do we open, where do we close, it's basically been a non-event for 2 weeks. So for those who are more passive and just check their accounts beginning of the day, they haven't really noticed much probably. Sure. But if you've been watching every tick, it's been anything but quiet. It's just been a battle.
Yeah.
Instead of this trending market higher, we're in more of this distribution kind of sideways phase at the moment. But because it's been lighter volume, a little bit less market depth, we've seen these big swings. It's because we test some of these negative gamma zones, huge moves happen, and then it's like, well, why?
Yeah.
And then quickly kind of cooler heads prevail, and then you see those snapback rallies intraday.
Good description. Okay, and we are kind of snapping back, a little V-bottom there, getting back above sort of the break even, if you will, the neutral areas. We now sit just below 54.70 going into the bell. Thanks, Alex Coffee. Nice look at the intraday action. It's very true. It has been a lot more exciting in between the bells than just looking at the closing bell. All right, let's find some movement when we come back. Bitcoin's bounced from 60K, keeping it above the pretty key area. Also, crude oil having a good day too. And there's a credit story we're going to talk about, because it's the second day in a row now where some of the low quality credit exposed businesses are getting a lot of love. Capital One, Synchrony, we talked last week, and analysts are chiming in on Capital One, so we'll hit that too. Plenty more ahead here on Market on Close.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Ethan, how's my favorite client?
Great. I started using Schwab investing themes, so now I can easily invest in trends, like wearable tech. Trends?
All that research sounds exhausting.
Nope. Schwab's technology does the work. So if I spot an opportunity in robotics or pets, I can buy those stocks in a few clicks.
Can't be that easy.
It is with Schwab.
Schwab investing themes. 40 customizable themes, up to 25 stocks in just a few clicks.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios.
Good job, mannequin.
And from the heart of Wall Street at the New York Stock Exchange.
Up to the minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on SchwabNetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere,
on any device for free.
Schwab Network, empowering every investor and trader
every market day.
Bonds selling off, stocks basically in the same spot. Crude oil is having a good day, and Bitcoin's rallying. Let's go to the market with Mr. Scott Bauer, CEO of Prosper Trading Academy. What's most interesting to you today, Scott? It's kind of an interesting start to the second half. Some curiosities.
Yeah, it really is. You know, it's if you look at the bond market from the time that the PCE report came out Friday morning,
yes,
where we saw the 10-year trade down to almost like 425. I think it may have been 426. What a rally here. And you know, okay, Friday, you know, the equity market sold off. That was probably more attributable to just being end of the month, end of the quarter, you know, end of the first half of the year. Yada yada, but then you see a little bit of continuation with, as you just said, bonds selling off today, and the markets are mostly higher here. So there's definitely a disconnect. And then you throw in what we're seeing with oil, with crude prices. Bitcoin's a whole different story, but I think crude is higher.
I don't know where he's coming from.
You get some eco data out of China that shows, oh, maybe manufacturing data is strong now, and you know the economy's picking up. Once again, I mean, how many times have we seen this story, right? That post-COVID, oh yeah, you know, world's second largest economy is picking up. No, it's not. Yes, it is. No, it's not. You know, we're kind of in that vicious cycle again here. So I think that's what's hitting crude to the upside today. And then with Bitcoin, you know, I really think that this whole Mt. Gox issue, where all these coins, all the funds are supposedly going to be released later this week. Maybe the market got ahead of itself a bit with the big sell-off, though I think it had more to do with rates and potential of the Fed not cutting than anything else.
Okay, I want to take those one at a time here. Firstly, with the move in WTI, Scott, I mean, do you think that's feeding into what's happening in bonds? Do you think we're worried that like there's going to be a summer oil flare-up?
Absolutely, it could be. Now, I've been on the sell side of crude on the way up here and get stopped out. 84.5 really, to me, is a pretty critical level for WTI here. We're at the upper level, upper part of the channel here, 84.5. The last time we were there was, I think it was the very end of April, and that should be some resistance. I just don't honestly trust the numbers coming out of China, and if that's why crude is moving because of, you know, the potential of increased demand because of that, I think the bulls better be a little bit careful.
So WTI willing to take a stab to the new high, or still looking to fade, Scott?
I mean, 84.5 is my last line in the sand for a while. So, you know, I'd be fading it there and
back off.
Use quick stops. Yeah, use quick stops, and if it does break through there, it's anyone's guess at that point.
All right, so back to BTC for a second. I thought that was pretty interesting. Maybe there was some selling pressure coming in from confiscated coins, but maybe now that's behind us?
Could be. You know, again, you know, kind of buy the rumors, sell the news sort of thing. People just getting out ahead of when that might happen. But then you see what's happened to rates since Friday morning, and you know, BTC is up, you know, $2,500 or so off of those lows since Friday morning, even with rates higher here. So I really think there's a bit of a disconnect throughout the entire marketplace between equities, between fixed income, and between BTC right now.
Yeah, it's not exactly a perfect. The pieces of the puzzle aren't fitting together as easy as usual.
No, they're not.
Last 48 hours, right?
No, little tough to decipher here. And sometimes when you get into, not sometimes, often when you get into a situation like we're in this week with half trading day on Wednesday, everyone's off Thursday, and then Friday we get a jobs number, but then after that number's out, more than likely we could see the lowest trading volume day of the year on Friday, just because of the way the holiday works out. It's a tough week, and I'm really more or less on the sidelines here unless something is really, really blaring to me that I have to get in. I don't like when there's not a lot of activity.
Got it. All right. I like it. Scott Bauer, good chat. Thank you, sir.
Thank you.
Scott Bauer, CEO of Prosper Trading Academy. Let's go to the financials. So for Developing Story with Jimmy Horn, taking a look at Capital One. After last week, we talked Synchrony Financial getting some love from the street. So some of these credit-exposed businesses, Jenny, what's going on?
Yeah, and I have to say that typically credit that isn't exactly seen as like super positive, I would say more of a well-rounded sort of basket of credit is what Capital One is like their sort of bread and butter as far as like their clientele is concerned. But Capital One was added to Wells Fargo third quarter tactical ideas list on Monday. Now, the analysts of these shares have more upside and cited several reasons behind this, like the odds of their Discover Financial merger increasing towards the election, as well as low-end consumer concerns actually starting to fade and edging closer to reserve releases. They highlighted that Discover Financial specifically shares are trading about 10% below the implied offer price of Capital One, showing that the market already sees only around a 50% odd of the regulatory approval at this point they believe going through. So they believe those odds will only continue to increase as we, of course, head into the November election, as we could see some changes in overall regulations regarding these various antitrust concerns. And they said that at this point, they believe Capital One will only benefit from those deal odds improving. They also expect their monthly credit metrics to prove to be resilient. And with that being said, second quarter earnings, they think that we'll continue to see more potential for some of these reserve releases for late 2024 or early 2025. So you mentioned the fact that Synchrony Financial was the best performer in the S&P 500. I believe it was Friday. And that was a note from Baird that said nothing but positive things regarding that company that is, again, more exposed to various types of consumer credit. This has been, I think, a major concern. So maybe some of these fears were overblown, as all we talk about is the way that consumers are spending on credit, savings accounts are dwindling. Obviously, these companies benefit, but I don't think that necessarily means the consumer is like maybe more healthy than we think. I think that means that these companies are just benefiting from the current credit environment.
Okay, and maybe there was like part of a skew to the negative kind of narrative around it.
Right.
Because the chart's looking fine, and then the Synchrony move last week too. I think is it's continuing today at 2.5%. I mean, kind of curious. So thanks for keeping tabs on. I appreciate it, Jim. Thank you. All right, when we come back, our big picture discussion with the Schwab team takes us into the bell, and it's going to be a race to see if it's red or green for S&Ps because they're still within basis points, but it did shift back positive. Colin Martin talking bonds, Michelle Gibley for an update on the international look. Be right back.
To the 200. Boom, 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 boom.
Trading the
live from the New York Stock Exchange. Catch me on Schwab Network anytime, anywhere, on any device for free. Schwab Network.
I remember when I first started flying.
Mara up
and we would
14%
experience
today.
turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
You are privileged. You worked for it. You earned it.
Schwab Network's like no other financial media you've watched because it's all markets, all the time. It's 100% finance. We look at everything as traders and investors. And everything we say, everything we do is through that lens. There's no ulterior motive, and there's no subjectivity. There's no
9 more minutes.
guesswork about what we think. We are following the numbers all the time, relentlessly. We have the best CEO interviews, hands down. They're longer, more thorough, and tailored specifically to our audience. We never take our eye off the ball, which means we're always ahead of our peers.
That's true. Especially Anthony.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim. With robust charting and analysis tools, nearly endless customization, and up-to-the-minute news and insights. Trade brilliantly with Schwab.
All right, let's talk some big picture topics. Heading into the bell here, we got a little more than 9 minutes left in the session. Joining me from the Schwab Center for Financial Research, Colin Martin, Director of Fixed Income Strategist, alongside Michelle Gidway, Director of International Research. So Michelle, let's talk some France first. What the heck is going on over there?
Yeah, we had the first round in the French election yesterday. The second round is next Sunday. We could get some more volatility as the week goes by, and next week as well. You know, today French markets are breathing a little bit of a sigh of relief. The CAC was up a little over 1%, and the spread between French and German yields narrowed. And there are a couple of reasons for this. The coalition of the left appears unlikely to win a majority, and that's a positive because it reduces the chance
There
of
goes the spy.
fiscal spending. And then Le Pen's RN party won a smaller margin than expected, and that they appear unlikely to win a majority. So we could get a hung parliament.
$33.
And like I said, we'll get more political maneuvering this week as the parties work together to try to defeat the RN. And a hung parliament is good because it means new additional spending bills could be difficult to pass. Last year, France had a deficit of 5.5%, so they really don't need any more spending at this point.
Okay. And all this kind of fits in with the theme of an economy that could use some stability, generally Eurozone cutting, because the ECB sees a need for some economic help, right? I mean, this isn't really helping the situation.
Yeah, you know, even the increase in spreads between French and German yields wasn't that big. In fact, half of the reason for the increase in the spread is because German yields fell in kind of a flight to safety. We still think the ECB is likely to cut. This isn't going to change that. We'll get a Eurozone CPI tomorrow. It's expected to moderate.
Nice move.
Last week we got results from Spain, Italy, and France. Today we got German CPI. It decelerated to 2.5%. And it's been kind of settling in that area in recent months and suggests that inflation is stabilizing near the target. ECB meets on July 18th. They're unlikely to do anything then, but their next meeting, which will be September, we're still expecting another rate cut.
Okay. So the narrative kind of has firmed back up towards it not being a one and done, because that was kind of the rumor, but it seems like it's going to be one and maybe a few more till done.
Right, and you know, maybe every other meeting.
Okay, all right, Colin. Well, here we're skipping a meeting. We got no August. You know, bonds.
Beautiful.
With some pretty big movement the last couple days. Does it look to you like this is just kind of an acknowledgement that we are stuck with September, or is it trying to game out fiscal scenarios after November?
I'd say today's movement is maybe pricing out fiscal scenarios after November. I mean, that's really where we saw the jump this morning following that Supreme Court ruling, where we initially saw yields fall pretty sharply on a somewhat disappointing ISM number. But to your idea about the Fed outlook, there's a less than 10% likelihood of a cut in July. We think it's extremely unlikely that they do anything in July. I don't see what we'd see between now and the end of this month that would pull that forward. We do think September is still on the table. Right now, if you look at the Fed funds futures market, it's not necessarily pricing in a cut just yet. But I think if we get more of the data we've been seeing, and to steal Fed Chair Powell's line, more good data. So another month or two of low inflation readings, both from the CPI and the PCE, maybe more signs that the labor market's coming into balance, then maybe it could happen in September, but it's too early to say right now. We still think we'll get a cut this year. The timing will depend on that incoming inflation and labor market data.
Okay. We hit a new low for the surprise rate, I think, today. So generally things are softening up pretty notably, but also expectations were fairly high. Would you characterize the last month here as bad data, Colin, or maybe just worsening on the margin?
I'd say worsening on the margin, not necessarily bad, maybe just softer than expected. Again, good news on the inflation front. If we look at today's
resist resistance.
Numbers, you could, if it's a binary discussion, you could say bad, because if you look at that 50 level, above 50 is expansion, below 50 is contraction. This was below 50. I always look at the ISM with somewhat of a grain of salt, especially the manufacturing index, because we're not necessarily a manufacturing economy anymore. I think this week's services index will be more telling. But also it's a soft survey data as opposed to the hard data. So we've seen the ISM manufacturing index really come down sharply over the past, not just months, but year plus. Yet we're still seeing above trend growth. It's slower, but still above trend over the past handful of quarters. So I wouldn't say it's bad, but it's softer, and I think that's a good thing. In order to get inflation down to the Fed's 2% target, we need to see a slowdown. Not necessarily negative growth, nothing drastic, but closer to trend than what we saw, say, in 2022 and 2021.
Okay, so data softening doesn't support the notion of higher yields. Maybe some fiscal gaming possibly does, or just the acknowledgement that we can't cut until September. Colin, if it's the fiscal gaming part of the last point, does that mean bond auctions should be dicier then? Are we going to start getting some misses if this is about spending?
Maybe a little bit. We've been talking about this for a while, and if we go back to the fall of last year, rising treasury supply, rising auctions were pinpointed as a potential reason for why yields were rising. And it did coincide. The rise in the 10-year yield to 5%, for example, did coincide with those auctions. But we don't think that's a key driver. And so if we fast forward to today, we're not going to really see it as a key driver. Maybe a little bit of the margin. Maybe it'll lead to some volatility here and there. If there is a weak auction where, say, the bid to cover is relatively low, something like that, then maybe you see yields rise. But we're talking about basis points, not percentage points. So if we look at what our outlook is and where the 10-year is going, the rise or potential increase in auctions, I mean, it's at the margin for now.
All right. Great stuff. Thanks, guys, very much. Good conversations. Colin Martin, Michelle Gibley, appreciate that. Nice tag team there of some important issues here this week coming ahead of us, both for European elections and the role that's playing in their rate policy, as well as our own, and options too. Wednesday will be a busy day for the Treasury. When we get back, it's the bell, and it looks like stocks are going to be well in the clear. S&P's ramped it right up.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once a client knew that she was hurt, we were able to help her move forward. Your client won't care how much you know until they know
how much you care.
Accelerate your market knowledge
and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Well, there we go.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So, what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with
Today was not a bad day at all. Today was not a bad day at all. I didn't overtrade. I went and done a few things, got some errands done. So now I'm just going to kind of kick back and relax and meditate. I got to pay a tax bill. I'm not too excited about that. That's it. We'll see you all later, YouTubers. Hi, Zona. Thanks, Josh.